The term technical analysis might sound a little.
Technical analysts often say the trend is your friend because they think a security that's going up is more likely to keep going up, and a security that's going down is more likely to keep going down. Having a clear view of the trend can help an investor decide whether to buy, sell, or hold a position. However, sometimes determining the trend can be difficult, and that's why this video is so important. A simple moving average is a technical indicator or tool that tracks a security's price over a time period and plots it on a line. This essentially smooths out price fluctuations to give an investor a general idea where the trend is heading. Using simple moving averages to determine trends, an investor can better identify buy and sell signals. To create a simple moving average chart, start by choosing a time frame. A time frame can be any period of time, including a day, a week, or even a month. For this example, we'll define a period as a day. Let's create a moving average using a 20-day chart. We'll take each day's price and add them together. Then we'll divide that number by our time frame number, which in this case is 20. This gives us today's 20-day average price, which is a short-term moving time frame and one that active traders may use. To create a moving average, each day will drop the last day in the time frame and add to days. A 20-day moving average can help determine short-term uptrends, downtrends, and sideways trends. Examining a security's moving average in relation to its current price can help investors identify potential buy signals. For example, when a price breaks above an upwardly sloping moving average, this could mean it's a good time to buy a stock. Another buy signal could be a support bounce. This is when the security's moving average acts as a support level for the price. When the price comes down to the moving average and then rallies up again, this bounce could be used as a buy signal. On the flip side, moving averages can also help investors know when to sell a position. For example, if the stock's price rises to the moving average and bounces, this might be a sell signal. Looking at a simple moving average over a short-term time frame can be very helpful, but it has its drawbacks. One thing to be aware of is whipsaws. A whipsaw is when the stock crosses over the moving average, giving one signal, and then reverses quickly, giving the opposite signal. A short-term time frame like 20 days usually shows more whipsaws, which is why some investors may prefer to use intermediate and long-term time frames. For example, intermediate-term charts with a 50-day moving average show a smoother average and have fewer buy and sell signals. As a result, the investor may stay in the trade longer. Long-term trends like those found with a 200-day moving average are even smoother. When looking at all these averages together, we can see that the short-term average is confirmed by the intermediate and long-term averages. The main disadvantage of any simple moving average is that they're slow to reflect price changes. Because each period is given equal weight, day 50 counts as much as day 1. As you can see, a large gain or drop hardly factors into a moving average for some time. This is known as lag. Let's look at an example to illustrate this. If you use a simple moving average for buy and sell signals, your stock could experience a huge pullback well before the simple average reflects this activity. To avoid lag, consider using another analysis, such as a weighted moving average or exponential moving average. These types of moving averages consider recent data the most relevant and give it more weight. Consequently, these types of moving average lines react quickly to the security's price changes. This is helpful for active traders who want to place short-term trades. It's also important to note that moving averages don't predict future performance. They only confirm established trends. Even with these drawbacks, moving averages are a powerful tool of technical analysis that can help you determine trends and identify buy and sell signals.
Moving averages are technical indicators traders can use to track stock prices over time. The basic idea is that looking at how a stock's average price has changed over a specific number of days can show you if it has been trending higher, lower, or just moving sideways. You can also use moving averages to identify support and resistance levels. Two common moving average types are simple moving averages, SMAs, and exponential moving averages, EMAs. Each has its strengths and weaknesses. Which one you use for a given trade will depend on your strategy. A simple moving average is just what it sounds like, a straightforward calculation of a stock's average price, usually its closing price, over a set number of days. So, if you're looking at a 10-day moving average, you just add up the stock's last 10 closing prices and then divide that number by 10. And because this is a moving average, as each day passes, you add a new closing price as an old one drops off. As you might have noticed, SMA is a backward-looking indicator insofar as it gives equal weight to a 10-day old closing price as it does yesterday's closing price. As a result, a stock's SMA might not react as quickly to recent events. That's where exponential moving averages come in. EMAs attempt to correct for the lag time of an SMA by giving more weight to recent price moves than older ones. Unfortunately, because of the weighting, EMA is a more complex calculation, but most trading platforms do it automatically. So, how do you choose when to use an SMA or an EMA? That will depend on your strategy. For example, if your strategy is to buy a stock when the slope of its moving average starts to turn upward, potentially indicating a rising trend, or sell when the slope turns down, EMA might be a better choice because it favors more recent price moves and it can give you a quicker signal about a potential trend. One trade-off, though, is that traders who use EMAs to join trends are more prone to getting whipsawed. Whipsaws occur when a security starts moving in one direction but then quickly reverses and moves briefly in the opposite direction. For trend-following traders, whipsaws can sometimes lead to a series of losing trades. Traders who use SMAs tend to experience fewer whipsaws, though they might be slower when it comes to spotting trends. You can also use moving averages to identify support and resistance levels. Technically, you can use either SMAs or EMAs for that, but many traders prefer SMAs, which generally make it a more effective indicator, as conventions like this can help shape trends if enough traders follow them. Both SMAs and EMAs can be useful tools for traders who like to follow trends. Which type you choose often comes down to personal preference. Try experimenting with both types and see which best fits your personal trading style. To learn more about technical indicators and how to use them, watch the other videos in this series and subscribe to our YouTube channel.
In this demo, you'll learn how to edit and customize chart studies on thinkorswim. To start, go to the Charts tab and enter an underlying symbol. To add a study, select Studies. If you choose a preset study, for example, a simple moving average, the study will be added using preset parameters. However, if you'd like to adjust these parameters, right-click the study and select Edit Study Simple Moving Average. A window displaying the preset appears. For instance, this moving average is based on 9 days of data. If you want your study to show a 50-day moving average, select 9. Replace it with 50, then select OK. You can also edit a study before you add it. Select Studies. Then, Edit Studies. A window appears featuring a detailed list of available studies. Select the name of the study you want, then Add Selected. The name of the study appears at the right. Note that you can move studies to a lower panel. You can also delete studies by pointing to them and selecting the X. To edit a study, select the gear icon. Make any desired adjustments, then select OK. To preview the changes, select Apply. If you're satisfied with the appearance, select OK. The edited study now appears on the chart.
One of the things that Thinkorswim is known for is its powerful charting tools. It's got hundreds of studies, tons of drawing tools, and endless ways to customize. In this video, I'm going to show you how to get the most out of Thinkorswim charts. When an investor first logs into Thinkorswim, they find themselves here on what's called the monitor page, and I'm going to be navigating over here to the charts. Just wanted to show you where we're going to be spending our time in this video. Now, we also won't be using this left column, so I'm going to hide that using the little toggle right in the center of that margin, and that's going to buy us some additional real estate. So now that we're all set, I'm going to start with the basics, like how to pull up a symbol, and we'll also cover stuff like how to add drawings and studies and show you some tricks for saving time and customizing layouts for your trading style. So for our example stock today, I'm going to use the symbol AAPL. If we know our symbol, we can just type it in, or we can also just begin to type in the name of the company. For example, we might type in Apple, and the system will try to look for that symbol for us. And I find it here in the menu. Let's go ahead and click on Apple Incorporated Common Stock, and that's going to retrieve our default chart. All right, so now let's get acquainted with the general navigation of the chart. We're going to begin up here in the upper left, and you'll notice just to the right of that symbol, we have the name of the company. We have the current price, and you can see that the markets are open as of the time of this recording, so you're going to see some of these metrics changing. To the right of that, we have the amount that it has changed in dollar figures and percentage terms, and we also see the current bid and ask price. Moving further to the right, we can see the price column, ranging from $50 up to $150 for Apple, and down below we have time. You can see the months and the days. If we want to just spend a moment there to acquaint ourselves with the layout here, you can see that we're going in 1 week increments, ending on each Friday, and that coincides with lines on the chart. You can see these very faint dotted gray lines on the chart that intersect with those weekly intervals. You'll also see that there are red dashed lines. Now, those are helpful if we are an options trader. They show us the traditional monthly expiration for options, so that's a nifty little shortcut for options traders in the viewing audience. And you'll also notice that on the chart itself, you'll see little bubbles. Here is the lowest price for the displayed time frame up to the highest price of 145.09. As we look back down at the bottom of the price chart, we can see some icons that may not be familiar to everyone watching. We have a red telephone, a blue light bulb, and a green dollar sign. The telephone and light bulb tell us when earnings were announced. So we can see the results of those earnings. 73 cents with the example from a couple of quarters ago. $1.68 were earnings this last quarter. And an interesting feature of this icon is if we right-click on the red or the blue icon, we get the choice to go to read the press release for that earnings announcement or even listen to the conference call. You'll also see that just below that, by default, are daily volume bars. Apple's pretty heavily traded, so we can see probably on average trading between 100 million and 150 million shares average daily volume. We'll also note that the default chart style is a candlestick chart, and we'll talk about how to maybe change that later. As we look up here in the upper left, just below where we entered our symbol, we'll see that symbol again. We also see an indication telling us this is the 1 year, 1 day chart that Apple trades on the NASDAQ. And then as we move a little bit further to the right, you'll notice metrics that are constantly changing as I'm moving my cursor. So I'm going to pause my cursor, and you'll notice that as I leave it there, we have a D, which is telling us that the date where I've positioned that cursor was April 13th of 2020. Over to the right of that, we have the opening price for that date of 67.08. We have the high of 68.43, the low of 66.46, close of 68.31. The range in prices from the high for that day to the low of that day was $1.97. And then finally, we have this metric known as the Y value, which is simply telling us as we move our cursor up and down, the position of that cursor point along the Y-axis of a grid chart. So that could be a very helpful little tool. When a trader is wondering, wonder what the stock price was right here, they can just point at a specific level, and that Y value will tell them exactly what the price was there. In this case, 125.67. Now that you're oriented with just a general navigation of the charts, let's talk about how you can begin to analyze and customize the charts. I'm going to begin with analyzing different time frames. So as I've already pointed out, by default, we're on a 1-year daily chart, meaning that each little individual candle represents 1 day of trading activity. And to change that time frame, I can move my cursor right up to the tabs at the upper right, and you'll notice one that says D. That stands for daily candles. I'm going to click on that, and we have the choice between two menus. We can go to our favorites, which carry default time frame settings for the charts, ranging from a 1-day, 1-minute chart, showing only 1 day's worth of activity with minute-by-minute data, all the way out to a 3-year weekly. You might be wondering to yourself, well, what if I want a 6-month chart? What if I want a 5-year chart? Well, that's where we can adjust this with a custom time frame. So as I select time frame, you'll notice we have a few more menus to choose from here. I'm going to stay here on the daily default, and we have 2 metrics that we can tailor. We have the time interval and the aggregation period. It sounds fairly sophisticated. It's really simply telling us, well, what length of a chart do we want, and what do we want the candles to be within that chart? So we can choose, for example, let's switch this to a 2-year chart, and maybe we change this to a weekly aggregation period, or in other words, to weekly candles. Now, a trader might be fine with going up and changing those time frames manually in the way that we've just done each time they launch a chart, or maybe they want to add some new favorites to the chart. I'll see that in addition to having those default chart time intervals and aggregation periods, I can also set up a custom time frame for my chart. Set it for a specific range of dates, and then set in aggregation periods and chart time frames. Now, the last thing I want to quickly demonstrate here, let's go to our favorites. And let's say that we wanted within this menu, let's say that an investor doesn't want to have to go in and set up a custom time frame, or even using the default time frames to adjust their chart each time. They want to add a new favorite to the default list. That's okay. We can just come right down to the bottom list and click on Customize List. And here we can add our own customized time frame. So for example, let's say that we wanted that 2-year weekly chart to appear in our time frame menu every time we launched our favorites list. Let's add that. And you can see that it has appeared now down here at the bottom of that list. Now, at the moment, it seems kind of out of order. We have 1 day, 1 minute up at the top, going down to 3-year weekly, and then we have a 2-year weekly. How about we move that just up above 3 years? So while it's highlighted, I'm going to click on Move Up. And once I'm satisfied with that, I can just click Apply and then click OK. And from now on, if I'm on a 1-day time frame and I want to switch it over to that 2-year weekly, I can pop back up to that weekly tab. This custom time frame that we've just established will appear here in our favorites menu. Right now we're on the 2-year weekly, but if I were to navigate away to a 1-year daily, and then I wanted to go back, switch that to a 2-year weekly, there it is again. All right, let's put this back to a daily chart. Now, while our focus is on the time frame, there are commonly times when a trader might want to get a closer look at a specific time in the past, and they don't want to go up and necessarily plug that into the customized time frame tool. Well, another function that the chart has is a click and drag zoom function. Let me show you what I'm talking about. Let's suppose that we wanted a closer look going from maybe early August to the end of October. It doesn't matter what our time frame is. We'll just go to the start of that time frame, click and hold down that click and then drag. We can drag to the right, or we could have gone to the end and done a click and drag to the left. It doesn't matter which direction. But once we've selected the time frame of interest, we just release the click and it zooms in on that period of time. This allows the trader to get a lot more detail. Now, if we want to zoom back out again, if we look down in the lower right corner of the chart, you'll see a couple of magnifying glasses. One has a plus sign, the other one has a minus sign. One's a zoom in, the other one's a zoom out. Right now we're zoomed in, so to zoom out, we'll click on the minus sign magnifying glass, and as we click on that a few times, it steps out, and we're back to our default time frame. Now, if I click on that zoom in magnifying glass again, it's just going to zoom in. First of all, it's going to cut the displayed time frame about by half. It's going to be zooming into that right-hand side of the price action. And then we can zoom right back out again. Now, some traders also like to add some extra space to the right of their chart. They're taking a close look at recent developments, and maybe they're trying to imagine where prices might be headed from here. But right now we're running into the hard right edge of the chart. So let's add some extra space out here, and that can be accomplished down at the lower right corner again, we have our magnifying glasses, and you'll notice we have a double-headed arrow. If I click on that icon, this is our right expansion settings arrow, and I can change those right expansion settings. We're literally adding blank space to the right of the chart. Right now, there is 0 extra space, so let's just change that. Let's say that we want to add 10 trading days of space, or in other words, 10 bars to the right. Now I'm going to click Apply, and as I do that, keep your eye on this far right margin. You're going to see some blank space appear. And there it is, so we'll click OK. And now the trader might be ready for some deeper analysis of the chart. So let's get into some of those tools. Next thing I want to show you is how to change the chart styles. As I mentioned, by default, we're looking at a candlestick chart. And since candle is the current chart style, I'm going to go up to Style, click on that menu, and I'm going to change our chart type from candle to a line chart. For some traders, candles may contain too much information. Maybe they just want to see how prices are moving close to close and maybe see what the general trend line is overall. So I'm going to select a line chart. And that's how quickly we can change that style. Now, as I was in that menu, you may also notice there are a number of other chart styles that might be chosen. Bar, candle, Heikin Ashi, line, equivolume, lots of other chart tools. I'm going to change our type back to a candle. All right, one function that's very popular among chart users is the ability to analyze their charts through applied drawings. And we have some really powerful drawing tools here. They can be accessed in a number of ways. We can find the drawings up here at the top. We can also find our drawings down in the lower right again. I'm going to use that area. And you'll see that right now our active tool is just that cursor tool. I'm going to click on that cursor, and it gives us a menu of all sorts of drawings that might be applied, ranging from Fibonacci retracements, arcs and fans, to channel tools, to rectangles and ovals. We can use these tools to make notes on our charts using text. But I'm going to use the trend line tool. So I'm going to select this diagonal trend line icon, and you'll notice my cursor is now changed to a little pen, which means that I'm prepared to start drawing on the chart. This little technique applies to pretty much any of the tools on the charts. We're going to do 2 clicks to complete a drawing. Let's suppose that a trader has identified that Apple really seems to be moving up a ramp here, what we call a support line, and they want to draw a line representing the lows for most of the year. So I'm going to come to this low back here in March of last year. I'm going to click once. That starts to draw, and then I'm going to move up to where I want to end the line, and then just click again. And that affixes the line to the chart, and that stays there until I choose to delete it. So if I were to navigate away to a different symbol and then come back, this drawing would still be here on Apple. Now I can also customize these lines once they've been drawn. I'm going to right-click on this line, and I'm going to choose Edit Properties from the pop-up menu. Now this allows me to do all sorts of things with this line, including changing its color. How about we choose maybe a nice blue color? We could choose this bright blue, or down here where the button says More, we have a whole palette of colors. How about we make this a nice bright blue? So that's going to change the color of the line. We can also change the style of the line from a solid line to a dashed line or a dotted line. I'm going to select dashed. And finally, the width or the thickness of the line. How about we go with the thickness from a scale of 1 to 3? Let's go for a 3. Now this is going to customize this line, but let's say I also want all future lines that I draw to be blue dashed thick lines. Well, I can just save this as my default line and then click OK. And you'll notice now that line has changed from a thin red line to a dashed blue line. And if I draw new lines, they're also dashed blue lines. Finally, if I filled my chart up with lots of drawings and I want to clean it up, I can just right-click on that drawing. And among the many choices that I have here to do with these things, we can either remove an individual drawing or we can clear the entire drawing set, all the drawings on the chart. That's what I'm going to do here. Click Yes, and those drawings are gone. Now, the technicians in our viewing audience may have noticed within that Drawing Tools menu, as I mentioned, we have the Fibonacci retracement lines. I'm going to click that. And this is a tool that's sometimes used by technicians to identify areas of support and resistance, potential price turning points. Just to illustrate the similarities between drawing a trend line and drawing a Fibonacci, we're going to go to where we want to start our Fibonacci and click once, and then move up to where we want to end that Fibonacci and click again. And there, for you Fibonacci users, is a now familiar tool. And to delete it, it's the same process. To remove this from our chart, just right-click somewhere on that drawing and remove drawing. Now, it's quite common for combinations of drawn trend lines to represent what we call price patterns on a chart, and those can be applied manually. For example, if I came back down here, I switch back to my trend line tool, maybe I recognize a triangle on my chart with lower highs here, higher lows here. There's a potential symmetrical triangle. The common price behavior is known as a price pattern on a chart. That can be done manually, but we also have a tool that will help us search for patterns, and that's found right up here in the upper right corner of the chart. I'm going to click on Patterns. The first thing that we'll need to do is make sure that this button here that says Show Patterns is checked. This is essentially the on-off switch for this tool. It's already checked, so I'm just going to leave that checked. And then I'm going to click on Select Patterns. And once again, for our veteran technicians, they're going to recognize a number of these titles: ascending triangle, channel down, channel up, descending triangle, right on down to triple top. Now, if you're not familiar with these patterns, you can come right over to the little question mark right next to each one. For example, I'm going to click on triple top, and this gives us a theoretical example of what a triple top might look like on a chart, and it gives us a description of what that pattern is and how it might be applied in technical analysis or charting of a stock. But the feature that I implied of this tool is we can select one of these patterns, we can add that pattern to the chart, and then click Apply, and the tool will scan to see if there is a recent example of that pattern on the chart, and it will display that on the display window. So I'm going to click OK, and we still have our triangle pattern, but no apparent recent examples of a flag pattern. Now, before we leave that Patterns tool, I'm going to go pop back up to that Patterns tool, go back to Select Patterns. We have our flag pattern selected here, and it does have the ability to be customized. Another common icon that you will see displayed on Thinkorswim charts is a little gear icon. This means that something can be customized. So if I click on that gear, I can set the time frame to look for other patterns. So if I want to look, let's say, just within the last 10 to 50 days, I can customize that time frame here. If I want to look back 50 to 100 days, that could also be done. But for today, we're not going to customize that. We're going to click the X and then click OK and close that tool. Now, to prevent any subsequent flags being discovered and displayed on a chart and that being a distraction through the rest of this video, I'm going to pop back up there to Patterns, and I'm going to uncheck the box for Show Patterns. So I'm going to pop up here to the Studies tab, and as I click on that tab, you'll notice the very first two items in that menu are Quick Study and Add Study. And as I navigate back and forth between those two, you'll notice that apparently identical menus pop up: Quick Study and Add Study. There is an important distinction between these two. The Quick Study is intended to just display a single technical indicator or study on a chart. It will delete any existing indicators or studies from that chart to give a good, clear picture. So obviously the Add Study means we're going to keep the studies that are on the chart and add a new one to that study set. So regardless of which one we choose, let's get ourselves acquainted now with the menu here, and you can see how deep and how broad the available menu of technical studies is on Thinkorswim charts, ranging from the alpha studies all the way down to volatility studies, A to V. And what I'll do as an example today, let's just go to moving averages, which has been, in my experience, maybe among the most common technical studies used on a chart. And let's suppose that a technical trader is looking to add a simple moving average to their chart. So I'm going to navigate over to the right menu and select Simple Moving Average. And as I do that, you're going to see that a default green line has appeared on the chart. Now, to give us a clearer view of this, I'm going to do a little bit of housekeeping here. I'm going to delete these two lines that we've already drawn. You should now be familiar with how this is accomplished. Right-click and then clear that entire drawing set. I wanted to save this just as a reassurance to those who think that erasing a drawing also might erase studies. Not true. This is just going to clear off the drawing. So it's going to clear the drawing set and click Yes. And now we have a nice clean chart showing just this blue line. For those of you who are familiar with moving averages, we know that that's just connecting. It's, in this case, looking at the average closing value of price for the last 9 days on Apple and plotting that as a dot on a chart. And as those values change over time, it creates a line. For some technicians, this might represent potential price floors and price ceilings. It might also identify the trend. But in any event, we'll notice that in our example moving average, it's hugging very close to price activity. So if we were using this for entry and exit signals, they might be coming very rapidly. And for some traders, that might be too much information. Maybe they want to keep a moving average on the chart, but slow it down. So let's customize this study. To customize the study, I'm going to head up to the beaker icon or the flask icon. I'm going to click on that, and I get a pop-up menu. Now, this menu allows us we could add new studies. So this is a different way that we could add new technical studies or indicators to the chart, or we can customize the current study. So here in the right window of the pop-up, you'll see we have price, we have volume, and we have lower, because some technical studies are applied to the price chart as this simple moving average is. Some are applied to that volume window that we see down below. And then finally, we may have some that are applied even lower than that. Down below the volume, we might want to add another technical study. But for now, let's customize our simple moving average. And as I showed before, when we get a little gear icon, this indicates that something can be customized. I'm going to click on that, and let's change the length of our moving average. The default is a 9-period moving average. How about if we crank that out to a 50-period moving average? When we use larger numbers with technical studies, it slows them down. So what it'll do with this one is it's going to change it from a relatively volatile short-term trend line to a smoother, longer-term trend line. So now we're just going to click OK and click Apply, and keep your eye on this trend line in the background as I click Apply. And you can see there it is, smoothed out, longer term, generating fewer signals. Now, before I close the window, I also wanted to show how we might add a study to the chart. Let's say that we wanted to add a lower study. And for example, let's add a moving average convergent divergent oscillator. It's also known as the MACD histogram. So I can come over here to this left column, and this is arranged in alphabetical order, and you can see just how many technical studies and indicators are available on thinkorswim charts. It really is a powerful tool. We go down and find this down among the M's in alphabetical order, or we could just type in MACD, that acronym. And you can see that only the studies now that contain that acronym MACD are now displayed. And I'm going to select MACD histogram, and I'm going to click Add Selected. And this is going to do two things. First of all, it's going to populate over here in our lower studies. And then as I click Apply, you'll see the MACD appear down below. There we go. There's our MACD histogram. So now we are customizing existing studies. We're adding new studies. And let's say that we've stumbled across a study that we're not at all familiar with. Before we add it, or as we're customizing it, what we may want to do is click this little question mark again. Just as we saw before, when we click on the question mark, we get more details about that item. In this case, it's the description of the MACD histogram. All right, we're done with that. So I'm going to click OK. And this will bring us back to our chart where we can begin a deeper analysis using these indicators that I've just added. Now, before we move on in our discussion, though, there are two other features of that studies tool that I wanted to show you. Let's head back up to that Edit tab. And I wanted to point out that there are two menus here. We have Studies, which are the indicators themselves. And we also have Strategies, which are a combination of indicators and predefined entry and exit signals using those indicators. So as I select Strategies, we get a different menu, very similar in some ways, but this in some ways is also more thorough. Because in addition to having the technical study, if we click on the little question mark, this will also give us potential ways to implement that study on a chart. And finally, within this window, there's a button that says Create. This really does allow a technician who is, let's say, the tinkerer who likes to build their own technical studies right from scratch. Maybe you have a concept for a technical tool that hasn't been developed yet. Well, there's actually a programming language that's built into the thinkorswim platform that allows you to create from scratch your own technical study and save it for application to your charts and for your own analysis. Now, this is a function called ThinkScript. It is a study unto itself. And this is another reason why you might want to continue pursuing additional videos and courses that are available to you through thinkorswim. All right, so let's say the trader has their chart all set up just the way they like it. They have their moving average applied. They have their MACD histogram. Well, once those are established, if we were to shut down thinkorswim and come back, they would still be there on the chart. However, once we change those for a different set of studies or add another study, that new construction is the new default. So some traders really like this feature that is saving a study set. So right here, you'll notice there's a button that says Save as Set. If I click on that, it's going to give me the opportunity to give this set a name. Let's give it a simple name. Let's say it's a moving average and MACD. So I can just click Save as a set. And what this has now done invisibly is it's given us a quick link. If we've changed to a different set of indicators, we can quickly pop back to our MACD and moving average configuration, just like this. Let me click OK. And I'm going to go up to that Studies tab and then down the menu to Load Study Set. And you'll notice there it is, MA and MACD. So if I were to change my configuration, I could switch it right back. Now, the final item when dealing with customized study sets and customized studies is how do we remove them from a chart? Well, we can actually get rid of all of our studies right here. Within this menu, just select Remove All Studies, or we can pop up to that Edit Studies tab and go just to the left of that gear icon, click the X. Let's remove our simple moving average. Let's remove our MACD histogram and come down and click Apply. And now we're back to a nice clean slate again. Now, as I look back up to the top right of the chart, we'll see we have two tabs left to explore. This first tab is known as the Chart Describer. I'm going to just click on this while we're displaying Apple. And what this does by default is, according to the time frame that we've selected, the system will automatically look at some of the more popular technical indicators and give us a quick summary of maybe some pertinent points, important developments regarding those technical indicators with this chart. Notice those indicators are not displayed on the chart. This is just a summary of what we might see if we were to retrieve those indicators. If we're not familiar with those indicators, we can click on the indicator name and we'll get those now familiar menus. Or if we want to add those studies to the chart, the standard deviation channel and the simple moving average, we can come right over to the far right and click Add Studies to Chart. And then once we've had a good look, we can remove those studies for the same process, pop up to the Studies icon, and remove all studies. I'll just click Yes, and we're back to that nice clean slate again. And that final tab is what it claims to be. It's a share function. If you have been doing your homework and you have created a nice chart, maybe you've performed some analysis that you're proud of and you want to share it with your technically trading friends, you can just click on the Share button. You'll get a pop-up menu that says Share Chart. I'm going to click Share again, and this is actually going to generate a little URL that can then be sent to an acquaintance, and the acquaintance can then use that to load up that same layout on their own chart. So I'm going to click Share. They can just launch their own Thinkorswim, go up to Setup in the upper right-hand corner, and select Open Shared Item and enter that URL right there. And that will display your chart for that acquaintance. I'm going to close that out. And the last little navigational technique I wanted to show you, I want to leave you with, could be a real time saver. For many traders, they like to process through a number of charts very rapidly. And to do that, we're going to use that left column that we've hit at the beginning of this video. I'm going to open that back up again by clicking the little toggle. And let's say the trader wants to navigate through a watch list of stocks that they're keeping their eye on, but they don't want to have to type in those symbols individually on the chart. Let's clear up some space right up here at the top of our chart. We're done with our Chart Describer tool, so I'm going to come to the far right, click the X to remove that tool. And now what I'm going to do is tie our watch list to our display window on our chart. It's done very simply. I'm going to open up this margin just a little bit further. And what you'll notice is just to the right of our watch list title, there's a little number that is color-coded. Right now we have a yellow 2 in our watch list, and we have a red 1 over here by Apple. What I need to do is just make sure that these two match. Now, by default, you may see this displayed as a little chain link. Doesn't matter whether it's a chain link or if it's a color-coded number. I'm just going to make sure that those match. So I'm going to let's choose a red 1 here and a red 1 here. And now, as I click on the symbols in my watch list, watch what happens on the chart. You can see they're automatically populating with those symbols. Very quick navigation. We can move all the way through a watch list very quickly. And as an additional navigational technique, You can also use the up and down arrows on your keyboard without even touching your mouse. For example, my hand is off my mouse right now. I have my hand on the up and down arrows on the keyboard, and I'm just going to click up and click down, and you can see that processing back and forth very quickly. That's your quick introduction to thinkorswim charts, but obviously there's still a lot more you might want to learn. For more tutorials and other investor education, subscribe to our YouTube channel and check out Insights and Education on Schwab.com.
A bull flag is a common price pattern that forms when a security temporarily pulls back during an upward trend. In this video, we'll discuss how to identify a bull flag pattern, how it's used to determine potential buy signals and price targets, and the risks and goals of using this price pattern in your trading. Let's start with how to identify a bull flag pattern. This pattern forms in a time of consolidation, which makes this a continuation pattern. This means that when the price breaks out of the pattern, it's likely to continue in the same direction it was heading before. The pattern begins when a stock's price rises from a low point to a high point, or in other words, from the bottom of a support area to the top of a resistance area. The initial movement represents the flagpole in the pattern and is followed by a pullback that creates diagonal support and resistance levels. These diagonal levels create the pattern's flag. Typically, the pullback should not retrace more than 50% of the upward movement. Bull flag patterns can come in many sizes, but will typically pull back at least 3 periods. So if you're looking at a daily chart, the minimum pullback would be 3 days, and if you're looking at an hourly chart, the minimum pullback would be 3 hours. The pattern is complete when the price closes above the original diagonal resistance level and finds a new level of support. This breakout point is typically seen as a buy signal. Once the stock has broken through resistance, it's important to confirm the move. To do this, look for higher than average volume as the stock breaks through resistance. Higher than average volume is important because it means the stock's price may be more likely to continue upward. After identifying the bull flag pattern, you can determine sell signals by setting a price target. A typical price target for a bull flag pattern is equal to the height of the initial upward movement. In other words, the price target is usually approximately the height of the flagpole. Some investors use the resistance breakout as the starting point to measure the price target, while more conservative investors may set the price target from the support level. As with any price pattern, bull flags aren't guaranteed to break out as expected. There is a risk the stock's price could fall through support instead of reaching its price target. For this reason, investors can set a stop loss to try to prevent further losses in case the price doesn't continue upward. Despite the risks, bull flag patterns may help you identify potential buy and sell signals.
Technical investors feel that following trends is an important aspect of investing, and investors sometimes use complicated formulas to measure trend. However, there is a way to simplify trend identification that gets to the root of how trends are formed, measuring highs and lows. In this video, we'll show you how to identify trends using highs and lows, how to identify potential changes in trend, and how to use these changes in trends to help protect potential profits. Uptrends, sideways trends, and downtrends are comprised of sequences of highs and lows. A stock generally doesn't go straight up or down, but rather moves back and forth and produces support and resistance levels. An uptrend is defined by the highs and lows forming higher and higher. In other words, each higher low could result in a higher high. In a sideways trend, the highs and lows are equal. Each equal high should result in an equal low until the sequence is broken. And a downtrend is comprised of a sequence of lower highs and lower lows. Each point identified as a high or low becomes a benchmark for the next sequence of highs and lows. Some investors monitor these highs and lows to anticipate changes in trends. This is an example of a stock in an uptrend based on rising highs and lows. The price has recently created a higher low and now might produce a higher high. However, in this case, it failed to do so, and is given a sign that something might be wrong with the trend because it didn't do what was expected. Now, the price has rejected the higher highs and broken below support, producing a lower low. If an investor missed the first warning sign when it failed to produce a higher high, then this next warning sign should be a red flag that the uptrend is in trouble and likely starting a new downtrend. Some investors miss the first warning sign, and even worse, miss the second warning sign and enter or exit trades too late. A way to avoid this risk is by learning to identify where the price may go under normal circumstances and acting quickly when identifying abnormal moves. Consider moving out of a position when it fails to produce a higher high, rather than just waiting for support to break. Here is an example of a trade that enjoyed an uptrend by consistently making higher highs and higher lows. The higher support level is a good sign, but then the trend weakens when it makes an equal high instead of a higher high. This may be a good time to move out of the position and watch it closely to see if it can recover. After a few more days, however, the price dropped more and actually broke support to produce a lower low. Here is a slightly different hypothetical example of a stock trading in an uptrend, but where an investor might expect a higher low, it sinks all the way down to an equal low as support. This is the first sign that the sequence was broken and the trend might be changing. After several days, it becomes clear that momentum is unable to push the price any higher and it makes a lower high. Consider moving out of the position at this point and maybe re-entering if the trend improves. But for now, the analysis indicates the trend is not strong enough to keep going. After several more days, it has dropped below support and started a new sequence of lower lows and lower highs. An investor may want to reevaluate their entry point with the understanding that a downtrend may be reversing when the stock manages to break the cycle of lower highs and lower lows. In this hypothetical example, the stock finally broke above a high, making a higher high. Generally, when a trend is broken, the price tends to come back and test the old resistance as new support. In this situation, some investors might consider waiting for a possible retest and establish a position if a stock shows it can hold at a new higher low.
Bollinger Bands are a technical indicator that can help you define trends and measure the volatility of securities like stocks. In this video, we'll explain how Bollinger Bands are calculated and applied, and address the benefits and risks of using this indicator. The bands are calculated using standard deviation from a moving average. Standard deviation is a statistic used in probability theory and is commonly applied in financial markets to measure volatility. In financial markets, standard deviation measures the volatility of returns from a historical average or mean, such as a 20-day moving average. Bollinger Bands are typically plotted 2 standard deviations above and below a moving average. This means about 95% of a security's historical price movement is likely contained within the 2 bands. This information can help you add context to trends and potentially determine when they might be overextended and reverse. Because the bands typically contain about 95% of a security's price movement, it's unusual but possible for the price to move outside the bands. But when it does, probability theory assumes the security price is likely to revert back to a moving average or mean between the upper and lower bands. This is called mean reversion, and some investors might use it to make trading decisions. Let's look at an example of how you may be able to identify entry and exit points using Bollinger Bands. A potential entry point can be set up when the price of a security falls below the lower band. Here, an investor might wait for the price to close back above the band before entering the trade. This is a form of confirmation when applying mean reversion strategies. A reversion to the mean is complete when the security rises back to its moving average. Some investors use this as an exit point. Others might target the upper band as an exit point, which is typically a bigger profit target and can take longer to achieve. Investors using the upper band as a target might look for confirmation by letting the price move above the upper band and then waiting for a close back below the band before exiting a trade. The idea is that a break back below the upper band is likely to revert to the moving average. Some investors look for additional confirmation by considering the slope of the bands. Put in simple terms, if the bands are sloping up, then the security is in a potential uptrend. Conversely, if the bands are sloping down, then the security is in a potential downtrend. So, by referring to the slope, some investors might only take entry points in uptrends and ignore entry points in downtrends. Timing entry and exit points in these ways is one of the main benefits of applying Bollinger Bands. Additionally, the bands can help investors visualize statistical properties of securities and help identify when prices move unexpectedly 2 standard deviations away from a moving average. Keep in mind that these deviations can last for long periods of time, which is one of the biggest risks of using Bollinger Bands. Remember that probability theory assumes that security prices are mean reverting, but this assumption frequently breaks down in the real world. Here's a typical example of a security that has fallen to its lower band, or 2 standard deviations away from its moving average. Notice how the price continues falling along its lower band before eventually returning to the moving average. A mean reversion can take a long time, and during that time, the price of a security can continue falling. That's why investors typically avoid taking entry points every time a security falls below the lower band. Using Bollinger Bands as a standalone indicator is risky. For a more balanced approach, an investor might consider using Bollinger Bands to add context to trends and help time entry and exit points that arise from other forms of analysis, such as fundamentals and the market's overall trend.
Swing trading is a short-term investing tactic that tries to profit from fluctuations in the price of an investment. Unlike a day trade where you enter and exit an asset in the same trading session, a swing trade can last anywhere from a couple of days to a couple of weeks. Those who try to swing trade hope to compound returns and increase their portfolio's overall performance. Let's take a look at how some swing traders approach stocks and some ways they manage risk. Swing traders tend to use technical analysis to determine when to enter and exit a trade, studying price charts rather than relying on fundamental analysis or studying financial statements, which is often used in other investing strategies. When analyzing a price chart, you'll notice the price rarely shoots straight up or drops straight down. Instead, it'll tend to move gradually toward peaks and troughs. Swing traders want to buy at a trough, ride the upswing, and sell at the peak. Alternatively, they'll sell or short at the peak, ride the downswing, and then close at the trough. Strictly speaking, swing trading refers to trading the short-term trends between the peaks and troughs, but the definition is broadened over time to include most short-term trading. Despite focusing on the short-term swings, swing traders usually trade with the broader trend, which means taking the upswing during uptrends and downswings during downtrends. During a sideways trend, they can try to trade both the up and the down movements. There are three components to a swing trade that should be determined before placing a trade: when to enter, when to exit, and how much to trade. Let's start with entries and exits. There are hundreds of ways for swing traders to pick entries and exits. Many traders use basic charting techniques like support and resistance or price patterns like flags and triangles. Others use charting indicators like moving averages and oscillators, which can help provide more objective signals. Because many swing traders start with support and resistance levels, let's use those for an example. It may help to think of support and resistance like floors and ceilings, where the price of a security tends to change direction within the larger trend. There are two common entry signals when trading on support and resistance: a bounce and a breakout. A bounce occurs when the price moves to a support or resistance level and then heads back in the other direction. Someone looking to trade off it would set a target exit at the previous level of support or resistance. For example, when Honeywell dropped near $170, which was its previous low, it turned higher again, creating a bounce. A swing trader could use that bounce to enter a bullish trade and set a target price at the previous high of around $200. If the trade worked in their favor, they could capture as much as $30 per share, not accounting for any commissions or fees. Another signal is a breakout, which occurs when the price moves past a support or resistance line. A trader would set a target by measuring the previous distance between the support and resistance lines, then adding that range to resistance for bullish trades or subtracting it from support for bearish ones. Let's look at another example. Schlumberger was trading between $38 and $44 when the stock broke above resistance, a breakout signaling a potential entry. The range between support and resistance was about $6, which, if added to resistance, would show a target at $50. However a trader determines entries and exits, it's important to have a plan in case the unexpected happens. In fact, it's common to have two exits planned, for if things go right or if things go wrong. Many swing traders use a proverbial line in the sand known as a stop, which helps them determine when to abandon a trade that's going the wrong way. For example, a trader might decide to close this example trade if the stock dropped to $43. Some traders use an actual stop order, while others monitor the price closely or by setting an alert and then placing the order themselves. It's important to know that stop orders often don't fill at the stop order trigger price. When a stop order triggers, it creates a market order. When the stock next trades, it could be much different from the desired price. Before actually placing a trade, traders should determine how many shares to buy. A few factors can help calculate how much to invest in the trade, including the stop price and the portfolio risk. Let's say we have $50,000 in a trading portfolio and we're willing to risk no more than 1% of the portfolio on a trade, or $500. This is the portfolio risk. Next, we'll divide the portfolio risk by the trade risk, which is the difference between entry price and stop price. For our example, let's say the trade risk was $2. If we divide the portfolio risk of $500 by the trade risk of $2, we could buy 250 shares. Of course, this is only one way swing traders calculate their position size. You'll want to find a method most appropriate for you and adjust it to fit your risk tolerance. Comparing the trade risk to the potential reward can also help determine if a trade is worthwhile. Let's say a trader bought a stock at $55 per share with a target price of $60. They decide to close the trade for a loss if the stock falls $2. That means they're risking $2 to potentially make $5, not accounting for any fees or slippage. But if the target was $56 with the potential to make $1 while risking $2, it could mean that the reward may not be worth the risk. There are other risks to swing trading, such as the stock shooting past its target or failing to make it to the target. In our first example, it continued to climb past its target price, and if the trader sold, they'd have missed out on those gains. That's a risk a swing trader must accept. Then, in our second example, the stock came really close to the target but didn't quite make it before starting to fall. If the trader was waiting to close at the target, they would have missed out on the gain. One way traders try to address this risk is by moving up their stop orders as the stock increases to attempt to lock in gains. Just remember that relying completely on stop orders could result in missing some potential gains and carries the risk of orders not filling as expected. There are many ways to approach swing trading, so get started by determining which techniques and indicators best fit your trading style. Then explore money management strategies that work for your risk tolerance. Finally, practice by paper trading your strategy before putting your hard-earned dollars at risk.
Let me show you how to find potential buy signals for stocks by screening for bullish moving average crossovers, aka golden crosses, on Schwab.com.
A bullish crossover happens when a moving average line with a shorter time period crosses above a moving average line with a longer period, establishing a potential upward trend. All right, on Schwab.com, let's go to Research, then Research Tools, and select Stock Screener. A lot of S's there. Then select Technicals, and today we'll focus on SMAs. Select a time period. For this example, I'm going to choose 50 and 200 day SMA cross.
The length you choose may vary based on your investing goals.
Now I'm going to select Bullish, giving me 21 companies.
Also, I should mention that there's never any guarantee that the trend highlighted by a crossover will continue.
Technical indicators are trading tools that use historical price data to help investors identify things like a security's trend and potential entry and exit signals. There are hundreds of them, so it can be difficult to determine which to use. Some new traders add numerous indicators to a chart and get stuck in analysis paralysis. By understanding the different types of technical indicators and their purposes, you can zero in on a few indicators to help you make trading decisions or even build a consistent rules-based trading system. We'll discuss 4 major indicator categories, including trend tracking, oscillators, sentiment, and flow of funds. Trend tracking and oscillator indicators are generally used for creating trading systems, while sentiment and flow of funds indicators are commonly used for determining the strength of the broad market trend. Let's break these groups down and determine when you might use them. We'll start with trend tracking indicators. One of the basic tenets of technical analysis is the trend is your friend. This means a trader should consider using bullish strategies in uptrends and bearish strategies in downtrends. One of the most common trend tracking indicators is moving averages. A moving average tracks a security's price over a certain time period and plots it on a graph. For example, the 50-day moving average takes the average closing price for the previous 50 days and charts it. If the line is going up, the trend is up. If the line is going down, the trend is down. Long-term investors may choose a 200-day moving average, while short-term traders may choose a 20-day. The moving average can also be used to help determine buy signals. If the trend is up, Investors may buy when the stock price moves above the line and sell when the price moves below the line. Other common trend tracking indicators include linear regression, envelopes, and Bollinger Bands. Often, trend traders look at other indicators to confirm a buy or sell signal. This is one use for the next group of indicators: oscillators. Oscillators typically measure how quickly a security's price is changing and chart it in a range to identify extreme values. Extreme values may suggest that a security is overbought or oversold, which could mean it's ready to reverse direction. Like watching a ball thrown in the air, you could tell it's about to start falling when its rise slows. A commonly used oscillator is the stochastic indicator. The stochastic measures momentum by comparing a stock's current price to its range of movement over a set time. If the stochastic line is rising, then this indicates that the price has bullish momentum. If the stochastic line is falling, then momentum is slowing. Some traders identify the extremes of the stochastic indicator as reversal zones. These reversal zones can suggest the security is overbought or oversold and can be used as trading signals. For example, the line crossing above 20 and out of the lower reversal zone could be a bullish signal. The line crossing below 80 and out of the upper reversal zone would be bearish. These signals can be used as confirmation with trend indicators like moving averages or as their own entry or exit signals for trading shorter-term swings. Other common oscillators include the Relative Strength Index or RSI, Moving Average Convergence Divergence or MACD, and the Commodity Channel Index or CCI. The next type of indicators, sentiment indicators, aren't commonly used to trade specific securities. Instead, they gauge investors' beliefs about the direction of the market. They tend to be popular with contrarian investors who are looking to pick market tops and bottoms. Many sentiment indicators are polls conducted by private companies to help determine if professional and retail investors are extremely bullish or bearish. Access to these polls often requires a subscription service. However, the options market offers some popular sentiment indicators you can access from most charting platforms. One of these is the put-call ratio. This indicator compares the number of puts purchased versus the number of calls purchased on stocks in a broad index like the S&P 500. Puts are commonly purchased when investors are bearish, while calls are commonly purchased when investors are bullish. If there were an equal number of calls and puts purchased, the ratio would be 1. However, investors tend to be bullish more often, so the ratio tends to be below 1 most of the time. Contrarian investors attempting to identify market extremes may interpret a ratio spike above 1 as excessive bearishness, suggesting a market bottom could be near. Often, investors will rely on more than one indicator to determine tops and bottoms. Other common sentiment indicators include the CBOE Volatility Index, or VIX, historical PE ratios, the Advanced Decline Line, and consumer sentiment. Finally, there are flow of funds indicators. Flow of funds analysis attempts to track changes in supply and demand for investments. In other words, it's a way to see where people are putting their money. One widely available flow of funds indicator is the ARMS Index, also known as the Short-Term Trading Index, or TRIN. The ARMS Index compares rising stocks called advancers to falling stocks called decliners in a stock exchange. The first level of comparison is the number of advancers versus the number of decliners. If advancers outnumber decliners when the market is uptrending, then it suggests that the rally is broad-based and strong. If the decliners outnumber the advancers during an uptrend, the uptrend is weakening. Next, the ARMS Index compares the volume for advancers to the volume of decliners. If advancers are seeing high volume, this means more money is flowing into bullish stocks. If the decliners are experiencing high volume, then money is flowing out of stocks and into other investments. A measure of 1 or less suggests more money is going into advancers. A measure above 1 suggests more money is leaving stocks. It's not uncommon to see the ARMS Index bounce above and below 1. Large positive or negative spikes indicate extreme conditions and are often used by contrarians to signal a final surge before changing directions. Other common flow of funds indicators include Chaikin money flow, on-balance volume, and the commitment of traders report. When it comes to selecting which indicator to use, it starts by defining what it is you want to accomplish. If you're looking to build a trading system, you may want to consider focusing on a trend tracking indicator and supplement it with an oscillator. If you're looking to trade short-term swings, you may want to focus primarily on an oscillator. Long-term investors may choose to focus on sentiment and flow of funds indicators to determine if the market is bullish, bearish, or neutral, and to what degree. Once you've defined what you want to do, it's easier to determine which indicator may be best. Whether you want to build a system or just enhance your decision-making process, there's probably a technical indicator that can help. The next step is to match the appropriate indicators with your investing goals.
A symmetrical triangle is a price pattern that forms when support and resistance levels converge. This continuation pattern, or pattern that occurs mid-trend, is likely to continue following the trend after a breakout. In this video, we'll discuss how symmetrical triangles form, how to use them to identify potential buy and sell signals, and what actions you may consider if a breakout occurs. First, let's discuss why this pattern exists. Symmetrical triangles occur when a stock is consolidating or trending sideways. Consolidation is regarded as a period of investor indecision that ends when a trend stops moving sideways and either continues or reverses direction. Basically, consolidation occurs when buyers and sellers are equally unsure if a trend is going to continue. During this period of indecision, support and resistance levels inch toward each other. This creates a symmetrical triangle. Now that you understand how a symmetrical triangle forms, let's learn how to identify the pattern. First, the stock price needs to touch the rising support level at least twice, and the diminishing resistance level at least twice as well. If this pattern continues, support and resistance levels will eventually cross. When they do, this cross point is called the apex. While stocks rarely reach the apex, it's an important element to consider when setting price targets, which we'll explain later. The next way to confirm a symmetrical triangle is by examining its time frame. Triangles usually take between 3 weeks and 3 months to form. If this pattern forms in less than 3 weeks, it's generally considered a pennant. Now that you know how to identify a symmetrical triangle, let's discuss how they can be used to identify potential buy and sell signals. While some traders are confident trading within support and resistance levels, other traders wait until a breakout is identified to buy the stock. One way to identify a breakout is volume. While the triangle is forming, volume will slowly diminish. Without increased volume, it could be a false breakout. However, in addition to volume changes, there are other ways to identify a breakout, such as waiting for a certain amount of time. If the stock has risen for 3 straight days after the breakout, this could be considered a confirmation. Now that you know potential basic buy signals and how to identify a breakout, let's discuss how to determine potential sell signals. It's important to set a price target for the stock. Traders may use 2 methods to estimate the minimum price projection or price target. The first method is to measure the height of the triangle's base and add it to the value at the triangle's apex. Second, use a parallel trend line to set the target. This is done by tracing a line parallel to the support level, starting at the first contact point of the triangle at resistance. This parallel line marks the potential price target. Keep in mind that in many cases, the breakout may continue in the same direction as the trend preceding the triangle. This means that a previously uptrending stock may continue moving upward, and a downtrending stock may continue moving downward. Though this is a typical market reaction, it isn't a rule. That's why many traders think it's important to wait until the breakout is identified before making any investing decisions. When you set a price target, many traders use a stop loss to help protect against setbacks. Setting a stop loss can help reduce your losses if the stock breaks in an unexpected direction or if the breakout proves to be false. While there is no guarantee of success, being able to use price patterns to identify potential buy and sell signals can help improve your trading strategies.
Hello traders! In today's video, I will give an introduction to our ThinkScript programming language on thinkorswim. We'll discuss what ThinkScript is and how it can be used, the resources available to our ThinkScript users, and even demonstrate how to alter and create an indicator with ThinkScript. ThinkScript is a built-in programming language on the thinkorswim platform that gives you the ability to create your own analysis tools such as studies, watch list columns, alerts, scan queries, and even conditional orders. Through ThinkScript, you gain complete control of the analytical power of the thinkorswim platform. In this video, I'll demonstrate how to create our very own indicator using ThinkScript, in addition to using ThinkScript to further customize some of the existing indicators within thinkorswim. Now, before I show you how to actually build your own indicator, I'm going to first show you how to view the code for one of the pre-built indicators within thinkorswim so we can take a look at what ThinkScript looks like. From a thinkorswim chart, if we open up the Edit Studies and Strategies window, we'll see a list of all of those existing pre-built indicators. And you'll notice to the left of each one, there's a small scroll icon. And if we just click on that, it'll open up our ThinkScript editor. Here I've opened it up for the ATR or Average True Range study. You'll see the name at the top, and then in the body of the editor, the actual ThinkScript used. And one of the first things I hope you notice is that even without knowing all of the ins and outs of ThinkScript, we can certainly infer how this ThinkScript is working. We see a declare lower statement, which tells me the ATR study should plot below the price subgraph. We see inputs for length, an average type that we'd like to use in our calculation, a plot statement for the ATR, including that average and length that we talked about before, and then we see a set default color statement to customize that look and feel of the ATR as it shows. This same method can be used to look at any of the pre-built indicators, to take a look at how the ThinkScript works, and even copy and paste it into your own codes as we get into later. Now, to create our very first indicator, I'd like to start with something simple that already exists in the platform, just so we can dip our toes in how this works. A simple moving average. So to get started, in the lower left, I'll hit Create, which will open up a fresh ThinkScript editor window for us. And we'll see its input New Study 0 as the name, since we don't have any new studies in the platform just yet. I'll go ahead and change that to My Moving Average. And it's put a line in here for us, plot data equals close. We can backspace this out to have a clean slate. And anytime we create a fresh ThinkScript, it'll always have that first line in there. So just keep in mind, you might need to backspace that out. Now, when we're creating any type of new indicator, I usually try to first think of what data I need for my indicator, what I'd like to do with that data, and then how I'd like to display the results. So first, let's begin defining a variable and bringing our data in. For our moving average, we need to bring in the last price or the close. So I'll define a variable, last price. Last price I'll define as close. And since we're saying the close of each bar, this is on a daily chart. So this would mean a daily close. And you'll see I've ended that with a semicolon. In ThinkScript, all of our statements have to end with a semicolon. And if we ever forget it, you'll notice that this entire line highlights it in red, and we see an invalid statement error at the bottom. So if you ever notice that, just make sure we end with a semicolon. I'll clear it right up. Now we need to create our average calculation. So I'll create a new variable, my average. And we need to use the average function to do some math for us here. So if I start typing, you'll see it'll pre-fill some of the possible solutions. And the very first one is average. Now, if I'm not quite sure exactly what parameters are available to use in average, if we just click on it, you'll see we have an inspector tool on the right. Wherever your cursor is, that inspector tool will let us know what types of parameters are available to us and what we can change. In the case of average, this function has two parameters, the data that we're averaging and the length of that average. Now, we've already brought in the last price, so I'll go ahead and put that last price in as the data that we're averaging. And I'll set the length to 30, since a 30-period simple moving average is fairly common. We just separate those parameters with a comma, and you can also edit that within that inspector tool as well. So if I'd ever like that length to say 20 instead of 30, I can just type 20, press enter, and you see it updates right away in the ThinkScript editor. For now, we'll stick with 30. Now I need to plot this information. Right now we've only defined it, but we haven't actually plotted any of it. So let's write a plot statement. We'll call it myLine, and myLine will equal that myAverage calculation that we just wrote together. We'll end once more with a semicolon, and if we hit OK, you'll see that my moving average is now shown in the current studies and strategies on my chart. If I hit apply, You'll see right in the background, we have our very own simple moving average that's now been added to our chart. Now that was simple, but I think most of us know that the simple moving average is one of those pre-built indicators that comes with thinkorswim. So let's create something that isn't necessarily on here just yet, and something that'll help me with some of my own day-to-day account management, make things a little bit easier. What I'd like to do is create a new study, so I'll click that create button, and this one I'd like to be an indicator of some percent change information. I'd like to have right at my fingertips percent changes over different periods of time, so I can see details like the percent change today, over a year, and maybe even over a month as well. So let's start this from scratch just like we did with that simple moving average. We'll delete our plot data equals close line that populated for us, and we'll give it a fresh name that we'll call percent change labels. Now, to begin defining our first variable, and this one we'll have to do just a little bit more math to create a percent change. So I'll define a variable using def, and then put percent change. And percent change will need to equal the close divided by the previous close. And to define previous close, I'll put the number 1 in brackets, which means to look back one period. So we've got the current close and then the close from 1 bar ago. And since we're on a daily chart, that would mean current close and the close of yesterday's bar. If we just subtract 1 from that and put a semicolon, we now have a percent change calculation that we can begin to work with. Now, as I mentioned, I would not like for this one to be a line like the simple moving average. What I'm hoping for is that I have a label, just some quick data that I can reference. So I'll use the add label function. I'm going to let our inspector help us out once more with this, so we can recall exactly what parameters are available. So now that I've typed it with the open close parentheses, I will click on it, and you'll see the inspector updates to let me know that there are 3 parameters available to me. I have an input, whether it's visible, the text to show, and the color. Now we can definitely get complicated and add conditions for when this should show or not show, but for now I'll just keep it easy. I'd like this to be shown at all times, so I'll put yes. The text we've already created. We wrote percent change, and that's where I'd like it to show. We can keep the color red just to keep things easy for now. Now if I hit OK, so we can take a look at our work so far, we'll hit apply, and you'll see in the upper left I now have that label. But there's a couple things that I don't love about it. It's a decimal instead of a percent in format, and it doesn't really have any text that tells me what this information actually is. It's just the number. So let's make some tweaks. If I open up our add label command here one more time, we can use a couple functions to clean this up. The first one I'll use is as percent. If I use as percent and put our percent change variable within that, so the percent change variable becomes the parameter for the as percent function, I now, if I apply, have changed the formatting of my label to display this information as a percent. Now I'd like to add some text to inform me of what this is showing me. So I'll put in quotes, percent change, the colon, and I'm going to put a plus in between our text and the value that we have calculated to indicate that we'd like both of them. If I apply that, see I now have a percent change label that actually tells me what it is, and we have it displayed as a percentage format. So this is great. This is a good start, but the next thing I'd like is for this to show me aggregation periods that aren't what I currently have charted. Now, I mentioned this is currently on a daily chart, but if I'd like this information to give me a year percent change or a month percent change, we have to do one more thing. So let's take what we've already created. I'm going to copy it so we don't have to restart this from scratch. And even in the same ThinkScript editor, I'll paste that down below. Now, to make this next label, which will make a month percent change, first we see this error because I've used the variable percent change twice. We can't use the exact same variable twice, or define it twice, I should say. So we'll give it a new name, and we'll call it month percent change. Now, to make sure we're keeping things consistent, I'm also going to update the text so it actually says month percent change. And then I'll make sure that the variable that we reference will be month percent change below as well. Now the only other problem that we still have is that this is still the same calculation. This is still just close divided by close with an offset of 1. I need to specifically declare that this close is from the previous month. So you'll notice if I use the inspector once more, I can actually set the parameter for the close to be a particular period. So I'll change that to be a month period. You'll see that updates in my ThinkScript immediately. And if I hit apply, I'll move this to the side so we can see. We now have a second label. We have a month percent change, and we see it displayed as a percent, just like our first one, with the text key to help us out. Let's do one more of these, so we get a year. So we'll start out the same way, using that just the very first label we created. We'll adjust the variables, so we have a year percent change. We'll update our text key. And I'll update the variable below as well. Now, just like we did in the previous one, I'll need to update that close period to be the close of a year. And we now have 3 different add label statements, all in one ThinkScript. One is showing me the close divided by the previous close as our percent change. The other one is showing me a month percent change. And the final one we just wrote is a year percent change. Now, if I apply that and hit OK, we can see our final results here. We now have a total of 3 labels. One is that day percent change, since we're on a daily chart. We have a month percent change, and we have a year percent change, all at our fingertips. And you'll notice that if I were to change symbols, it'll update real time and easily give me that information nice and quick, so I don't have to spend quite so much time looking for it in the future. Now, I'd also like to show how to customize some of the existing indicators that are already within Thinkorswim. If I stick with this same theme of looking at percent change, we can find the default percent change study that exists in the platform. If I add this to my chart, you'll see that we get a line, and that line is showing us the percent change of the security over the defined number of periods, which is 14, and it's using closing prices. So in this case, because we're on a daily chart, this is showing me percent change information over 14 days. Now, one of the things that I'd like to point out is that if we look at the ways that we can adjust this study without ThinkScript, we still have plenty of inputs to customize this and make this our own. But let's say that I wanted this study to, instead of showing me 14 days percent change, I wanted it to just be today. And specifically, I wanted it to be today since market open. What's the percent change just since market open? Well, I run into some difficulties because I can't change this price to just be open. It would be open to open or close to close. I can't say to look at the current close or current price, last price, compared to market open. So let's take a look at the ThinkScript and see how this is actually working. I'm going to right click and use duplicate, which will give me a fresh ThinkScript editor, but it will already have copied in the entire ThinkScript for that pre-built study for me, so we can start with the full thing. Now, as we look through this, there might look like there's a little bit more on here than we've looked at before, but the reality is we just have a few inputs that we're using for our calculations. We see the plot statement percent change, which is the one that we definitely want to focus on here, and then we see some various colors and customization below. So if we look at that plot percent change line, you'll see that really our problem is just this price variable. We're taking price divided by price with an offset of that length input. And so anytime I change price from close to open or vice versa, I'm changing both of them. I can't have one be closed and one be open. So we can make that change right here, right now. If I change that to plot percent change equals 100 times, and then in parentheses, price divided by open minus 1, if I apply this right now, you'll see I have both the original percent change and my very own percent change below. Now the original is still using that normal calculation, looking at 14 days percent change, whereas mine is simply looking at the current close compared to the same bars open. So since we're on a daily chart, today's open. So this is giving me the percent change since open, exactly like what I was hoping it would give me. And we can continue with these types of changes throughout many, many indicators, and we can even bring this same calculation back to the label that we wrote before if we would now like to have a price change since open label. I'll copy and paste this one last time, and we'll use exactly what we did in our percent change study. We're taking close divided by open. We'll call this the open percent change. So we have a new variable. Give it a fresh text label. And change the open percent change in our variables below as well. If we apply that and take a look, you'll see that now we have one final percent change label that says open percent change, and you'll see we got 0.56%. And down below we see the exact same value for our line. So now we have two different ways to give ourselves the exact same information, whichever we'd prefer. Now, the last thing I'd like to show you in this demonstration is one of the most valuable resources when you're learning ThinkScript, or even if you're an expert and you just need a reference, and that's our Learning Center. From the Education tab on the top, if you head to Learning Center, the home page you'll be met with has 4 tiles. And the tile on the far right is ThinkScript. This Learning Center page has everything from tutorials that are basic through advanced, to a full glossary of the functions, constraints, declarations, you name it, that are available to you in ThinkScript, along with examples of how to apply each one. Now we have shown how to use the ThinkScript editor, how to create a custom indicator with ThinkScript, and how to adjust an existing indicator. The possibilities with ThinkScript are endless, and I hope you feel encouraged to take advantage of this unique tool. To learn more, check out our other videos and resources, such as the Thinkorswim Learning Center.
A stock's price rarely moves in a linear path. Instead, it fluctuates up and down over time. However, when it repeatedly reaches a certain value, then reverses direction, it creates price levels called support and resistance. These levels are just one tool in technical analysis that you can use to become a more skilled trader. In this video, we'll discuss what support and resistance levels are, what causes these levels to occur, and how they can help identify buy and sell signals. Simply put, support and resistance are price levels that act as boundaries that a stock is bounced off more than once. Support is the level a stock tends to stay above. Think of it as the floor supporting the price. And resistance is the level a stock hits and comes back from. Resistance levels act as the ceiling for prices. Support and resistance levels are confirmed when a stock's price bounces off a certain value more than once. The more times this happens, the stronger the level is. You might wonder what causes support and resistance to occur. There are several reasons. When a stock price falls back to a previous low, investors might be more interested in buying. They're looking for a good price in hopes of buying low and selling high. Likewise, when a stock's price approaches a previous high, investors might be more interested in selling and taking their profits. Another reason support and resistance levels exist is that money managers often have common price targets. This means it's common for a lot of stocks to be bought at a certain price and sold at another predetermined price. Now that we know what causes support and resistance, let's learn how these levels can possibly help you make decisions when trading. When the price hits a support or resistance level and then reverses direction, it's called a bounce. Therefore, when technicians see the price of a stock nearing support levels, it might be time for them to buy. The more solid the support level is, the more confidence technicians might have it could bounce back up. On the other hand, if the price reaches resistance levels, some technicians may think it might be time to sell. However, support and resistance levels aren't hard stops for prices. When a stock moves beyond previous limits, it's called a breakout. If an upward trending stock breaks resistance, the old resistance level often becomes the new support level. After a breakout, technicians may see this as a good place to buy, believing the stock will rally and climb. Depending on investors and if they're bearish or bullish, support and resistance levels can be used in different ways. An investor looking to build a position might watch support levels for buy signals, hoping the stock will rally and break through resistance. An investor looking to close a position might watch resistance levels for sell signals. How you use support and resistance levels as buy and sell signals depends on the type of investor you are. For example, very active investors, like swing traders, use these levels to buy and sell often, possibly even in the same day. Less active trend traders can simply use breakouts to confirm a trend's direction. Support and resistance are basic concepts of technical analysis. Some investors are comfortable making trading decisions using only support and resistance, while others prefer coupling it with other technical analysis tools and techniques. Understanding support and resistance makes you better equipped to make sense of the market, no matter which way it's trending.
The stochastic indicator is a technical analysis tool that helps traders see when a stock might change direction. The stochastic measures a stock's momentum, or how quickly its price is changing, and charts it in a range to identify extreme values. These extreme values are called reversal zones and may suggest that a security is overbought or oversold. That could mean the stock is ready to reverse direction, which could be a bullish or bearish signal. I'll show you how to set up and use the stochastic indicator on the thinkorswim desktop platform. Let's begin by adding the indicator to a chart. I'm going to pull up Microsoft, then I'll go to the Studies menu and choose the stochastic. Notice that there are a few to choose from. You can go to the Thinkorswim Learning Center to learn more about these versions. Today, we're going to focus on the stochastic full indicator because it's more general. There are two lines that make up the stochastic indicator, %K in red and %D in pink. A point on the %K line is calculated by comparing the recent closing price to its range over the last 10 days. The %D is the more important line because it's the signal line. The %D line is a 3-day simple moving average of the %K line, which is why it's less volatile. The stochastic is charted on a scale of 0 to 100. The reversal zones are at 80 and 20. When the signal line is above 80, it suggests that the security is overbought, meaning that the price has risen to a point that it could drop. When it's below 20, the security is oversold, suggesting the price may rally. Despite these definitions, a stock can remain overbought or oversold for a long time. Back in 2024, Palantir traded in or near the overbought zone from September to December, while Kohl's was in the lower reversal zone much of November through January. Like most oscillators, the stochastic tends to do best when the security is in a sideways trend. Let's go back to Microsoft. There are a number of ways to trade the stochastic. We're just going to focus on a couple. A bullish signal occurs when the signal line moves above 20. We see on the chart that the stochastic was oversold 4 times. Each time it moved back out of the oversold area, it could have been a buy signal. A bearish signal occurs when the signal line moves below 80. The signal line was in the overbought area 4 times. Each time it fell out of the overbought zone, a trader might consider it a bearish signal. One hypothetical trade could have happened on October 16th. The signal line crossed above 20, and a trader could have bought shares around $416. Then they could have exited the trade on December 23rd at approximately $435. Like other oscillators, the stochastic won't get you out at the very top or bottom. But not every signal develops. Look at ConAgra, which had a bullish signal on November 27th. However, if a trader took that signal, it could have resulted in a loss because the sideways trade broke down. Another common signal is a hinge. Hinges can be effective with stocks that are trending up or down, but they're more subjective. A hinge occurs when the signal line changes direction between the reversal zones. For example, Oklow's stochastic turned lower the first part of January. However, later that month it turned higher, creating a hinge that preceded a bullish rally. Some traders only trade bullish hinges on bullish stocks and bearish hinges on bearish stocks. Of course, not every hinge signal works out. Graham Corporation experienced back-to-back hinges. The stock started higher, but the rally failed after a disappointing earnings report. To help confirm signals, many traders try to pair the stochastic with another indicator, like candlestick patterns or a moving average. For example, adding a 10-day simple moving average may have helped to confirm potential buy and sell signals on Deere. In October, the stochastic gave a bullish hinge, but the price failed to move away from the moving average. However, the second hinge in November saw a stronger break above the moving average that coincided with the stochastic signal. These pairings should be part of a broader trading plan where you determine when to buy and sell and how many shares you'll trade. A plan can be vital to a technician's success. Also, consider testing the stochastic signals in paper money as you learn the ins and outs of this indicator.
Hi, I'm David Bruner. I'm on the trade desk here at Charles Schwab, and today we're going to be taking a look in Thinkorswim, specifically how to customize your charts. Some common questions that we get on these charts is, first off, how do we remove this volume subgraph on the bottom? How do we remove these corporate actions, these different lines in the background such as the grid, and how do we change the appearance of our candlesticks? So we're going to take a look at all this within our chart settings. So we're going to start by going to the settings gear on the top, and going to our equities header, and unchecking show volume subgraph, unchecking show corporate actions, and as we go through these, at the end we're going to apply and show you how everything looks together. Next, we're going to switch to our appearance header, and this is where you can go in and really customize those candlesticks. So you can see here the border up, the border down color, if you would like the candles filled in or not. Also, that grid that I mentioned is right on the bottom here. If you like having that a little bit of a cleaner look, having that grid taken off, you can do that on the bottom there. Then we're going to jump into our time axis section. A few things here. We're going to check keep time zoom, which I'll explain in detail a little bit later. We're going to include an expansion area. As you can see on the right side of our chart, there's really no wiggle room here. The candlestick is pushed all the way up onto the right, so we want to add a little bit of space there. So let's just say, for example, we have these different preset ones, but I want to go in and type in specifically what I want, so we're going to do 25 bars. And then these lines as well, that I mentioned, these expiration lines, we can uncheck those, make our chart a little bit cleaner. So let's apply these settings, go back to our chart and see how everything looks. So we're going to click on apply and OK. So now we have a much cleaner and more minimalist chart, but really this is personal preference, so play around with it, see what settings work best for you. So now that we've customized our charts, we're going to look at a few more features that are going to be relevant when you're doing your trading on Thinkorswim. So we're going to go back into our settings gear, and this feature down here is called My Tools. Let's put it on each chart and apply. And so what this is going to do, it's essentially going to be shortcut buttons for us, which we can then pin. See how that was going away? If we just click on that pin, it's going to keep it on the top for us no matter where we put our cursor. And we're going to have buttons that we can customize here by clicking on this gear. And we can see in our My Tools section, these are the different preset buttons, which we can go in and customize. So let's say we want, instead of a trend line, we want to change it to a different drawing tool, and we prefer the price level. We can put that here. Let's say, for example, instead of our text note, we want to have a study that is quickly accessible. So we can go in here, and let's pick our daily high-low. Simple moving average is another study, and let's say we wanted to add another button. You can go on the bottom, left click, and you have that same set of options where, let's say we wanted to go in our time frame section and add a 5-day, 5-minute. We'll click on done, and we can see these buttons have changed here. For example, right now we're on the daily chart. We want to switch to a 5-minute chart. We click there, and we switch. So let's talk about zooming, and I'll show you that keep time zoom feature. So we're going to go in here, we're still looking at forward, and we're on our 5-minute chart. And the way to zoom in on the platform, well, there's two ways which I'll show you, but the most precise is going to be if you left click and you hold down and you drag, you're going to see it's a different color there, which is going to be the space that you're going to zoom in on. So you're going to go as far as you want, and then when you let go, that's what you're going to be zoomed in on. So that's one way to do it. Another way is going to be on the bottom of the screen if you prefer using the magnifying glasses. That's another but less precise way. So let me show you this keep time zoom feature. So right now we're zoomed in on this forward 5-minute chart, and we have our keep time zoom selected now. And if we switch over to Disney, we're gonna see it keeps it in that zoom. Let me show you, for example, if we uncheck that, and then we switch back to Ford, it takes away our time zoom and brings us back to the standard zoom. Also, one cool trick, if you are zoomed in on the platform, an easy way to get back to the normal view is just by double-clicking anywhere on the chart, and that brings you back to your normal view. So now we're gonna look at adding studies to your platform. You can see here, there's a studies beaker, which if you click on and you go to add study or quick studies, there's gonna be a lot of options with different categories where if you're not sure which study you're looking for, it might be good to browse those categories. But if you wanna be a little bit more specific, you can click on this beaker here, which is gonna bring you to our edit studies window. And same thing, you can browse through all these different studies. There is a lot on here, but if there's one that you know what you're looking for, so for example, let's type in simple, and we can add a couple simple moving averages. And just to get a few more on here, for example, let's put in the Bollinger Bands, and let's get something in our lower section, so we can put in RSI as well. And what I'm doing to add these, you can either double click on the study that you'd like to add, or you can click it once to highlight it, click on add selected, and it will bring it over to the right side. This is where you can go in with these gears and you can be more specific. So let's say instead of a 9 period, which is the default for our simple moving average, we want to change it to a 50. That's where we can just click on the settings gear, go into our length and change that. But there's a cool feature here that's been added to thinkorswim recently. First, let's apply these studies. So we can see we got all those on the chart now, but let's say we didn't want to have to delete studies when we were done with them, add them back. This new feature which was added, there's a little eyeball here. If you click on the eyeball, you see there's going to be a line through it, which means that it's going to temporarily hide those studies. So if we do that, click apply, now we can see we're back to our normal chart without those studies in it. One last thing I want to leave you with is going to be the color link. So we can see here we have a watch list set up with a yellow 2. These are our different options because this is very useful in a lot of different parts of the platform. So right now we have our yellow 2. This is currently a red 1. So if we go up here and we also change this to a yellow 2, rather than having to go in and type in every symbol that we're looking at, we can just go here, left click on the symbol that we would like to see on our watch list, and because these two are linked, it's very quickly switching our symbol on our chart. Today we took a look at a few ways to customize our thinkorswim charts. To learn more about thinkorswim, subscribe to our YouTube channel and go to schwab.com/learn. Thanks for watching.
So you've created a trading strategy and optimized your indicators, but you're having trouble finding stocks that go with it. Sometimes finding uptrending stocks is harder than you think. Here are a mix of ways to find uptrending stocks for a bullish trading strategy using the Scan tab on the thinkorswim desktop trading platform. Hi, my name is Kiara. I'm on the trade desk here at Charles Schwab. So before creating any scan, consider using tools to avoid thinly traded and penny stocks. I'll add a stock filter for stocks above $4 per share. I'll add a filter by selecting Add Filter and clicking Stock. I'll change it to the close price and add a minimum of $4. Next, I'll add a study filter. Click Volume and add Average Volume. I'll change it to the last 50 periods and greater than 1 million shares minimum. Okay, there are some commonly used indicators for identifying a trend. One of these is a moving average. In fact, you may already have a moving average in the system you want to use. So let's say, as an example, we plan to trade the intermediate term using 50-day. I'll add it to the scan. The stock doesn't need to be 10% above the moving average, so I'll change it to 2% because if the price is well above the moving average, we may need to wait for it to retrace before we get an entry point. Now I'll change it to match the moving average I want, a 50-period simple average. If the price is trading above the 50-day moving average, it's more likely to be uptrending. However, that's not always correct, so we'll add another filter. The next thing we can do is look for stocks that are making new highs. A bullish trend is commonly defined as a price making new highs and lows. Stocks that are near their 52-week highs are more likely to be uptrending as well. We can scan for those. The default current price is 3% of the 252 period, which is about the average number of trading days in 52 weeks, which is a year. You may consider increasing the percentage to 5% to include stocks that may be a little more volatile and subject to higher swings. Let's run a scan with these filters and see what we get. Okay, for my search results, I'm going to select AEP in this example and paste it in my charts. Here's what we wanted to see. We notice here that the AEP stock had their 52-week high. Right now, the stock is trending upward back to that 52-week high and above the 50-day moving average. So what if you want to find new trends that may be emerging? You can try this technique. I'm going to switch out the near high lows for a price change. In fact, I'm going to add 2 of them. The first one, I'm going to change to at least 5% greater than 30 bars ago. On a daily chart, this is 30 trading days. This will help find those stocks that have had a recent surge. The second one I'll change to 5% less than 252 bars ago, so I can find stocks that may be moving sideways or might be recovering from a downtrend. Let's take a look at some of the results. All right, so out of this list here, I want to take a look at Celsius. So I'm going to paste this in my chart. Here we see that Celsius was downtrending the first part of the year, then it flattened out. In February, the stock broke above the 50-day moving average, which is pointing higher. So this could be the start of a new uptrend. We use the moving average and the near highs to find uptrending stocks. And then we use price change to find stocks that might be emerging. If you've already created scans for your trading system, adding these trending filters can help you find potential candidates that are near to your entry signals. If you trade with stock charts, you're used to seeing volume at the bottom showing you when shares are traded. Volume profile is a technical indicator that shows you where or at what price volume occurred. It's like taking the volume indicator off the x-axis and putting it on the y-axis, letting you directly see how volume matches up with price. Analyzing patterns in these areas of supply and demand can help traders identify support, resistance, and potential buy and sell signals. I'm going to show you some of the ways traders find these signals for short-term stock trades using the thinkorswim desktop platform. Let's get started with an example of how to add the volume profile to a stock chart. First, I'm going to pull up a chart for United Health. This isn't a recommendation, just an example. In this video, we'll focus on short-term trading, so I'm going to change the chart to a 5-day, 5 minutes. Next, I'm going to add the indicator by clicking on the studies icon. While I'm here, I'm going to make some adjustments for short-term trading. I'm going to edit the study to get more data by focusing on the ticks. Then I'll create a volume profile for each day on the chart. Finally, we can overlap the profile with the price to get a different look at support and resistance. Now hang with me while I pull up the day I want to use for the example. I'll click on the thinkorswim platform on-demand feature that allows us to see a previous market day as if it was real time. I'll change the date to January 17th, 2025 at 10:45 a.m. I'll zoom in by going to a 1-day, 1-minute chart. We're finally set up. So let's break down the indicator. Each bar is called a node, and it tells you the number of trades taken at certain price intervals over the trading period. We set up the chart so that these nodes are generated by overnight and day trading sessions. The nodes create patterns that can help investors identify what types of trades to make. UNH is a symmetrical pattern because the bars have similar length and spacing above and below the red line. The red line is the point of control, or POC, which is the fair value price. This isn't the same as what fundamental analysts call fair value, but it's the price that has the most volume, suggesting it's the price that the majority of traders think is the best price for that time. The shaded space above and below the POC and between the two yellow lines is known as the value area. The default in the thinkorswim platform includes 70% of the trades. The upper yellow line is the high value line. When price is up here, the stock may be considered overvalued, which can act as resistance. The low value line suggests price is undervalued and may act as support. UNH rallied on the open, which is where the shading changes at the vertical line. The price ran up to the upper value line around 520 and appeared to bounce off resistance, which some traders see as a bearish signal. Traders expect the point of control to act as a magnet that pulls the price. When the price moves away from the POC, the expectation is that the price will eventually move back to it. Here's something to consider before we talk about our example trades. Many traders avoid the first hour of trading because it tends to be volatile as new orders pour in and are filled. Our example picks up about 75 minutes after the open. To take this hypothetical trade, we could short shares of UNH and set a target price at 515, which is the POC. The lower level of 508 could also be a target, although there's a lower likelihood of the price hitting it. We may also consider an exit above the high value point as a way to cut losses if the stock rallied. I'll move the time up an hour. UNH went the wrong way by rising to 521.85. A trader may close the trade here for a loss depending on their trading plan. Notice that POC is $3 higher at 518. It's important to remember that as the trading goes on, the POC and value areas will shift. However, that doesn't necessarily mean you have to change your targets. Moving forward again, UNH fell to the original POC at 515, which is one potential exit signal. Skipping forward near the close, we see UNH didn't quite make it to the lower 508 target in that trading session, closing just below 511. So trading symmetrical pattern is all about waiting for price to go back to the average. Of course, there's no guarantee that the price will revert, which brings us to some other volume profile patterns. I'll go to Tesla for a trending pattern. Once again, this is not a recommendation. The stock rallied in pre-market trading on January 15, 2025, creating an uptrending P pattern. A bullish P pattern can occur when a stock rallies and then consolidates. The opposite is a bearish B pattern, where the stock may sell off and consolidate, making a small case B. If we were to enter a hypothetical trade, we might choose to buy after Tesla created a new higher low or after a breakout above the upper value line. For potential exits, we could expand the chart to 5-day, 5 minutes to see potential resistance lines. We could also put some kind of loss exit around the lower value line. Tesla rallied throughout the day, causing the POC and value areas to move higher as well. It also moved past resistance set a couple of days ago. However, if we didn't plan an exit, we may have given up the gains the next day when the price fell again. The volume profile allows you to identify the price where investors see value. There are other ways and patterns you can learn to trade. Consider practicing with the volume profile using the paper money feature on the Thinkorswim platform before adding your own money to the volume bars.
Hello traders, I'm Cotton Hensley from the Schwab Trade Desk. You've developed your trading plan and created your watch list, but you lack confidence in some of the signals that you're seeing. The unusual volume scan will help you confirm your entry signals by identifying stocks that are on the move due to strong volume. To make your life even easier, I'm going to show you how to set up your platform to scan your watch list automatically and alert you when a stock moves on volume. Okay, so we're in the platform now, and let's just go ahead and go over to the Charts tab. While we're in the Charts tab, we've got a few different selections here from our left sidebar. Now, as you can see on my chart, I'm currently using the RSI, or the Relative Strength Index. With this specific indicator, it's pretty popular. The idea is that if we have a specific price action that's going up above this top line, we're in overbought territory, meaning that with historical information, this stock generally doesn't trade this high, and when it does, we tend to see a downward motion. It's overbought, so it might reverse. The opposite is true for the bottom line. That's the oversold area. With historical information, this stock tends to come back up after it's approached its oversold area. So knowing that with the RSI, I can then look through all of my different stocks over here on the left sidebar. Now it's important to note that I'm just using the S&P 100 in this case. This might be a watch list that you like to use, that's your own personal watch list that you've developed before. But as I go through these stocks, I'm seeing quite a few stocks that are approaching their overbought section. That doesn't necessarily mean that we have a strong signal to buy or sell. We might just be having an up market. So in other words, I'm not confident in some of these signals. I may not want to get into this stock just because everything seems to be doing that. If I look at Visa, for example, I can see that it has just hit its overbought area. And when I look at the price action, I can see a couple of candles that are green, meaning that it's gone up the last 2 days. When I look at the volume, I can see there's not a lot of volume on this stock. So I'm kind of in the middle of the road when it comes to what decision I need to make. So what can we do in terms of making an additional confirmation signal to help us feel confident in our trade? So from here, let's go over to the Scan tab. We can use this tool to help figure out additional signals in the list that we've already pre-made. So with the S&P 100 being over here on the left, I can actually load that into the Scan tab up here at the top. So you'll notice that All Stocks is a section. We're currently scanning in All Stocks. And I've got a couple different categories I can choose. Now, if I go to categories, I can see All Stocks. If I go to a personal watch list, I can choose a watch list that I've made myself. Since we're using the S&P 100, I'm going to go to public S through W in this case and simply select that list. So with S&P 100 being loaded up, I want to use the unusual volume scan to help me figure out what stocks have unusual volume. After I delete my filters, I'm going to add in a study filter. What a study filter is, it's a scan of a chart. We're going to use the same study that we're using the chart and scan for movement on the market. I care about volume, and luckily we have a section here called volume already. When we go to volume, unusual volume is a scan that we can choose. When we select unusual volume, we can see a couple of presets that are already in here. My current volume has increased 20% from the typical average over 50 periods. What is a period? In this case, the increment's set to daily, so that means 50 days. So in other words, this scan is saying, find me stocks where the volume has increased 20% above the 50% typical volume average. If I wanted to be a bit more aggressive with that, I could type in 25. Since I already had the S&P 100 loaded into my list, I know that that's the only thing this scan is going to scan within. And once I click scan, I've got two results, UNH and Charter. So what do we do now? We've completed our scan, so we might want to just test these results and take a look at them. So I'm going to go back to charts, and I might look at UNH. And this is interesting because UNH is in oversold territory. It has completely dropped off, and if we just look at the volume, it's increased quite a bit. Our other option was Charter. And this was actually very similar to Visa earlier. We can see that it's approached the overbought section, and we've got an increase in price action, and our volume has once again increased. So if I'm looking at this stock, this might give me a little bit more confidence to say, well, there's a lot more going on here. Not only is the price action increasing, but I have an additional volume factor to consider to give me a better idea of the breadth of the market. Now, let's say that we liked that scan a lot. We can actually save that scan. I like my results. All it is the S&P 100 with unusual volume. So if I were to save this scan right now, I could go up to the top right-hand side and click the middle 3-line menu, and my results would be Save Scan Query. Once we click on that, we can give this an original name. I'm just going to call this S&P 100 Unusual Volume. You'll notice that my scan results disappeared. So if we go to Charts, I can actually load in that scan on the left sidebar. I'm looking at the S&P 100 now, but if I click on the current watch list and I go to my personal section, I can see that S&P 100 Unusual Volume with this pink symbol next to it to let me know that this is not just a regular watch list. It's a dynamic watch list. It's a watch list that will scan every 5 minutes. So if you like, it will constantly look at the S&P 100, and every 5 minutes it will scan for unusual volume again. And any results that pop up in here will change and refresh. So you can keep an eye on any of the stocks that pop in here. Now, I can take this a step further, and I can actually be alerted whenever more things have been added to this list. So if I go back to the Scan tab, and then I just click Scan to refresh my results, I have a 3-line menu down here on the right side, and whenever I select that, I can save as watch list, or I can alert when scan results change. Now, it's important to note that Save as Watch List is just a screenshot. It's not really a dynamic watch list or anything like that. It's just going to save these 2 stocks, and they won't change, and it won't scan for you. So in this case, what I kind of talked about was the alert when scan results change, and we have an additional menu that we can choose. Just alert me whenever a symbol is added. Now, we're not going to use this example, but I also have the ability to use a symbol is removed. So if I want to be alerted when one of these symbols has changed, then I can do that too. Or I could also say a symbol is added or removed. Now, you'll probably guess that you're going to get a lot of alerts from that because you're being alerted anytime something is added or removed. So just keep that in mind. We're going to stick with a symbol is added, and we can see it's scanning in S&P 100 Unusual Volume. We'll create that alert. And our alert has already gone off. So whenever we look at our alert menu, that's going to be located in the Market Watch tab. And we can click on the sub-tab Alerts. We'll see that our scan has been created. And we can see that it also says a symbol is added to scan results, letting us know that the alert is already set up and our status shows active. So with that in mind, now we've got a scan that we've created, a watch list over on the left, and if we need to step away from our computer or anything, then we have an alert set up to where it will ding in the platform to let us know that our scan results have changed, and possibly there are more stocks that we can take a look at from the S&P 100 that have unusual volume. Now, if I were done with this alert, all I would need to do is come over here to the right side of the alert menu, and I could click the cancel button. It will ask me, are you about to cancel all active alerts? I can click yes to confirm that. And that's how you would create a scan, in this case, on the S&P 100 for unusual volume. The unusual volume indicator can make your life a little easier by scanning your watch list for stocks with higher volume that may be confirming your other signals. Then use a dynamic watch list scan to send you alerts so you can complete the analysis. Try out the unusual volume indicator on your watch list to see what you think and set up the alerts, so you don't have to be tied to your computer all day.
When trading bull flags, it can be difficult to know where to draw the lines. Should it go here or here? Like most price patterns, bull flags are up to the eye of the beholder. I'm David Bruner here on the trade desk at Schwab. I'm going to show you a couple of indicators that can reduce the subjectivity of identifying the trend and the entry and exit signals. Today we're going to be looking at a bull flag trend, and we're going to be using our indicators such as the RSI and moving averages to help determine that bullish trend, as well as our entry and exit signals. Let's jump over to Thinkorswim. For our example, let's use Royal Gold, RGLD. Remember, this is just an example and not a recommendation. The combination of indicators hasn't been backtested, and there's no guarantee of profitability. The first indicator is a moving average to help identify the trend. Technicians usually start with the trend, and bull flags are traded on bullish or uptrending stocks. Identifying higher lows and higher highs is the subjective way to identify the trend, but in this example, we'll say we have an uptrend when the price is above the moving average and the line is pointing higher. So now let's add our first simple moving average. We'll go up to the beaker to open our studies, and I'm going to add the simple moving average here and click on the gear to change our length to 50 days and click apply and OK. Identifying an uptrend, even with the moving average, can still be a little subjective because many traders will want to know when exactly a moving average is pointing up versus a reaction to price noise. You'll have to decide for yourself how much is enough to say that it's bullish. For our example here, I'm going to say as long as it's neutral to up and the price is over the moving average, that will be enough for us. RGLD's 50-day moving average turned up around the first week of March. Technicians may argue what constitutes a flag pattern, but generally they are those downswings or pauses that take place in a trend before the price moves higher. Commonly, traders will draw a resistance line to identify the flag and create an entry signal when it's broken. Drawing the resistance line is also subjective, so we can use a shorter moving average to provide that signal. I'll add an 8-day moving average as the primary entry signal here. Consider going long when the price breaks above that 8-day average. No moving average will work for every stock. Some stocks may test a 5-day or a 10-day moving average for its upswings, but try a few for yourself and figure out what works best for you. An 8-day does split the difference between these moving averages, and some traders like an 8-day because it's a Fibonacci number, so let's use that today. So if we zoom in here, we can see that RGLD broke above that 8-day moving average back on April 9th. Next, the RSI will be our confirmation signal. The RSI, or Relative Strength Index, is an oscillator that tracks price momentum. When the RSI line is rising, the price has bullish momentum. On our chart, now we're going to add the RSI. When the price breaks above the 8-day moving average, we'll look for the RSI to come out of the lower reversal zone and create a hinge. A hinge occurs when the RSI line turns bullish between these reversal zones. Many technicians consider a hinge to be a good signal in uptrending stocks because it suggests stronger price momentum. So it looks like the bears weren't able to push the RSI line to the lower reversal zone, so the bulls appear to have the momentum. The RSI confirms our 8-day crossover signal with this bullish hinge. Let's say we bought the stock at the close for $164.74. Because swing trading often takes place in a tight window, a quick exit may be needed to maximize the gains. Therefore, we may choose to put this trade on a short leash. The exit we'll use here is to close when the price breaks below that 8-day moving average. We can still get back in if a new entry signal appears. We don't just have to treat this stock as a one and done event. Be careful though, depending on your broker and the type of vehicle you're using, this could result in higher trading costs. On April 22nd, the stock closed below that 8-day moving average. Let's say we sold on the close at $181.35. Moving averages and the RSI can be helpful tools to reducing uncertainty around trading signals. Feel free to mix these in with whatever else you're using when you're trading to complement your strategy. Experiment with these tools using paper money to find a mix that works for you.
Last week's meeting of the Federal Reserve may just have been the weirdest monetary policy meeting the central bank has ever held. 24 hours before it began, it wasn't even clear who was actually going to be at the meeting. the president's attempt to fire Fed Governor Lisa Cook was awaiting a court decision about whether she could continue to serve in her role while her legal challenge against the president unfolded. The night before the meeting started, an appeals court ruled that she could stay. At virtually the same time, the Senate was voting on whether to confirm Stephen Miron, the chair of the White House Council of Economic Advisors, to fill an empty seat on the 7-member Fed Board of Governors. He was confirmed by a single vote, 48 to 47, and took the oath of office just minutes before the Fed meeting began on September 16th. Cook and Miron both participated in the 2-day meeting at the Fed last week, which, to no one's surprise, culminated in the announcement that the Fed was lowering its baseline interest rate by 25 basis points, the first cut in 2025. The vote was 11-1, with Miron dissenting, favoring instead a 50 basis point cut. In his press conference following the meeting, Fed Chair Jerome Powell talked about the dilemma the Fed is in as it tries to manage two competing problems: a softening job market and inflation that is inching upwards. He said there is no risk-free path forward when it comes to interest rates. But the intensity around this meeting went deeper than just a tricky monetary policy decision. The real issue that has longtime Fed watchers, financial analysts, institutional investors, and just about everyone who watches the markets concerned is the Fed's independence itself. No president has ever tried to fire a Fed governor until now. No Fed governor has ever simultaneously held a White House position until now. Every Fed move for the remainder of the year will be under unprecedented scrutiny. For fixed income investors already anxious about the economy, inflation, runaway government spending, the national debt, and more, turmoil at the Fed is another worry. How should investors navigate all of this uncertainty? Welcome to Washington Wise, a podcast for investors from Charles Schwab. I'm your host, Mike Townsend, and on this show, our goal is to cut through the noise and confusion of the nation's capital and help investors figure out what's really worth paying attention to. After last week's Fed meeting, there is a lot to sort through. And that's why I'm so glad that Kathy Jones agreed to join me on the podcast this week. Kathy is Schwab's chief fixed income strategist and someone I trust more than just about anyone I know to have a good read on the Fed and a thoughtful take on what matters to the bond market. That conversation is coming up in just a few minutes. Before we jump into that discussion, I want to share a couple of other things that I'm watching right now in Washington. First up, we're now less than a week from a government shutdown, and Congress seems to be a long way from resolving the standoff. Congress is not even in Washington discussing how to resolve the standoff. There are a lot of moving parts here, so here's a quick update on the state of play. Regular listeners of the show know the drill by now. Congress is supposed to pass the 12 appropriations bills that fund every federal agency and program by the start of the government's fiscal year on October 1st. This year, Congress hasn't passed any of the bills yet, with less than a week to go until a potential shutdown. Both the House and the Senate have passed 3 of the 12 bills, the ones focusing on agriculture, military construction and veterans affairs, and the legislative branch. And the 2 chambers have agreed to meet in a conference to hash out the differences on those bills. Now, that's actually a positive sign. It's the way legislation is supposed to work. The House passes a bill, the Senate makes some changes and passes the bill, and then the 2 chambers meet to combine the bills into one final version that both chambers can agree on. Those discussions are ongoing, and both sides have said that they've been productive and cordial. So it's at least a sign that the regular appropriations process can still function. But even if a compromise emerges from that effort, it only covers 3 of the least controversial of the 12 bills. So attention is focused on a short-term fix to avoid a shutdown. Last week, the House approved a temporary extension of funding known as a continuing resolution, which would keep the government open and operating until November 21st. The Republican plan also includes nearly $90 million in additional security funding for all 3 branches of government in the wake of the Charlie Kirk shooting. That plan passed the House by a single vote, 214 to 213. But when it went to the Senate, it failed to get anywhere near the necessary supermajority of 60 votes. Also failing was a Democrat-authored alternative proposal that would have included several healthcare items and also language to prevent President Trump from clawing back funds that Congress approves. Both the House and Senate are in recess this week for the Rosh Hashanah holiday. The Senate is scheduled to return on September 29th, when they will have about 36 hours left before a shutdown. The House of Representatives is not scheduled to return to Washington until after the October 1st deadline. Democrats have appealed directly to President Trump for a bipartisan meeting to try to hash out a compromise. The president first agreed to such a meeting, then said the meeting was off, and things may change again as we get closer to the deadline. But as of right now, the chances of a shutdown next week seem very high. If that happens, the question then becomes, how do the two parties get out of a shutdown? Senate Democrats are particularly concerned about the fact that enhanced subsidies that help people buy health insurance through the Affordable Care Act are set to expire at the end of the year. Even some Republicans don't want to see those expire. And Democrats are arguing, since the open enrollment window to make health insurance purchases or changes for next year starts on November 1st, dealing with the issue in late November or December is just too late. They want an extension of the enhanced subsidies to be attached to the continuing resolution. Republicans want to deal with that issue separately, but that would likely mean not addressing it until after the enrollment window opens. Government shutdowns are inherently unpredictable. The administration gets to designate who's an essential employee and must show up for work without pay until decisions are finalized, thereby deciding which government services will continue to be provided and which will not. TSA agents at the airport, for example, are certain to be designated as essential so as not to disrupt air travel. But national parks are typically closed during shutdowns. It's just not certain yet how this administration will handle a shutdown if it happens. And ending a shutdown typically is decided by which party blinks first, and that's tied to which party is getting most of the blame for the shutdown. If one happens next week, and it is looking increasingly likely, there's a lot of uncertainty about how it will play out and how long it will last. As I've said before, government shutdowns historically have not been big market movers at all. But given other uncertainties in the broader economy, it's possible a prolonged shutdown could have a negative effect on the markets this time around. The other issue I'm watching right now is something I think is going to be really important for investors to follow in the months ahead. Last week, the president used a social media post to float the idea of ending the requirement that companies report their earnings each quarter and instead move to semi-annual reporting. He argued that it would save money and would help companies focus on the longer-term growth of their company while being less focused on meeting short-term goals. A few days later, the Trump-appointed SEC chairman, Paul Atkins, said in an interview that he supports the plan, that he's talked to the president about it, and that he expects the SEC to propose a rule making the change in the coming months. Notably, he also made it clear that he expects any rule would leave it up to companies to decide whether to report quarterly or semi-annually. For the sake of shareholders and public companies, the market can decide what the proper cadence is, Atkins told CNBC. I think this is going to be a fascinating issue to watch. The SEC has required quarterly reporting since 1970. President Trump brought the issue up during his first term, and in 2018, the SEC requested public comment on the idea, but it never went anywhere after that. Semi-annual reporting is used in other countries, like France, the United Kingdom, and Australia, though quarterly reporting remains the standard in most major economies. Any proposed change this time around will require the usual rulemaking process, including time for public comment on the proposal, so it could take several months at a minimum for it to get changed. Companies have long complained about the burden of quarterly reporting requirements, and some investors have complained that the cycle forces company executives to focus on hitting artificial short-term targets rather than building for the longer term. Opponents of this idea argue that it will just mean less transparency for investors into what's going on in a company, and that less transparency will lead to increased market volatility. SEC Chairman Atkins said last week that it's a good time to look at the whole panoply of ways that people get information and how it's disseminated. He has already signaled that he plans to push forward with reducing or eliminating corporate disclosures on things like executive compensation, climate risk, and conflict minerals. But quarterly reporting requirements fall into a different bucket. Even if the SEC changes the rules, it appears likely to make it optional, and it's hard to imagine investors and shareholders in most public companies being comfortable with less frequent information. It's clear this is an issue on a fast track. It moved from a presidential social media post to a plan for rulemaking in less than a week. I'll be keeping a close eye on this one going forward. On my deeper dive today, I want to focus on last week's remarkable Fed meeting and its implications for the economy and fixed income investors. To do that, there's no one better than my colleague Kathy Jones, Chief Fixed Income Strategist here at Schwab. Kathy's also co-host of our sister podcast, On Investing, a weekly show where she and Liz Ann Saunders, Schwab's Chief Investment Strategist, discuss what's been going on in the markets and the economy. Kathy, welcome back to Washington Wise. Thanks so much for making the time to join me today.
Great to be with you, Mike. Thanks for having me.
Kathy, let's start with last week's Fed meeting, which was full of drama for a variety of reasons, and we'll get into some of them in a minute. But the actual monetary policy decision to cut the Fed funds rate by 25 basis points, not that surprising. In his press conference, Chair Jerome Powell called the move a risk management cut. How did you interpret that?
My take is that Fed Chair Powell was referring to trying to manage the risk of a rise in unemployment versus the risk of rising inflation. The Fed has been focused over the past year primarily on setting policy to pull down inflation. But with the recent big downward revisions to the jobs data, the Fed's starting to turn its focus to the labor market. As you know, Mike, the Fed has a dual mandate to set policy for 2% inflation over the long run and for full employment. And right now, those two mandates are in tension. Inflation is stuck near 3%, looks like it's edging a little bit higher, while the labor market is softening. So the Fed is trying to adjust policy to both realities. By cutting rates, even though inflation is above target, it's hoping to forestall a further deterioration in the job market. Now, I will note that Fed Chair Powell also said there is no risk-free path for monetary policy. The Fed's quite aware that they're trying to fine-tune the policy to balance these opposing forces. But if they move too far in one direction, they run the risk of missing in the other direction by a wide margin. So it's not an easy position to find oneself in.
You know, Kathy, it was perhaps a minor surprise that the vote was 11-1 in favor of the 25 basis point cut. Only one dissenting vote, and that was from the newest governor, Stephen Miron, who was literally sworn into office right before the meeting started. We'll come back to him in just a minute. But going into the meeting, there was some thought that there might be additional dissents. So Chair Powell seemed to do a pretty good job of holding most everyone together. However, there is a wide range of views within the Fed on where things should go from here and how quickly. The projections in the so-called dot plot showed that at least one FOMC member thinks rates could go higher, and another thinks we should have massive cuts right away. Even Powell said it's not incredibly obvious what to do. So is this just part of a healthy debate at the Fed? It feels like the Fed is really struggling with the situation. Of course, they're no strangers to rough patches, but what do you think is causing them so much angst this time?
I think you're right, Mike, that it is part of the healthy debate that takes place at the Fed. Despite the near consensus voting record over the last 10 years or so, there are really diverse views at the Fed. Each regional bank president reflects the views of their region, where you can imagine the conditions in the Kansas City region, where the agricultural sector is currently under a lot of stress, are different than those in Boston, where the strength in the tech sector and in finance is keeping the region's growth rate healthy. These two regional presidents may end up voting for the same policy, but they have different ways of getting to their conclusions. In general, monetary policy in major countries is more effective in influencing demand than supply. And I think that's one of the struggles they're having right now. And it's one reason that Powell said there's no clear path from here. Because right now we have an economy that continues to grow, but in a lopsided way, with upper-end consumers as the driving force. The unemployment rate is still low, but job growth is really weak. And meanwhile, inflation is pushing higher, largely due to tariffs. So on both sides of the equation or the mandate, the problem the Fed is facing is largely supply-driven. Part of the slowdown in the labor market has to do with immigration restrictions that are reducing the supply of labor. The story is similar with inflation. Some goods are simply not coming into the U.S. because companies can't or won't pay the import tax. And if they do pay the tariff, they try to pass it on to consumers, and that adds to price pressures. So either way, supplies are being constrained, and the Fed has no influence over supply issues. So it's making the job really tough right now.
Yeah, we talk all the time about the Fed's dual mandate, and they certainly seem to be worried, at least at the moment, more about the labor market than about inflation. And I think that's because it wants to get ahead of this problem with jobs, because that can be so hard to turn around once it really starts going in the wrong direction. But as we've been discussing, there are these big divisions, even among Fed officials, on whether that's the appropriate focus. What if they get this wrong? So a two-part question for you. What are the implications for the economy of prioritizing jobs over inflation? And if they realize they're on the wrong path, how quickly can they reverse course?
I think the implication of focusing on jobs over inflation, or the risk around it, is it could end up with the economy running too hot, driving up wages and demand, and resulting in even more inflation. And that would be a problem, as it would imply that the Fed would have to then reverse course and hike rates rather aggressively to counteract the inflation it just created. It would also likely raise inflation expectations, which the Fed tries to manage because the expectation of inflation can actually be self-fulfilling. So, for example, if you think prices are going to go up next month, you might run out and buy whatever that thing is you're looking for today. If everyone does that, then the price will go up because demand is strong. We used to refer to it as too much money chasing too few goods. Also, after being late to the game in addressing the pandemic inflation, I would think the Fed would be very cautious this time around. Now, on the second part of the question, yeah, the Fed can reverse course very quickly. It has in the past, as we saw coming out of the pandemic when prices rose quickly because demand was outstripping supply. But it's disruptive, and it can hurt companies and consumers in the short run that had planned for lower costs, and then they find that costs for financing have driven up for business inventories and operations, and the costs for consumers are up, like credit cards, car loans, and mortgages.
Kathy, you and I have both been watching carefully all the turmoil and uncertainty at the Fed over the last few weeks. As I mentioned, it was less than 24 hours before the meeting when Stephen Miron was confirmed and sworn in, and Fed Governor Lisa Cook, who President Trump is trying to fire, got a court order allowing her to remain in her role as a governor that same evening. In addition, of course, the president has been pressuring the Fed really all year to cut rates. I would have loved to be a fly on the wall at last week's meeting just to see the interpersonal dynamics that were going on in that room. But as a result of all this chaos, there has been a lot of talk about Fed independence. I do think there is real evidence that the president is aggressively trying to chip away at that. We have the fact that Stephen Miron is still technically a White House employee. He's chair of the White House Council of Economic Advisors. He's taking an unpaid leave of absence from that position rather than resigning. And there's never been a White House employee who simultaneously served on the Fed board. Then we have the firing of Lisa Cook. No president has ever tried to fire a Fed governor before. Her case will almost certainly end up before the Supreme Court. And one of the reasons that the stakes are so high is that if she loses and the president can fire her, he can nominate someone else, and then he will have named a majority of the board members, 4 out of 7. To take this one step further, in February of 2026, the board needs to confirm the presidents of the 12 regional banks, 4 of whom are voting members on the FOMC on a rotating basis. That confirmation, which happens once every 5 years, typically is quite routine. But there is a concern that a majority of the board could vote to fire some or all of the bank presidents, install individuals who are more loyal to President Trump, and then the president would have a voting majority on the FOMC to set rates. Now, granted, that's a lot of steps that need to happen. We are quite a long way from that happening. But when you play out potential concerns about Fed independence, that's a road that you can go down. So my question for you, how concerned are you about the Fed's independence, and what would be the potential fallout from something like the scenario I just laid out, both domestically and abroad?
Well, it is something that's become a much bigger concern recently. The administration has been quite outspoken and aggressive about wanting the Fed to pursue a different policy and cut interest rates sharply. And as you say, there is, at least in theory, a path for the administration to appoint people with views that are not independent. The public, or at least people like me who follow monetary policy closely, want to see Fed officials are acting more like guardians or watchdogs of the financial system and of the economy. The hope is that they're maybe more technocrats than politicians. There are times when they have to make unpopular decisions for the good of the overall economy, and you want them to be independent. I worry that even the appearance of heavy influence by the administration to push interest rates lower could weaken confidence in the Fed. In practice, the worst case scenario would be something like we've seen over the past few years in Turkey, where the president of the country took control of the central bank, installed a relative to do his bidding and push interest rates lower at a time when inflation was high. And it really caused chaos in the economy. Inflation soared and the Turkish lira fell sharply as a result. And it's been quite a struggle. Having said all that, look, the Fed has a long history of pushing back against politicians. If you read various books written by historians and former Fed officials, there are stories about administrations, both Democratic and Republican administrations, trying to push the central bank to lower interest rates. It's nothing new. And the institution of the Fed has remained stable throughout those years. I've known many people who work at the Fed over the decades. I've been doing this job, and although there are differing views on politics, no one I've ever met has tried to bring that into the job. Chair Powell says in every press conference following its meeting, after the Federal Open Market Committee meeting, that everything they do is in the service of the people, and I believe he means that. So I'm watching, but remain optimistic that the institution itself will remain stable. But look, the fact we're even having this discussion isn't a good thing. It's something we're watching, but in my view, there's no reason to jump to conclusions as to how this will all play out.
Yeah, I really appreciate you saying that, Kathy. I think it's a really important thing to remember. And even the scenario that I laid out, as I said, has a lot of steps and a lot of things that would have to happen in order to make that happen. So we'll continue to watch it. But, something else I've been thinking about a lot in the context of the Fed independence discussion is that the administration and especially the public can get confused over what rates the Fed can actually control when it makes a monetary policy decision. A cut like happened last week is a reduction in the Fed funds rate. That's the rate banks charge each other for overnight loans, and that's really the only rate that the Fed can actually set. It can be a signal for other rates, but it does not specifically affect, say, mortgage rates or the rate I pay on my car loan. And it doesn't affect the rate that bond investors are demanding for their investment. I think that's where the disconnect happens between the Fed's benchmark rate and, for example, what investors are demanding for a 10-year treasury, which is set by the market. To that end, now that the Fed has resumed its rate-cutting cycle, what is your outlook for other rates?
Since late last year, I've been of the opinion that the Treasury yield curve would steepen. And what do I mean by that? I mean that the difference between short and long-term rates would widen or increase. So as you said, the Fed directly influences short-term interest rates. It sets the Fed funds rate, that very short-term rate that banks charge each other for loans. It's usually overnight. So any loan tied to the short-term market will tend to track the Fed's policy moves pretty closely. But as you go further out in maturity, other factors come into play, including inflation and inflation expectations, prospects for economic growth, and supply and demand factors. So typically when the economy is in growth mode, intermediate to long-term rates will be higher than short-term rates. Investors demand more yield to compensate them for taking the risk that inflation is going to be higher than expected, or that there might be some unexpected increase in the issuance of treasuries, which is supply, or a drop in demand for treasuries. And we call this extra yield a risk premium or the term premium. In an environment like this, where inflation is higher than the Fed's target and edging higher, and fiscal deficits are high and rising, that risk premium is likely to rise. So in our view, there's room for yields to fall for all maturities of bonds as the Fed lowers rates, but much less room for long-term bond yields due to these worries about the deficit, about inflation. It's even possible that long-term rates rise as the Fed cuts rates. That happened in 2024. Since long-term rates affect mortgages and other types of consumer loans, it could be very confusing for the public to see the Fed cutting rates, but seeing, say, mortgage rates or credit card loan rates going higher.
I want to pick up on your comments about one of those factors, and that's the impact of fiscal deficits, because I know that's something that fixed income investors are thinking about. The One Big Beautiful Bill that was signed into law over the summer increased the debt ceiling by $5 trillion. And that wasn't really that controversial. Even Republicans who had never supported a debt ceiling increase in the past chose to vote for it this time. While elected officials are not acting particularly concerned about the ballooning deficit, The bond market seems to care quite a bit about it, and that seems to be playing, as you said, a role in the steepening yield curve. So can you give us more clarity on where the yield curve stands right now, and what else may be driving it, and what investors should be watching for as they take a look at this?
The Treasury yield curve has been steepening with short-term rates falling, long-term rates kind of holding steady or edging a little bit higher here. I look at the difference between 2-year Treasuries and 10-year Treasury yields as one indicator. And that's widened out to about 55 basis points. And it was much, much lower, closer to 20 basis points just earlier in the year. I think the rise in long-term yields is likely in part due to the concerns about fiscal policy. It's not just happening in the US either. It's a global trend. In developed markets, deficits have risen relative to the size of economies, in some cases to record levels, which means there'll be a lot more bonds issued by these countries that have to be absorbed by the market. Even in Germany, which traditionally has limited its debt, there's increased issuance. And that's pushing yields higher everywhere. It's especially concerning if inflation remains high because inflation erodes the value of bonds. There are even some concerns that countries will try to inflate their way out of the debt or monetize the debt. So naturally, investors are demanding more yield to compensate for those risks. I want to add, though, that I'm not in the doom and gloom camp about this. I always like to point out we are a very wealthy country with a growing economy and have the capacity to service the debt. We, meaning Congress, just need to demonstrate the will to do what's necessary to address our rising debt levels. In an ideal world, we'd focus on outgrowing the debt, that is, having economic growth exceed the growth rate in the debt over time, and that would bring down debt to GDP. But it will probably entail making some unpopular decisions, such as raising taxes and cutting spending in some areas, and those are difficult things for politicians to do, as you well know, Mike.
Yeah, no question, Kathy. There's a focus on Capitol Hill on cutting spending by some, but we also saw the lowering of taxes, not the raising of taxes. And as we know, that's always a very politically tricky thing to deal with. You know, a question that you and I hear constantly is, will the U.S. be able to sell all of the treasuries it needs to issue? So far, that hasn't been a concern. Foreign governments and private investors hold about 30% of our debt. But it feels like the combative nature of tariffs, hostility towards immigration, the drastic reduction in foreign aid, these are all signs that our attitude toward and role in the world may be changing. So are you seeing signs that foreign investors are growing concerned? For instance, have you seen anything in treasury auctions that concerns you? Is there concern that it will take ever-increasing rates to entice new buyers given all the other factors?
So far, we haven't seen a lot of pushback. The auctions are going along without much disruption. Yields have tended to come in close to where the market is trading, and that's pretty much by design because we know the amount that's coming due and the market adjusts to that. So some of that has to do with the fact that Treasury has been issuing a lot of short-term debt, which is generally pretty easy to find buyers for. It's much easier to sell a 6-month or 1-year T-bill than it is to sell a 10 or a 30-year bond. In the recent Treasury International Capital Report, we call the TIC report, it showed that foreign inflows of capital are continuing. They have slowed down a bit from last year, but they're still positive on a year-over-year basis. And that's indicating foreigners are still coming to the U.S. markets.
I want to follow up on 2 things you said. One, that the yields on foreign bonds may go up. And 2, that it's the short-term bonds that are holding U.S. yields close to where the market is trading. So if foreign bonds may be offering better yields and the U.S. can't cover the debt with just short-term debt, and you add increasing inflation to the mix, wouldn't it stand to reason that long-term rates will have to go up?
That is one of the risks, Mike. Yields are rising globally for a number of reasons, but deficits and inflation pressures are the primary reasons. We're also seeing unanchoring of yields from Japan. So for decades, the Bank of Japan has held down their long-term interest rates in an effort to manage their high level of debt, and they're starting to let go of that and ease out of that, and that's allowed those yields to come higher. And that has pushed up or contributed to the rise elsewhere. So it is the case that we're seeing a combination of rising deficits and inflation pushing up yields globally. And it certainly is a risk for the U.S. It would be very difficult for our yields to fall relative to those around the world unless we were in recession or something. We see very aggressive rate cuts because we were falling into recession and inflation was falling. So it is a risk that they might have to go up. I think that it's a risk that's already reflected to a large degree in the market, but it is something that's out there that we have to keep an eye on.
Another thing I know you follow closely is the dollar. Dollar is down more than 10% year to date. What's driving that? What are the biggest impacts of a weaker dollar if that continues? And should we be concerned?
Well, dollar is down, as you said, about 10% from its recent high. It's largely down, I think, because of the prospect of the Fed lowering interest rates and slower economy, lower interest rates. U.S. interest rates are still generally higher than those in most other major countries, but the difference in yield has narrowed. So all else being equal, a lower interest rate makes the currency less attractive to hold. There also may be a component of concern about economic growth and or the impact of tariffs on trade. And finally, some investors have the view that the administration welcomes a weaker dollar in order to boost exports. So it's perceived by some that there wouldn't be any pushback from the government if the dollar were to fall further. One of the consequences of a weaker dollar is it does tend to push prices higher. The U.S. is a huge net importer of goods, and as the dollar drops, it takes more dollars to buy those goods. Putting it differently, the price of imports to U.S. consumers goes up. And that's one concern. The other is that we need to import capital to offset our trade deficit. So there is a risk that a rapid drop in the dollar could discourage inflows of capital as foreign investors kind of step back.
Kathy, we've covered a lot of topics in this conversation. Really enjoyed it. I always like to end with having you talk about what all this means to the fixed income investor. Given everything that's going on, where do you see opportunities and maybe conversely areas of concern for bond investors right now?
Overall, despite all the concerns in the markets, we think it's still a good environment for bond investors. Yields are relatively attractive and more likely some parts of the yield curve to fall than to appreciate. But we continue to focus on managing the risks by keeping the average duration in portfolios in the intermediate term part of the market, meaning 5 to 10 years, and staying in higher credit quality bonds. So an intermediate term duration avoids two types of risks: reinvestment risk and interest rate risk. So reinvestment risk is when you hold a lot of short-term investments, and when they mature, you end up reinvesting the proceeds in lower yielding bonds. So your income tends to go down. You get less and less yield along the way. On the other end, you have interest rate risk, and that's when interest rates move up, causing the value of your bond to fall. Should you need to sell them, you could take a loss. The longer the duration or maturity of the bonds, the greater the potential for those price declines. So staying in the middle or trying to spread out maturities over time so the averages in the middle makes sense to us given all of the uncertainty out there. Now, in terms of credit quality, we don't see a lot of value in the riskier parts of the bond market right now, such as high yield or junk bonds. You're just not getting a lot of extra yield to compensate for the potential for volatility or a default. So we'd rather look to higher credit quality part of the markets like treasuries, other government-backed securities, investment-grade corporate bonds, and investment-grade municipal bonds.
That's great advice, Kathy. And this is a great discussion of a lot of different factors that are coming to play in the bond market and certainly for the Fed. Thanks so much for taking the time to talk to me today. I really appreciate it.
Always great to be here. Thanks, Mike.
That's Kathy Jones, Chief Fixed Income Strategist here at Schwab. You can follow her on X at Kathy Jones, and be sure to check out her podcast on investing. Definitely worth your time. Well, that's all for this week's episode of Washington Wise. We'll be back with a new episode in 2 weeks, where we'll take a look at how equity traders are navigating this record-setting market while also watching some worrying signs in the economy. Take a moment now to follow the show in your listening app so you get an alert when that episode drops and you don't miss any future episodes. And don't forget to leave us a rating or a review. Those really help new listeners discover the show. For important disclosures, see the show notes or schwab.com/WashingtonWise, where you can also find a transcript. I'm Mike Townsend, and this has been Washington Wise, a podcast for investors. Wherever you are, stay safe, stay healthy, and keep investing wisely.
My work is easy because I use ClickUp. Here's how I keep track of all my tasks. I start by brain dumping everything I need to get done in a list view. Next, I set a priority and a due date to keep things on track. I create custom statuses to organize my progress exactly how I want. I like to add the action items field so AI can show me the next steps. I add my teammates as watchers so they're in the loop. ClickUp makes work easy, from personal projects to running a multi-billion-dollar company. Click the link below to create your workspace for free.
Want to level up your investing skills? Master the dynamic worlds of finance and technology. Earn a certificate or credential from CFA Institute, and you'll be more than ready for your next step in investing. Set the standard.
This is Wall Street Week. I'm David Weston, bringing you stories of capitalism. This time, not for just a week, not for just a year, but stories of the arc of capitalism over the first quarter of the 21st century. It's been an especially eventful 25 years, from Y2K to the great financial crisis to the pandemic, giving us a lot to adjust to and learn from, starting with profound changes in the economy. Our colleague Michael McKee starts us with an economic overview.
We are fortunate to be alive at this moment in history.
Unemployment was low, the economy was booming.
Never before has our nation enjoyed at once so much prosperity and social progress with so little internal crisis.
Trees don't grow to the sky, and at some point there would have to be a reckoning.
We are in the midst of a serious financial crisis.
Everybody's house was probably overvalued. Anybody who had a mortgage might have a mortgage problem coming up.
Today does mark the beginning of the end.
By the time we got to the American Recovery Act, it was a question of what would it take to get people spending again and businesses investing again.
The economic recovery appears to be proceeding at a moderate pace, though somewhat more slowly than the committee had expected.
We got to 2015 and you still had problems because we had a manufacturing recession then, brought about by the collapse in oil prices.
The wealth of our middle class has been ripped from their homes and then redistributed all across the world.
A lot of Americans suffered because the factories went away, the businesses went away, and that gave rise to the MAGA movement.
Make America great again.
In 2019, things had started to look better. The unemployment rate was very low, growth was picking up, which is the irony of the pandemic.
Today, I am officially declaring a national emergency.
COVID did shut down the economy, and it shut it down very fast. And we saw that in the largest unemployment rate since the Great Depression.
First is providing checks in pockets and shots in arms.
Inflation started to take hold, and then an inflation psychology started to take hold.
We're very strongly committed to using our tools to get inflation to come down.
It is a situation now where everything seems to combine to make people feel more nervous and more unhappy about their situations.
When it comes to the economy, we always start with the numbers. And for the numbers, we often turn to Torsten Slok, chief economist at Apollo, with the help of people like Harvard's Jason Furman to interpret those numbers for us. The first 25 years of the 21st century have been eventful for a lot of us, but particularly for economists. Looking back at the year 2000 now and where we are today, what's the biggest change or surprise you've seen?
It's
Actually, the thing I'm most surprised about is that the interest rates are so low, despite the budget deficit and the debt being what, to my 2000 eyes, would have been unimaginably high.
So what accounts for that, do you think? What do you think we got wrong and what we would have anticipated?
Look, in 2000, I was working in the Clinton administration. We balanced the budget 3 years in a row. We were on track to fully pay off all the debt. At the time, I believed in that and thought that was good and important. Turns out, I think we had a lot more room for borrowing than we ever appreciated at that time.
We're certainly spending it when we need to spend it. Are we saving it when we need to save it?
Yeah, look, I think we spent too little in the financial crisis. I think we spent too much in COVID. Those were both hard calls to make in real time. It's a much easier call that we shouldn't be running $2 trillion deficits in a year when the economy's growing perfectly fine.
We have seen a growth in income and wealth inequality. To what extent is that attributable to some of the things we felt we needed to do to stimulate the economy? It tended to go, I think, to the people who had capital and not to people who did not have capital.
I put the last quarter century in context of the last 3 quarter centuries. And if I had to rank them, the best one in terms of inclusive growth, strong economic growth, broadly shared, was 1950 to 1975. The worst was actually 1975 to 2000, where we had much slower economic growth and an enormous widening of just about every way to measure inequality. The story from 2000 to 2025 is a little bit more complicated and nuanced. There were some facets of inequality, like wealth inequality, have risen. Other things like wage inequality has actually been falling for more than a decade now. There's been stronger wage growth for the median household than there was in the 25 years before. And so the story is actually a little bit more positive for the last quarter century than it was in the quarter century before, just not as positive as it should and could have been with the right policies.
Torsten, looking back over the first 25 years of the new century, let's talk about some major themes, one of which is inflation. We thought it was all gone away, and then it came back.
Well, for a very long period, the whole research agenda and also the statements from the Federal Reserve was that inflation was not quite at 2%, it was 1.8, 1.7, and so much time was spent in financial markets thinking about how can we get inflation up by that 0.1, 0.2% more. And obviously that changed dramatically when we found out that inflation was not dead in 2020. So what is a very important feature of what has happened in the last 25 years is that inflation can come back under certain circumstances. And this becomes very important when we look into 2026, namely, are the circumstances still here for inflation potentially to begin to move higher next year?
Which leads us to what were the larger forces that kept inflation down, and have they gone away?
Well, a very important force that was keeping inflation down was globalization. It was the case after China entered the WTO 25 years ago that goods were coming out of China and was holding goods prices down. At the same time, immigration globally also went up. That also meant that the cost of labor and wage inflation was also held down. So those forces were weighing on inflation for literally 2 decades after 2000, because we saw inflation therefore simply not move much away from 2%. COVID again has of course been moving upward pressure on goods prices, and now more recently when we've had restrictions on immigration, we've also begun to see more upward pressure on wage inflation. So that's also therefore beginning to become an issue looking into next year.
Deglobalization and restriction on immigration could drive wages up. On the other hand, artificial intelligence seems to be on the brink of really making a difference the other way.
That's true. So AI is, of course, also a very important development over the last 25 years. We have certainly seen some very significant technological advances. We've not quite yet seen that show up in wage inflation or even in the unemployment rate. So therefore, there's a lot of discussion about data centers, AI, large language models, voice recognition, etc. But at the end of the day, we're not quite yet seeing the productivity gains in the dramatic way that is holding inflation down.
One of the big developments in the last 25 years has been ways that the U.S. and European economies have diverged. Stephanie Flanders, Bloomberg's head of economics and government, explains just how differently they've developed.
Traveling to Mexico? Stay connected at all times. Explore hidden cenotes without losing signal. Discover the magic of Chichen Itza. Get to Teotihuacan without getting lost. And forget about roaming fees. Stay connected wherever you go with Olafly.
At the beginning of the century, you would have said the big project that the European countries were embarking on was the single currency, and a much broader single currency, a much broader collection of countries joining the euro than had previously been anticipated, and there were lots of risks in that. And we can talk about how they managed that, but I think it's fair to say there ended up being a lot of other things on their plate. And we saw whether it's the financial crisis, we saw COVID, and these were crises that in different ways, I would say, the European governments did not always respond too well, but they did, as one senior policymaker said, European governments do the right thing when they're all on the window ledge looking down.
The euro was a very big move. It came under a lot of siege over the last 25 years. I mean, certainly, great financial crisis put everything under stress. But then we also had I'll call it the Greek crisis, when there were people literally speculating the euro might not survive.
I would say in the first few years of the euro, there was a kind of false calm and a sense of great, achievement on the part of European leaders that turned out to be also complacency. They were all borrowing at the same rate almost, not taking into account those differences. And ultimately, the imbalances that were caused by that was why you had not just the crisis in Greece, but actually a broader Eurozone crisis. But I would say it's a game of two halves, because the second half, the years since the global financial crisis and the Eurozone crisis, have been, although they were very painful for countries like Portugal, Greece, Spain, Ireland, that period of crisis and adjustment has produced some convergence.
Are you moving toward something beyond convergence, into really coordination on the fiscal side?
Very slowly, David, I would say we are moving in that direction, and we've seen a little bit more flexibility on that front from German governments in the last few years. But boy, that has been a very slow process, and I think it is still an area where the politics has yet to really catch up with the economics.
The history of the EU has been getting bigger for the most part for a good long time, with one notable exception. It got smaller in the first 25 years with Brexit. What has that done to the economy of the UK and of Europe?
The deal the UK actually negotiated with the EU turned out to be actually a lot worse than I think any of us would have reasonably expected. We wouldn't have expected such an extreme version, a hard Brexit, as they call it. That has ended up, the estimates range from 5 to 7% of GDP hit at a time when, as you know, all European countries, and certainly the UK, have struggled to have very much growth. I would also say it's affected the capacity of the UK to respond and move forward in other areas, because so much effort and political energy was absorbed by that long period after 2016, after the referendum, trying to negotiate and then trying to pass a deal with the EU.
Looking forward to the next 5, 10, 25 years, what's the best case for Europe, if not entirely catching up, getting headed in the right direction in terms of closing the gap with the United States and goodness knows China?
So, obviously in recent weeks we've had talk of, civilization erasure, I think was in the Trump administration's national security strategy. I think we could probably dodge that, but I do think there's a serious kind of question of governability in some of the core economies. In terms of growth rates, I think your best case is sort of, certainly no more than 1%, probably more in the kind of 0.5% a year range.
Coming up, we turn from the first quarter of the century in economics to the ways in which China has transformed itself and surprised some of us along the way. As we continue our review of the first quarter of the 21st century, we turn to one country that has been a story, well, really many stories, in and of itself. Our colleague Enda Curran takes us through China's remarkable transformation.
China joining the WTO in 2001 was probably one of the most consequential decisions, not just for China's economy, but for the world economy.
The WTO agreement will move China in the right direction.
So companies could shift there and both tap into the Chinese market and, of course, export from China to the rest of the world.
The slowdown is not only in the developed country. It will also become a sharp slowdown in the developing country.
The global financial crisis reverberated all around the world.
China is going forward with a $500 billion stimulus package. It will build schools and subways, power plants and hospitals.
China played a crucial role stepping up, spending that money, generating all of that demand and activity, and in that period, China did become the world's second biggest economy. The Belt and Road positioned China as someone who was willing to invest and a source of new capital at a time when capital was becoming scarcer. They invested into ports, they invested into rail networks, they invested into motorways. Well, China has been a victim of its own economic success in so many ways. As China moved up the value chain, then it became a threat to some of those Western economies that had been doing business with China in the first place.
We've been ripped off by China.
And no longer are the doors just open for free two-way trade. China had the virus under control, so they took opportunity and really took a leap in terms of electric vehicles and in lithium batteries in particular. Clearly, that window was when the rest of the world was caught napping. China was doing just fine. It wasn't until later when China started to impose restrictions on its real estate sector and its real estate sector started to slow down that you began to see some of the brakes being hit on China's economy.
The problem being that home buyers are afraid to buy homes, worried about distressed developers not being able to deliver on the homes a year later.
The slump has been going on for several years now, and I think it has taken some of the gloss off of China's economy for the rest of the world.
Afsani Beschloss of Rock Creek and Elizabeth Economy of the Hoover Institution have spent a good part of the last 25 years traveling to the Middle Kingdom and coming back to try to make sense of it for us. They looked back at some of the country's biggest changes and challenges. Elizabeth, you've been going to China for quite a few years now. As we look back over the first 25 years of this century, how has China changed?
The transformation has been extraordinary, of course. I think if you look back to 2000, for example, China was an economy of $1.2 trillion. GDP per capita was around $1,000, and it was making more bicycles than cars. It was very much trying to adapt its domestic politics and economics to the demands of the international community. What we see today is pretty radically different from what we saw in 2000. Its GDP per capita now is $13,000. Of course, it's not making bicycles so much anymore as, the most EVs, electric vehicles in the world, and cutting-edge electric vehicles, largest manufacturer, consumer, and exporter. Today, you have China saying, we're front and center, and we'd like the international community to adapt to us. So what you have is China no longer being a rule taker, but a rule maker.
I know you've just recently been in China. How does it feel on the ground, as it were, over there?
It is a tale of two Chinas in many respects. Driving around in Beijing, there's no traffic. There's a kind of gray pall that seems to have settled over the city. The economic activity is not what you might expect. You don't see cranes dotting, the landscape, a lot of new building and enthusiasm. You don't have the sense of a dynamic economy. But when you meet with Chinese officials and you meet with, Chinese tech leaders, you definitely have a sense of confidence. And, the Chinese officials believe that they have a model that works. And that model is investing in technology. I visited an EV factory where they're producing 300,000 EVs in a year, and they only have 2,100 people on their factory floors. And the factory is spotless. You could eat off the floor. It's extraordinary. And they are very confident. They're confident about their ability to compete with the United States. They're confident that they're on the right trajectory. Again, though, I think for the broader, swath of Chinese people, consumption is not rebounded. They're not feeling it. This is very much an economy of haves and have-nots. And the haves are moving ahead very aggressively.
One of the things we've seen over the last 25 years is a migration, first of all, into the middle class, from the rural into the urban setting. Is that continuing?
I think it's one of the interesting things that we haven't seen the middle class continue to expand. And the Chinese are just beginning to wake up to the fact that artificial intelligence and their move toward robotics, they already have 250,000 robots. I think we have about 10,000, in their factories operating. They're going to put people out of work. And so one of the factories that we visited was an autonomous vehicle factory. And the person who was, taking us on the sort of tour of the factory said that they are now being told by the local government that they're going to need to help find jobs for the people that their autonomous vehicles supplant. At the same time, the local government's not allowing them to charge any more than regular taxi drivers or Didi drivers because they don't want those people to go out of work. So I think they have not figured out how they're going to manage the technological change and the demands for employment.
How much success has China already had in reshaping the international community?
I would say much less than we might anticipate. It doesn't seem as though much of the rest of the world is interested in trading the current international system for a China-led international system. That being said, if you're looking for Chinese technological influence or economic influence globally, certainly the Belt and Road and the Digital Silk Road have been transformative. Look at Huawei, which has 70% of the 4G in Africa. Their satellite system now rivals GPS. So I think they can look at any number of metrics and say, we've had a success. At the same time, of course, there have been protests in virtually every Belt and Road country about how China's done business. Interest and the desire, the willingness to have Chinese investment stems from the fact that they can't get that kind of investment from any other country. So I think, if we were to go in and really be competitive, for example, in Africa, in this idea that we're going to promote our tech stack globally, I think we'd be welcomed.
Do we understand in the West just how far ahead China is getting in some respects in technology and manufacturing?
I think most people think of China as producing consumer goods, their toys, basic goods. And that is the way they started. But today, it's a whole other world. So what is happening is most of us are now reliant on not just their basic ingredients being made, but the new molecules being developed in China. EV cars, let's say. The batteries that they are producing are so far ahead than the ones we're producing. So they are jumping ahead in ways that we did not expect. They might have less power constraints, the way they're building nuclear plants and the way they're using clean energy and renewable energy, the opposite of what we're doing in the US. And that's because the government in China is putting so much capital to work alongside the private sector, something that in the most recent past we're not doing.
What is that enormous move forward for China as an economy, as a government, meant for the people of China?
So if we look at the people of China, when this whole process started 25 years ago, there was hope. They were growing fast, double-digit growth. A lot of opportunities for people to get new jobs, move from agriculture to industry into cities, and get out of that extreme poverty. And right now, what's happening, because of their overcapacity, let's say, if you're producing EV cars, you might be getting paid less because they have the overcapacity. You're lucky to have a job. So the situation for the individual may not have got better, but China as a whole continues to do well. I think one thing that I found very interesting is we in the US always say China should start consuming more. And if they consume more, they will export less. We will have less of a problem, and they will deal with their growth with domestic consumption. What is very clear with President Xi, but also really maybe people who came before him, they're not interested in domestic consumption. They're interested in world supremacy, as has become evident. So you need to do the quantum, you need to do the AI, you need to be ahead on robotics, you need to be ahead on producing things so that you control your own destiny, but potentially you control other people's destiny. And I think that's what we've missed, really realizing ourselves here.
How have Chinese relations with the United States and with the West changed over these 25 years?
Obviously, when we had the Nixon and the Kissinger period and the opening up and WTO, it was the West hoping that China would open up to U.S. goods and to a more liberal democratic system. And as one went to China and you would talk to your Chinese counterparts, it was always a very open dialogue. What has been very different the last few years is that China has become more closed. If there's one thing that is changing with the Chinese, because they've always been very careful in how they show their hands to the rest of the world, they are showing more overconfidence than before. The other thing is that if you sit in China today, who would expect that the US would be kneecapping its own universities, its own research, its own biotech, is investing less in technology at scale, is not investing in nuclear power, and is not working with its allies? So in a way, that, if you're sitting in President Xi's seat today, you see a lot of potential for China.
Up next, in the year 2000, we were caught up in a tech bubble. Now there's talk of a different bubble altogether. But in some ways, bubbles were the least of what the markets had to contend with in the last 25 years. The first quarter of the new century brought us a great financial crisis, a global pandemic, and several revolutions in the ways markets coped with it all. Our colleague Romain Bostick gives us highlights and lowlights.
How do we know when irrational exuberance has unduly escalated asset values?
You had a market that hit a peak in early 2000. It proceeded to drop by about 30% in the span of just a few months.
The big question is hard versus soft landing at this point. My expectation is the fundamentals will probably get worse before they get better.
The bursting of the housing bubble was a little bit less of a panic and more of an orderly exit.
We've seen triple-digit swings in the stock market. Major financial institutions have teetered on the edge of collapse, and some have failed.
Most people began to sell stocks that were directly tied to the housing market, but eventually that began to spread to other areas of the market that had nothing to do with housing or credit.
By far the most important thing is a program be successful, because if it's not, those that are going to pay the biggest price are some of the ones we all care about the most.
Quantitative easing was the effort by the Fed to stabilize the markets. In fact, it was so ambitious, they actually did it 3 times. Once they ended QE3 back in 2014, they had to restart it a little bit less than a decade later when the COVID pandemic hit.
If the epidemic become pandemic,
global pandemic,
I think there's a panic. A whole lot of panic.
The COVID pandemic was undoubtedly one of the biggest exogenous shocks for financial markets in modern history. The market in the span of really about 5.5 weeks plunged 20 to 30%.
This will deliver urgently needed relief to our nation's families, workers, and businesses.
We saw inflation, headline inflation rates, top 9%, the highest for the modern era.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
Meme stocks. The best way to describe the meme stock boom can probably be summed up in one word: boredom.
All eyes seem to be on GameStop. GameStop to the moon and back.
Gains in GameStop.
This has now reached levels of insanity here.
You're witnessing the French Revolution of finance.
There is a rebellion aspect to it. There's an anti-establishment aspect to it.
At this point in 2025, the vast majority of activity that we see in U.S. public equity markets are actually driven by individual investors rather than institutional investors. That has a big impact on prices. It has a big impact on valuations.
As we begin the second quarter of the 21st century, we're returning to talk of bubbles. In 2000, it was the tech bubble. Now people are wondering if we could be building an AI bubble. Bridgewater founder Ray Dalio has studied the mechanics of bubbles through the years.
I think you have to relate the markets to the geopolitics, the politics. We have a bubble in 2000. And then 2001, you have the international geopolitical problem in terms of 9/11 and then the war on terrorism. And so we spend about $8 trillion in our wars on terrorism and we run big budget deficits. And then we come into the period where we get down in 2008, we have the great global financial crisis. And the great global financial crisis is not just a financial crisis, it brings over the wealth gap issue. In other words, Occupy Wall Street. And it also was a shock to the rest of the world. And in 2008, very important, that was the first time interest rates hit zero since 1933. And so what happened for the first time since 1933 is we did quantitative easing. We printed money and we bought bonds. That's a marker. And we start to learn that large budget deficits can be monetized. So we learned about monetization. And from that, then we drive it down to negative interest rates. And of course, through this all period is the digital technology, the development of all the digital technologies. You know, devices like this, think about this. This is the everything object and the communications and so on. Very unexpected in many cases in terms of what the effects would be. And then 2016, the change, the big change in the world order and the big change domestically, the beginning of populism and Donald Trump being elected president. And so we have this greater polarity, left and right, that reflects the wealth gap differences. And then that meant a big change in the relationship with China. In other words, recognizing that there's a great power conflict. And that great power conflict goes from globalization to nationalism and the change in that world order. And of course, at the time, in order to be stimulative, there's the printing of money and buying a lot of debt, which drives interest rates down to be negative in some places, and certainly real interest rates to be negative. And then what that does is it causes the leveraging up of assets. In other words, private equity, the emergence of private markets, venture capital, private equity, all being leveraged up. At that point, we begin to have the tightening. We're beginning to feel that effects, the deterioration of the venture capital market and the private equity market and the fragility associated with that. So now we have an economy where so much of it, since really 2020, large budget deficits and necessarily the monetization of that, large gaps in wealth and values and in populism, a great power conflict. Acts of nature, droughts, floods, and pandemics have been a major force in history, and that certainly was the factor in terms of seeing not only the pandemic, but also climate change and its effects.
Ray, some of the major developments over the last 25 years you referred to, like the Great Financial Crisis, 2008, and the pandemic of 2020, have caused the government, the United States, but also other governments, to play a more active role in the markets. Some people have said they've gone from being a referee to actually being a player in the game. What are the consequences of that for financial markets?
That's always been the case in times of great conflict. If you look at when there's great geopolitical conflict, there becomes the necessity to go from a consumer-based economy to a more directed economy of how do you use the resources. If people just get rich and buy expensive things like expensive handbags and so on, and it's not directed, you're not going to have the country be competitive. In the AI world, you have to build infrastructure. You have to build sources of energy. So it has always been at similar times the bringing in industrial policies, as we call them, in order to create that direction. And so, for example, in AI and related technologies, quantum computing and the like, it's quite typical in history to see what's now happening in terms of the competition, or let's call it the tech war between the United States and China. Because the tech war is also related to the military war. Whoever wins is going to win everything.
Ray, what about geography over the last 25 years in terms of financial markets? Where have there been surprises in some regions growing a lot, maybe unexpectedly, or others diminishing? And I think, for example, of the contrast between the Middle East on the one hand, where you've been very active, and Europe.
It has to do with immigration and migration. There's been a dramatic change in the population and the politics of what it means, that it's become even cultural. So I would say, the movements of people, or even the changes in the numbers, that demographics. In other words, Europe, the United States, China, a number of these countries, which generally speaking, what we would think of as the developed world, for the most part, although it includes China, have declining populations. And in the emerging world, the global south as we come, they have growing populations that want to migrate. And that's connected to climate change, because as climate change creates greater heat and so on in these areas, it drives migration. And so as we're looking at the migration and the immigration issues, they become greater issues. I think if you just look at the administration's new report on its strategic objectives and the way it views the world, you can see that there are even cultural issues. In other words, which are the areas that maintain their culture, or do they have migration issues? So these are geopolitical issues that are all connected.
I suspect if we talked to you 25 years ago, you would have predicted China would be a major force. Would you have predicted that the Gulf, Saudi Arabia and the surrounding countries, would become as prominent as they have?
Basically, all you need is three things to happen to have a successful country. First, educate your children well so that they can be productive and earn incomes and that they're civil with each other. And then second, if they come out to a country where people can work well to be productive and that there are financial resources like the capital markets to be able to be productive and everybody earn, and in other words, the basics, earn more than you spend and have more assets than liabilities. If you're financially sound and productive and civil with each other, that's key. And then stay out of wars. Stay out of internal conflicts, that when you have that internal conflict or an internal war of sorts or an international war, that's a problem. So some of these places, I can see that over maybe now I see it better than I saw maybe 25 years ago.
Coming up, as we draw to the end of the first quarter of the century, in some ways it's all been about tech, one way or the other, from Y2K to .com to AI.
And liftoff.
What did we learn from the innovation and the turbulence? The last 25 years have brought us the smartphone, streaming video, and Elon Musk, not to mention that AI and whatever it has in store. Our colleague Caroline Hyde guides us on our journey in tech.
Y2K, the millennium bug, the accident that never happened. We suddenly had this fear that as the celebration moved from 99 to 00, computer systems wouldn't work, but hundreds of millions of dollars were spent putting plans in place.
There will be some Y2K glitches somewhere.
We went from wired to wireless in many shapes and forms.
The Mac, the iPod, and now the iPhone.
We're able to be connected, we're able to be understanding indeed how to communicate, but also we could then interact with the internet at the same time. 2007, streaming hits the big time with Netflix, offering not just DVDs through the post, but a streaming bundle too.
We can improve our service, offer the best of DVD and the best of online, combine those, and then it's a huge opportunity.
We are seeing an evolution in social media that really dovetailed with the turning of the millennium.
Facebook was born in a specific time and place. A college campus, the web.
Facebook made a significant pivot in 2021.
I am proud to announce that starting today, our company is now Meta.
3, 2, 1.
Elon Musk, who came in with SpaceX, born in 2002, and so swiftly, within 6 years, he had already got a privately owned, privately built spacecraft into orbit. People are now talking about putting data centers into space.
AI.
AI.
Everyone now remembers the end of 2022, when just very quietly, a not-for-profit, OpenAI, introduced ChatGPT, and the crowd went wild.
I think it takes like unique human arrogance to believe that AI cannot supersede humans.
And it's now that we're seeing IBM say by 2029 we will have in the hands of corporates a really useful quantum computer that will solve real-world problems.
For more on the evolution of technology over the first quarter of the 21st century, I spoke to former IBM President and CEO Sam Palmisano and MoffettNathanson partner and senior analyst Craig Moffett.
Take us back to 2000.
Yes.
And how the world looked in 2000 and how differently it looks today in technology.
Well, it's incredible. In 2000, at that point in time, I wasn't CEO yet, okay, right? So, and I was running the hardware business at IBM, and that was semiconductors, it was storage, mainframes, all PC, and all those sorts of things. And basically, the dominant architecture for development, for research and development, was we called it the Wintel duopoly, Windows plus Intel. They were the dominant for client server. And client-server had become the alternative to the mainframe, because you could do a lot of the applications in the client-server environment that you didn't have to run this big centralized computing environment. So that's the world we lived in.
The internet was just getting started, actually.
The internet started in the late 70s. Mm-hmm. And people, again, didn't realize what was happening is because it was basically research laboratories passing technical journals to each other in a standard format. That's how it began. But all the things that made it the internet as it is today had to be built up.
What do you see converging right now in tech? For example, AI, what it could make possible in various areas over the next 25 years?
I don't think we have any idea, but I can tell you some of the stuff we're working on. I don't think anyone has. It's just like the early days of the internet. Did anybody think that this would get to where you can't live without your smartphone? And I was part of the industry. Nobody saw that. I mean, we did see opportunities, but we never thought of Uber or GPS or those kinds of things operating on your phone. And that's, I think, what's going to happen here. There are people I know today that are building, they call companies without any people. We're invested in one that's building an AI bank. A bank without people. I think in other areas which we've done a lot of work on, like drug discovery, you're just seeing the beginning of that. I think if you can take the very complex cases of disease or drugs and forget these big data centers, connect that with a quantum computer, with the knowledge within the AI systems and the data structures and the volume of that data and all those case histories and things, that could be significant. That could be a significant breakthrough.
When are we going to see quantum computers really be usable, and how transformational could they be?
Where it's a defined space that it's not a general purpose computer. And I think that's where when people are talking about it being ready by 2029, I believe that'll be the use cases at that point in time. It won't be what you can do in a cloud today or what you could run historically in a mainframe, which is large general purpose systems that do all kinds of work, manage all kinds of variables and those sorts of things. It'll be very defined. Now, the benefit of that is you'll have the general purpose systems feed the quantum machine. The quantum machine will do its stuff that it can do very, very well and then pass it back.
A lot of changes in a lot of places, but certainly in the telecommunications area. Give us your perspective about that 25 years. What did it look like in the year 2000?
It's quite interesting if you think back to that period for a number of reasons. One is people talk about it as the bursting of the dot-com bubble. But the bursting of the dot-com bubble in reality wasn't terribly consequential. There wasn't a lot of market cap involved. There weren't all that many jobs involved. The bursting of the telecom bubble was much more significant, and it set in motion things that have lasted and echoed for 25 years. I think you can make a case that the jobs lost and the potential for a really serious recession coming out of the bursting of the telecom bubble was why Alan Greenspan and the Fed cut rates aggressively to forestall a recession that ultimately inflated real estate prices and arguably was one of the main precipitants of the bursting of the housing bubble that created the Great Recession of 2010. On the other hand, it created a tremendous amount of telecom capacity that continues to benefit us to this day. And the connectivity and the cost of connectivity that fell so precipitously because of the overbuilding of the late 1990s had really, really salutary effects for the tech economy for another 2 decades. The obvious question that everybody's struggling with today is, what are the echoes between that period and today's potential bubble in AI? And if the bubble bursts, the most important question is really, will the capacity that's being built, all these data centers, for example, but also the power that supports them and the facilities themselves, will those facilities actually have a long enough useful life to have a benefit even if the bubble bursts? Or are they such short-lived assets that unfortunately it simply brings all the pain of the bursting of a bubble without any of the benefits?
When we think about the so-called bubble in the year 2000, often people are thinking of things like Pets.com.
Yeah.
But there was also fiber optic, which got really overbuilt, excess capacity.
Right.
But without that fiber optic cable, would we have many of the services we have today?
No, you're exactly right. It really turned out to be tremendously beneficial to the tech economy. There was a genuine capacity shortage going into the late 1990s. And what happened was Wall Street, in the way that it does, figured the way to solve this problem is to fund new companies and new innovation, new entrants, created this extraordinary overhang of capacity. So there was this massive excess capacity. The marginal costs of any telecom business are essentially zero. And so it didn't take a genius to figure out the debt service from all these new entrants was going to be impossible to satisfy. You were going to have a wave of bankruptcies that would create this enormous crash. We never would have had Netflix without the enormous capacity that had been created in the telecom bubble, and Netflix was able to take advantage of essentially free transport to build a business that today is sort of dominant in the entertainment business.
Well, and streaming is all the rage right now, given even some of the deals we're seeing going on or trying to go on. I remember back in the day, going from twisted pair to coaxial cable seemed like a really big step forward.
Coaxial cable, as you said, really took off as the transmission medium to the home. That lasted for another really 2 decades, and it's only been in the last 5 years that you've seen real pressure on that. Because, and by the way, I would argue we're back in a telecom fiber bubble, this time in FTTH, as it's called, or fiber to the home, overbuilding by not just AT&T and Frontier and Verizon and the big companies, but by a host of privately funded private equity companies are building in markets where the density simply isn't high enough anymore to support the returns. And it looks to us like you're going to have yet another bubble bursting, not anywhere near the size of 1999, but we suspect that bubble will burst.
Looking back, you know what we thought we saw in technology in 2000. 2025, looking out, what do you see?
AI is by far the most important and dramatic technology innovation of our lifetimes. It's not even close. And we're really struggling to figure out what it's going to do to societies. You know, that I hear people say, well, of course, the Industrial Revolution was tremendously beneficial to human productivity and humankind. But we had 200 years to adjust to the Industrial Revolution, to figure out what are the right things to teach in colleges or schools at the time, and for society to adjust. This is a revolution that's happening in a decade. We've never seen anything like that. And I think the next 10 years are therefore the hardest to predict of anything I've ever seen in my lifetime. Is just how is society going to respond to what is certainly the case that huge numbers of jobs are going to be replaceable by AI? To try to figure out how will society try to adjust to something this profound that comes this quickly. It is an incredibly difficult question or set of questions to answer.
Next, Ray Dalio takes us through the history of bubbles. As we begin the second quarter of the 21st century, we're returning to talk of bubbles. In 2000, it was the tech bubble. Now people are wondering if we could be building an AI bubble. Bridgewater founder Ray Dalio has studied the mechanics of bubbles through the years.
There are so many bubbles that you could look at. I don't think people understand the mechanics of the bubble. So you can look at that bubble, you can look at many, many other bubbles. Okay, what is a bubble? A bubble occurs when there's an enormous amount of increase in wealth relative to money. It's important to understand the difference between wealth and money. Wealth is easy to create. Like now and in other times, what you do is, let's say you raise $50 million for a $1 billion company. So you have a unicorn, but you raise just $50 million. Then you're a billionaire, and the company's worth $1 billion, but nobody's really paid anything like that. And so wealth is something that rises, but you haven't materialized the benefit of that. And so in order to spend money, you have to sell wealth. And so what the dynamic of a bubble typically is the need to sell some wealth to get some money. That usually happens when there's a lot of wealth relative to the amount of money, and there's a need, and maybe a tightening of monetary policy. It could be wealth taxes. For example, because of the large gaps in wealth and the ability to become very wealthy without paying any taxes because there's no tax on wealth, if you were to have something like a wealth tax, then you would have to have people who are holding these assets, selling some to pay their tax bill. So when we look at all the bubbles in history, there's plenty of lessons of what the mechanics are for that. There's plenty of lessons in the printing of money and the devaluing of money. I mean, the 2000 lesson is just one of many lessons in where the government needs to spend a lot of money, but where's it going to get the money from? So what happens is there's a supply-demand problem for debt because there's not enough lending to finance the debt. And so the central bank comes in and monetizes that. And there's the effect of monetization. It should not be surprising that that causes inflation. So there are many, many lessons. The relationship between the geopolitical or the political having to do with what wars or even preparations of wars are like. In other words, before the shooting wars, there are economic wars and sanctions. Sanctions have existed throughout history. You know, prior to World War II, it was the same sort of thing. Japan is getting expansionist in Asia, and what the United States does is it embargoes it cuts off their oil, and it cuts off the payments of their debt. So they're holding that. So that's analogous to how China is dealing with the issue. So there are many, many lessons. When we say history rhymes, I mean, it means that in similar circumstances, reactions are similar. Yes, there are many lessons. I think that that's why I did the studies that I put out as the book, The Changing World Order, which look at these patterns over 500 years, or how countries go broke. There's a mechanics to this that I don't think we learn the lessons. I think we're so focused on the news and the arcs of history because they come far apart. You know, always there's been a breakdown of monetary orders. Always there's been breakdown of political orders or great powers conflicts. But they happen rarely and sometimes happen before our lifetimes, yes. So I think we don't study them.
From your study, the past, of increasing leverage, as you point out, over the last 25 years, there's been a lot of increase in leverage on private balance sheets, but even more, perhaps, on public balance sheets. Is it most likely, given what's happened in the past, that the way to deal with that is basically to print money, discount the value of money, and pay off the debt in cheaper dollars?
That's how they do it. You know, very classically, when the private sector needs money and doesn't produce enough, the government sector comes in and it borrows money and it hands it out in its various forms, and it runs large deficits. And then one man's debts are another man's assets, so they get devalued. So that's been true since 1971, when we shifted to a fiat monetary system. In other words, up until 1971, there was always gold, and then the promise to deliver gold. And the way that it worked is they printed up many more promises to deliver gold than there was gold in the bank. And then they had to devalue, break the link, and so on. And then they gave up on that in 1971. And so we have a monetary system. And that's the way it works. Of course, it's easier through the printing of money. Because when you hold a dead asset, you're holding promises of others to give you money. And if there's a tightness, then it's easier to print the money to pay that off. And so that happened 100% of the time.
One of the things that we've seen over the last 25 years you referred to is the growth of private markets, particularly private credit perhaps, has really expanded dramatically. How does that fit with your explanation of the cycles and the forces at play here?
Well, I think it was a wonderful development in that it opened capital markets to private markets and so on. But it produced a lot of the leveraging up, because in the private markets, most of the great success largely came during the period of very negative real interest rates or hardly any nominal interest rates, because that was it, leverage long in private markets. And so that's what we're seeing. And now we're seeing the consequences of that now. So you see that as interest rates rose and that leveraging became less profitable, and then those who borrowed have to refinance, you're seeing problems with that refinancing. You're seeing problems in venture capitals. You're seeing problems in the private markets. And you're seeing the lack of exits. You know, in the private markets, generally speaking, there would be a period of time that you would exit through an IPO or maybe an acquisition in one form or another. That's down 60 or 70%. And now a lot of the debt that was required to do that leveraging up is maturing. And that's requiring those entities to then borrow money. So these things go in great cycles, you know? And so I think that that's where we are in private markets. Now the question is, do they make the private markets public markets? Ooh, that's interesting.
That does it for us here at Wall Street Week. I'm David Westin. See you next week for more stories of capitalism.
Hello and welcome to another episode of the Stock Market Today video. It's Justin Nielsen here and I'll be hosting for you. And joining me, as he typically does on a Friday afternoon, is Mike Webster, our senior market strategist. Today is December 19th, 2025. We are heading into the holiday season, triple witching, and it was a day where it looked like tech was on the comeback trail. Mike, what do you think?
It's been so choppy that you can't make too much out of one day, especially after what we had earlier this week. Look, it's a great...
Too early to declare victory?
Yeah, it's great that we're back above the 50 and all, but we'll get into the charts, but I don't think it's crystal clear that we're out of the woods yet. But it's certainly a great way to end the week.
Yeah, not dead yet, but not necessarily thriving. So let's go through the indexes real quick to kind of give a recap. And we'll also be, of course, since it's a Friday, doing a recap of the week. The NASDAQ Composite had a nice gain of 1.3%. The S&P 500 wasn't too far behind with a 0.9% gain. Dow Jones Industrials, that had been leading for a while and getting to new highs ahead of everyone else. A little bit, lackluster here, closing about in the midpoint range with just a gain of about 0.4%. Russell 2000, I'm going to go ahead and actually put up IWM, the iShares Russell 2000. That did close at, near the top of its range, probably in the upper quartile, with a gain of about 0.8%. The RSP, which is the equal weighted S&P 500, that underperformed the market cap weighted sister there. It was only up about 0.4%. And that's, I'll throw up QQEW as well. That's the equal weighted NASDAQ 100. That was up a solid 0.8%. So, Mike, I'm going to go ahead and go back to the NASDAQ. As a reminder, we had the power trend come on briefly, because very briefly, just for a couple days, and then it went right back under pressure as we fell back below our 50-day moving average line. That's one of the things that puts it under pressure. We've also had a little bit of a distribution cluster. Our market school rules, we went with 4 out of 8 days. We got 3 out of 5. So it was really, when we were doing the studies, we were kind of, it was a toss-up between 3 out of 5 and 4 out of 8. We went with 4 out of 8, but 3 out of 5 was right up there.
In hindsight, we should have gone with either. I mean,
yes,
we were in the mindset of, the way Bill O'Neill, the founder of IBD, liked to look at things, and he wanted to keep things as simple as possible. So not having the or statement was more...
simple
is on the simple side, but I think the other one, having the or statement. So with that, and I apologize for my voice, I had my vocal cord injections last week and they did not work. So bear with me. So we had so much distribution in a short period of time, but really what bothers me is Wednesday, like that break where you didn't get people coming in and supporting it near the close. I mean, we close at the lows. When you get something like that, I mean, that is not, it's great that it worked out the next day. And I think that was the CPI number and everything. But if the CPI would have come in disappointing, now there is all the, Powell set it up at the press conference to basically say, don't trust the CPI. But when it came out, everyone forgot that he had said that it was dirt, that it's basically, he was looking at it the way I look at volume. It was dirty data, and dirty data you ignore, whether it's helps your case or hurts your case. And so yesterday's reaction, now some folks have come out and tried to poo-poo the CPI to remind people what Powell said. And what's good is we had this positive reaction after that. So everyone is aware, is reminded that the CPI this time was dirty because of just, we don't want to get into the weeds, but just really with the closure of DC and all that stuff that impacted it. But today's reaction was really good. But then you got to take it with a grain of salt that it was, triple witching and all in the fourth quarter, triple witching right before a holiday week, because next week we're closed on Thursday, and Friday or Wednesday is a half day, and no one really takes Friday seriously, the 26th, so it's really just a couple days. So next week is...
You're not going to be here, so I mean, really, should we even have the market open?
Next Friday? No,
Yeah,
I will be
yeah.
driving from California to to Texas on Friday, Saturday, Sunday, and looking forward to it actually. But no, enjoy the show, and it'll be a 15-minute show or whatever, what everyone wants. But anyways, getting back to this chart. It's really odd because if we didn't have that close like that, if it would have closed mid-range, I would be very bullish on things because this is clearly a handle, right? You can look at this as a cup with handle, and typically in a handle, you'll get a shakeout, upside reversal, not really a shake, a big move down closing at the lows, and then an inside day the next day stuck underneath the 50-day. So it was just a weak position. And it feels like there's just rotation after rotation after rotation. It's things will look good for 3 or 4 days, and then those will fall apart, and then it'll move on to something else, but then grind higher. And it's reminiscent of like the first part of 1999. Let's just go there. We haven't gone there. Go to like October of 1999, or maybe September of 99, so we can see what that looked like that whole year. Like you were grinding higher, but it was really, really choppy. And to trade that year, you kind of had to ignore the market and just trade the individual stock setups and everything, which is not how we like to do things. But it was a one-off. You and I, along with Charles, studied all the history of the market when we were coming up with the market school rules, where we did get the power trend from. And no matter what we did, they didn't work well in 1999. It was just one of those weird things where it would get you deep right when you wanted to get out, and then get you out right when you wanted to get, like, the way we look at things just didn't work that year. And what we could have done,
I think it was the worst year of underperformance for the market school rules, and again, you look at, maybe on the monthly chart and you're like, well, gosh, or maybe if you don't even look at the chart at all, if you just look at the number and say, oh, 1999 was up X percent, that must have been a good year. Well, this really kind of ruined it. And let's not forget Charles Schwab, one of the big leaders coming out of this October follow-through day, and AOL both topped in April. Now granted, they had 400% moves, but that's when they topped and they were done. So it's really, again, there were a lot of reasons to be a little bit cautious through this period when you had two of the biggest leaders, topping so early.
Exactly. And we've seen a lot of the speculative growth. And again, I'm sorry for my voice. I cannot control it. I do my best, but I can't. The speculative growth, a lot of the names have come way off their highs. Many of them are underneath their 50-day, lots of devastation. I look at that as a real positive thing, because there was so much talk about an AI bubble. And yeah, you're in a bubble, but that bubble could last another decade, or it could have been over. Most likely, we've got years left if it plays out in a fashion like this, like the ones that you're showing that, have these crazy moves up, and then they come back down.
I hope people were paying attention to this number right here, down 50%, 49%, 42%. So.
And that's after they've bounced off their lows substantially, substantially. So, and this was very reminiscent of what happened in 1999, where you had the junk story stocks had these wild moves like this. But then you had some of the quality ones with earnings that, like the Qualcomms of the world, and we don't have to go back there, that were having really big moves, but just not on a percentage basis as big as what the junk was. But it was something that you could sleep at night when you were trading. So there's two different types of stocks, right? You've got your junk story stocks that can have the huge, huge potential, but you when everyone hits for the exit, it could be just an elevator straight down, like really you can go down 80%. And that happened back then, 80, 90% for those. But then the other ones, it was more of a slow bleed down. So that's a long way of saying that it's actually constructive that that happened, because if not, and let's pull up Bitcoin, and I think a lot of the reason why the things have been so choppy is this has been under, serious distribution, for a long time, and since October, and that's been about the same time that our style of stocks have been just so difficult to trade. You wouldn't know it if you just looked at the SPY or NASDAQ or whatever, but this feels more like what has been like trading our stuff. And I think you had the crypto space getting hit so hard that a lot of people have a large percent of their assets in there, and it just kind of changes you mentally when something that was at 71 is in the 40s and the 50s, and I think that's more of a drag on our style in the short term. But like I said, I think this AI theme has years and years and years to play out. But just remember, you can still have 33% bear markets like we had in 1998, and when the internet was still young, and it still is relatively young compared to other technologies. And on the show this morning, Leif was bringing up the railroads back in the 1800s, and just think about it, like they're still around now in a big part of transportation, 100 plus years, when they were the AI. And then, it just went from that to cars to airplanes and hotels. And there's always these hot sectors that'll go, but it's the real big themes like a railroad that really changed everything, or automobiles that changed everything, or airplanes that changed everything, or the internet. Now AI just is kind of next level. And you and I saw that recently on a project that we were working on. We don't want to get into the weeds of it, but where you leaned on AI, and it really ended up being a game changer for us. So I think it's going to be a new way of all of us doing work, is integrating AI. And I'm not telling anybody anything they don't know. It's just you want to keep that in the back of your mind, that it still has a long way to go, and bad weeks like this, or bad quarters like this, they come with the territory.
Yeah, and I mean, what we kind of have been talking about as being very interesting is the kind of the augmented intelligence, right? If you ask certain questions, it can kind of guide you in ways, and again, the Windsorization, for those that know statistics, was something I was not aware of, and it's like, oh, this has been something we've been looking for to help us, get outliers not out of the equation, but minimize the effect. And so, yeah, it's amazing.
You can winterize your pipes too,
right? It's like, hey, I still live in California, so I didn't. I don't have to worry about that. You know what? I'm just going to throw up ARK-K real quick because you brought up IBIT. I think it's worth noting that this ARK innovation, Cathie Woods, what a lot of people consider a more risk-on play, topped basically right at the same time that the IBIT did, within days, so I think this actually 92.65, so it was 2 days, within 2 days of the IBIT top. And
I do have a position in that, just FYI.
A lot of the trouble really kind of started in October, certainly with this October 10th drop that we saw, and then again in November 20th, those two hard hits were pretty tough to get over. Let's
go back to, can we go to the RSP for a second? Because I just wanted to make a couple other broad points, and then we can move on to whatever you want. What's good about the RSP, because people like to look at breadth, and they're always concerned with breadth, which is valid. This is how I like to measure breadth, is the equal weight of SPY and just comparing it to what SPY is doing. So for a second, pull up SPY, and then let's go back to RSP, just so people can have it fresh in their mind. So here, this dipped underneath your 21-day and your 50, closing below that, and now you're just getting back above your 21-day and your 50. Now let's toggle back over to the RSP. And to contrast that, your average stock, this held above your 21-day. Your low was still still above it, and your 21 day is above your 50 days. So you're in a completely different position than what the Nasdaq was or the Qs, so this is your average stock. So it feels like that money is flowing from those mega caps, which a lot of them just look like they're base building. Or let's pull up Nvidia, for example.
Yeah, and I just put up FNGS, which is the FANG Plus, or if you look at MAGS, which is a Magnificent 7. But yeah, certainly the FNGS, still recovering. And to your point, NVIDIA, still below its 50-day moving average line. Broadcom, also in the chip space, that took some hard hits. Meta, of course, has been really struggling. That's below its 200-day moving average line. Microsoft, that one's, stuck below its 50-day moving average line still. Tesla, that came back a little bit more and looks stronger.
I have a position in that.
Apple and Google have also been on the better side of the FANG stocks, the $1 trillion club, if you will. Did I miss anyone? Amazon. That's back below its 50-day moving average line.
I think in that FANGS, Netflix is in there, and I think ServiceNow is in there. I could be wrong.
So yeah, Netflix has certainly been in trouble, and ServiceNow underneath the 200-day moving average line. So not a great look for a lot of these stocks.
Yeah, but the good thing is, with the exception of like a ServiceNow or pull up Oracle, which I think you had up for a second, that these are broken. Like Oracle is a broken chart. Doesn't mean that it can't recover and come back, but you've got to know when a chart is broken versus base building. So pull up in Amazon, for example. It's not acting super strong. It's not like the Google that looks really good. This is base building, and that's healthy, normal, and natural. It's just that when they all do it at the same time, it's a drag on things like the FNGS and those types of things. But again, it's healthy, in my opinion, because the money is rotating out. It's been going into biotechs, it's been going into the small caps. It's been, even just all sorts of places like metals and now defense-related stocks, and there's select little groups here and there, which is good. You don't want it to always just be, going just the whole AI theme. You got to give it a little bit of a break, and so I think it's weird because let's go back to the Nasdaq. The Nasdaq's in a vulnerable position. What should happen, because we're in the handle portion, and if you draw a declining tops line of the handle, you're right there, like at a point where it should be breaking out and going. And if it wasn't for, again, the Wednesday action that we had, and some other things like the Broadcom not acting well, which was kind of an important bellwether for that area, I'd be very, very bullish because this looks really set up. So, but I'm going to keep an open mind to that, because you do have things like the RSP that looks good, and other sectors, like pull up the ITA, which I have a position in.
As do I.
Yeah, rounding out the right side of a base and just getting over the 50-day in a material way now. I mean, it hasn't even broken out. So if this works out, it's one more area that, that can go besides the metals and, other groups that have been working.
Yeah. And let's also, since we talked about RSP, one of the indexes that was kind of going along right with that was the small cap index, Russell 2000. This one, certainly came back below its 21-day moving average line here, but was definitely in a very different position, especially since it broke out here. But is this, where do you think we stand here?
I have a position, a small position in it. Before I had a very large position, but this week, I had to back out of it, and then I, got back into it as we went back above the 21-day, and we had to exit it on Swing Trader because we had built a really big position in it. But with Wednesday's action, it was starting to break, and we didn't want to sit around and see it go through the 50 before we exited it. what I'm looking at on this is the last marked high, the 25 or 252.77. Once we get back above that, then I'll feel like it's healthy and recovered. So I'm just have a little toe hold in there, and then would gun it back above that, because I still think this is where money can be rotating into. But it's when you had the larger averages falling the way they did, I think it just was a spillover thing into the small caps. It was like algos that just sell everything, and then with everything interconnected, it goes into spaces that we're really holding up a lot better, because this looks substantially better than the NASDAQ, at least recently. Although the NASDAQ looks set up better, Yeah. So it's
it does now. What a difference a couple days makes, right?
Today's close, but it's triple witching close. So then you got to take it with a grain of salt.
Yeah, absolutely. And to that end, the volume, of course, is almost always higher on triple witching.
It's super clean on triple witching. It's just dirty the other times.
He's kidding, folks. He's kidding. That's the okay. Let's go through some sectors to kind of see again where the money has been flowing here lately. As usual, we start from the worst first. Worst today was utilities. That's back below its 50-day moving average line. This was seeing some participation as an AI adjacent type of play, because again, with all these AI stocks, yes, you have NVIDIA as the brains, and Google as the AI research, and Microsoft with software. But at the end of the day, energy and power is a very important part of AI, as a lot of these data centers are about 10x times the power usage of your regular cloud data center. So it's a big difference there. But this has normally a place to hide in XLU and XLP, the staples. These, as you would want, are not doing as well. The last few days, kind of getting resistance. XLY, which is heavily weighted in Tesla and Amazon, that did break out. It was down today, but it's not broken by any stretch. XLR,
I do have a position in that. Just
XLRE. XLRE, the real estate, that looked like it was trying to get back above its 200-day moving average line, but that is back below the 200-day line. XLE, the energy plays have been a little bit all over the place, a little bit volatile here lately, still not really showing a direction yet. XLC, as we mentioned, Meta, not looking as great. Alphabet looking much better. This is kind of splitting the difference between those two heavyweights in this ETF, but a nice double bottom with a potential handle here. So that's interesting to see. Gold, GLD, the gold shares, setting up in a little handle. We were mentioning that this area right here, too early for a climax, so it wasn't necessarily a time to say, oh, count this out, but here we have a base and a potential breakout on the horizon right here at around 400, a round number. RSP that we covered already, with the equal weighted S&P 500, XLB, the materials, that one is, back above its 50-day moving average line and 200-day moving average line recently, and holding up pretty well. XLF, this one is the financials, and that had a breakout and is holding right above the top of this base at 54.50. Not 51.50, but XLV, that is also, this is kind of a longer base that this is coming out of, a nice little saucer here, if you will. Maybe a little too deep for that. Oh no, it's 20%. So right at the.
No, it should be a saucer. It is a saucer.
Yeah, it might be 20.01 or something. But yeah, a little handle getting added onto that. So that's something that's been looking interesting. We saw a recent breakout in JETS, the from this base here, and that's been continuing higher. QQEW, which is the equal weighted NASDAQ 100. Remember, the NASDAQ 100 doesn't include financial names, very heavily tech weighted. That had a good day. Not as good as the NASDAQ, but still, very good. XLI, which is the industrials, that has gotten support at the 50-day moving average line, back above the 21-day moving average line, and looking at a area of resistance here. SPY, S&P 500, right in there in the middle, or actually, I guess on the higher end. KBWB, this has a lot of big banks in them. We were considering going over one today, Goldman Sachs, that got added onto Swing Trader, but that's had a nice run here, tightening up. FNGS that we mentioned, still below its 50-day moving average line, but had a good day today. The Qs, of course, this is the NASDAQ 100.
Could you go back to the FNGS?
Sure.
Just something that jumps out at me, but I'm not sure if it jumps out at everyone else. This looks like a double bottom to me, where your buy point would be the 72.29, and so just keep an open mind with it, because I think a lot of people have kind of ridden off this space and we're looking at this as a short. And if it goes back up there, those shorts are going to get squeeze, and that would be very good for the overall market if that ends up happening. I don't think it's a perfect instrument, because the stocks that they picked for this, I would have done it differently. But it's just, it is what it is. But at least this is a potential double bottom.
And just one of the components that we look for in a double bottom is that this second leg undercuts the first leg, which this did just by a tiny margin. 67.03 was the previous low, and this one was at 66.84. So just about a quarter below that. Moving on to QQQ, the NASDAQ 100 and ARKK also kind of showing a little bit more of a risk on. So even though this has been in a poor position, this was up 2% for the day. XLK, which is the tech ETF, very heavily weighted in NVIDIA. This was, crossing above a downtrend here in this handle. GDX, the gold miners, I do have a position here. This looked like it was tightening up and kind of breaking out of that area there. SMH, the chips, having a very strong day. Again, ugliness just a couple days ago on Wednesday, but is all forgiven now as we get back above the 50-day and 200-day moving average line. And then as we go to the leaders of the day, ITA, Aerospace Defense, making a move here today. I do have a position in this one. XME, I do have a position here.
Sorry, it's annoying. It's as annoying for us as it is for you guys listening, but it's just a legal thing.
Yeah. This one is. We were kind of poo-pooing this for a little while, because it was like, oh man, it's all over the place. You've got coal in there, you've got steel, you've got copper, you've got gold. But at the end of the day, it was looking so strong, it was hard to ignore. So, it is what it is. Sometimes if you can't beat them, you join them. XBI, I also have a position here. The biotech, that looked like a bounce off the 21-day moving average line. So I actually added a little bit. Can I just say
something about that one? Is we had it on the swing trader for a while, and we removed it because it looked like it was a potential to shake out well underneath the 21-day, maybe even come into the 50-day. And when it didn't do that, that it just had a little bit of a shakeout there and firmed up, we went back into it. And so you have to, it's just a reminder that you can exit something and you can always buy it back. The stock or the ETF doesn't care what you did with it. And it doesn't mean it's going to work out, but then you have a new stop in place, which we would use today's low and yesterday's low to exit this new position. But there's still a lot of strength there.
I'm going to back up real quick, because someone was asking, why we put ITA on Swing Trader today. Again, I have a position. We have to say it every time. Unfortunately. And they were mentioning, well, housing hasn't been strong. Not ITB. That is the housing. ITA is the B is the home construction, but ITA that we put on Swing Trader was aerospace and defense. So that was an area, and we'll get to a RTX today, but there were a number of stocks that were looking interesting, whether it was Woodward or GE. A lot of the aerospace defense stocks looking interesting today. Moving on to the top round. IBD 50, the Innovator IBD 50, that had a good day today, still below its 50-day moving average line. And IBIT, of the sectors that we had in our screen here, this had the best day, up 4%, but still very, very far off of its highs. Just a real quick look at that. It's still 30% off of its highs, even with the bounce up today. So, Mike, let's go ahead and take a look at some stocks. And why don't we start with RTX, since we talked about some of the aerospace defense area? A nice little move here.
I do have a position in it.
Yeah, so this is the former Raytheon. Just changed its name. But what do you think here?
I think it's set up. It looks good, and you have a nice exit, because the exit, if you were going to do this from a position trading standpoint, you could use the low from 2 days ago. And if you're doing it from a swing trading standpoint, you can use that too, but you could also start exiting at today's low. So when I look at a stock or an ETF, my first thought isn't how much do I think I can get out of this? My first thought is, where do I know that I'm wrong? Because you're going to be wrong a lot in trading. And if you're not comfortable with that, don't trade. Just dollar cost average into SPY and just hold it forever. I mean, there's nothing wrong with that. But that's not what we do, because we can admit when we're wrong, and you buy something and you have to know where that stop is. Now, if this was 200 and your stop was still at the same place, you'd probably pass it up, because there would be too much risk in there. Let's go to the weekly on this one. And this is more of a group move, that there's so many stocks in the defense, you can almost throw a dart at it. And that's why we went with the ITA for which I have a position in, that we put on Swing Trader, because it was just
should mention that for this GE Aerospace has a 21% weight here on this one, and RTX is at 16%. So that combination is the bulk of what you're getting in that ETF. So
yeah, and I think the GE looks good. I think the guys, Hatman and Ken, I think they put that on a leaderboard today, if I'm not mistaken. So go back to the RTX weekly and let's look at the quarterly numbers. When you look at this, it's mediocre. You just got to be honest. 12% sales, 17% earnings. But on the good side, the sales are starting to accelerate and the earnings are slightly accelerating. But it's not, this is a C caliber, B minus caliber stock. But what it has going for it is the group behind it, the RS line blue dot. So the RS line is at new highs, as is breaking out of the base. You have a good exit with it. You have a relatively low ATR, which you don't even have to pull up the ATR. You can just see it by how it trades. And it trades in a predictable fashion. But the annual estimates are weak at high single digits, but it's nothing to write home about. So honestly, I'd probably go with the ITA instead of the RTX, even though I've done both in my personal account. But I'd lean heavier on the ITA, just because you can get some, if you're going to take a lot of individual stock risk, you want to make sure that it has something compelling for it, not that it's just another one in the group. And like you were saying, what was the WWD, and there's so many of the other ones in the group that just look buyable, and you could do a basket buy of all of them, or you can just go with the ITA or similar. There are other defense related ETFs that might work better for you if you just look at the holdings and see what the percents are on there. But this one, those annual estimates are stronger. Let's go down to the quarterly numbers, and those are stronger. But let's go over to the daily chart. And so I was going back and forth on this one. The risk on this is really the low from 2 days ago, and that's just further away. But this is also one in that area that I think, and frankly, looks better than the RTX. It just has more risk.
And also, just to kind of point out, the ATR on this one is 3.56 as opposed to RTX, which was much lower. I think that was 2. I'll pull it up again. I'm just looking at my list. Yeah, 2.11. So 3.56 on Woodward versus 2.11 for RTX. So, sometimes when we're doing our portfolio construction, we will take that into consideration. What is our portfolio ATR? When you have a lot of cash, that's going to help minimize that. When you have a lot of ETFs, that's going to help minimize it. Unless it's something like XME, which has a 3.5% ATR right now. And again, this is a 21-day ATR that we're using. So just interesting how that played out. Let's also take a look on the tech side. Palantir. This is one I was stunned as I was doing some post analysis. I overall lost money on this stock, and I'm like, how did that happen? Well, a lot of this choppiness in here just took away the profits that I had from earlier. I had some small gains in here, and they got taken away from some of these. Actually, it was in here. I think it was all in here that I turned a winning trade into a losing one. Or a losing stock for the year. But set up again. What do you think, Mike?
Well, I have a position in it. I bought it yesterday, and then when it was starting to move this morning, because we had already tried it on Swing Trader, and then we backed out of it, and would have done that same trade again. It was just not working out. And then so I bought it back yesterday with the low back above the 21-day and the 50, and it looked set up. That's what I call a setup day, where you've got a tiny spread up near an area of resistance, closing near the highs. I mean, it's just something I've been using for decades now. So your expectation is today. So then this morning when it was going up, I was getting ready to add to it heavy, and I'm like, oh shoot, let's put it on Swing Trader. So then I had to sell it, and we put it on Swing Trader, and then I built my position back up and added to it heavy, and then the guys put it on Leaderboard like late in the day, so I had like 1 minute to the close to buy my position back.
I had it as well, and I couldn't get it back in that final that final minute when we had a window of 1 minute from the restriction period to the close.
It was literally 1 minute that were allowed, and anyways, with Interactive Brokers, it allowed me. I was like, oh wow, there's probably something that'll allow me to set up a specific time, and so I'm going to start using that.
Oh, that's awesome.
Yeah,
that would really help.
It just did it for me, because you and I, we miss so many things because we have to put it, when we put it on Swing Trader, we got to sell it. But anyways, this is not a beautiful base, but it has been one of the leading stocks in the AI space. And it's in position where where you're wrong. Where do you know you're
what
wrong?
Don't you like about the base?
The gap down on. Mm-hmm. Are you joking?
No. I think it's very instructive. Yeah. Mm-hmm.
Oh, okay.
Yeah.
So
because you say it like it's obvious, and it might not be.
Okay. So when you analyze a base, and let's do it on the weekly first, because that's probably a little bit easier. And Bill O'Neill, founder, and all, he invented this thing called as far as I know, he invented it, a week-by-week analysis of the base. And it's one of the most powerful things, and he doesn't get a lot of credit for it. And the two of us spent years trying to codify that, and we never finished it. He ended up retiring before we finished that project, but we would go week by week through it and analyze it to death. And by analyze it to death, what did we do? We'd look at the combination of volume with the price. Yes, I don't use volume anymore, but I would still use the price action. The spread, the distance from the high to the low versus anything in the base. Your widest ones in the base, your smallest ones, what do they look like versus your prior run? So the spreads in this, especially the first 3 weeks in there, so much wider than anything that we had seen recently. What does that tell you? That's a bad sign. That's telling you that people don't know what to pay for it. It's not equilibrium. Tight is equilibrium. This is, in a nutshell, that's what it means. The next thing you look at is the closing range. Where did it close? If it closes at the high as 100, closes at the bottom at 0, in the middle it's 50. And we found that really 38 to 40% closing range on a down week was actually supporting action. The higher, the better. And do the track price on each one of those first three in there. And this is only for down weeks. And so that is a 23% closing range, is right there in the track price. Then a 31. And then a 27.
Mm-hmm.
So the thought process there is the Friday close is the most important. And if you can't at least get up to halfway, which would be 50%, then you at least wanted to show that it has some strength, that, let's just call it 40%. Sometimes we use 38, but 40% or higher that it was supporting action as the stock was coming down. Because you got to remember, when something is being sold off, it might be like a bunch of swing traders or those goofballs who like to trade fast in there. I don't know who would want to do that.
Well, just as a case in point here, let's look at this base prior, and here was a 46%. So in the lower part, but above that 40% that you mentioned. So a very different look as opposed to kind of a waterfall here. And it stopped on that second week, had that 40% close, and then inside a couple days, just again, as a contrast.
Exactly. So that week, and then the two prior weeks, very, very constructive action because one, not just the closing range that you pointed out, but the fact that it was back above its 10-week on the close. And as you were saying, that those next 2 weeks were tight. You wanted to, again, equilibrium. The spreads came back down. It was telling you people were comfortable there. And then it started moving up, but then the market and the whole AI thing was falling off, and that's why I think it came down. But each one of those weeks, thanks for blowing it up.
Yeah, someone said that it was a little hard to see, so I'm going to try and blow it up a little bit more, and then I'll go back down.
Yeah, it helps my eyes, so thanks.
Oh, too much.
It's okay. You can just move it over to the right. Yeah, there you go. So with this, each one of those were closing underneath the 10-week, or the first one was right at the 10-week. That's very critical. That's another sign of weakness in there. So you had lots of distribution on the left side, which happens in bases, but then you needed the right side, something that is so compelling that it makes up for it. So that next week off the bottom, the closing range was high, but it was just an inside week. So equilibrium and all, but after that big hit, you would have wanted some power. So that was kind of a gray week, a touch of gray week. The following week, very nice action. Closed at the highs, was able to regain through its 10-week line, but the spread on there, because the spread will show you the power, the distance from the high to the low, it wasn't as wide as those other ones. So that was also a sign that it wasn't really being accumulated at the same pace that it was being distributed at. And then the next week, last week, that was actually a bad week. What was the closing range there?
Let's see.
Even though it was up, it was a bit of a stall.
46%.
Okay, so 46%.
So, and just to be clear, you said this already, but I want to just reiterate. When we look for that, okay, can it close in the above 40% closing range? That we consider support on a down week. But when you have a positive week, it looks a little bit funny, right? That looks more like a downside reversal in a lot of cases.
Exactly.
Or
and
stalling.
In this case, I would think is classic stalling type of action where it's just running out of gas. And so you only had 1 week of momentum the week before that, then it runs out of gas. So this is just not a good base. What you would want to do, and this is what I always used to do, is print off the chart and then take a red pen and a blue pen and mark each week with a blue pen that has something positive. Sometimes you'll have a blue and a red pen on the same week. And like with that week, last week, what was good is it closed above the 10-week line for 2 weeks in a row. That's constructive. It was relatively tight closing. That was constructive. But the closing range was bad, so that would be a red pen. And that whole stalling feel, the fact that it didn't get above the high from the second week of the base. So we could go on. I could do this for another hour just on this base. There's so many things to see. So when I see it, it just jumps out at me. And let's go back to the daily on this one. And folks should go and do this on every base. I mean, that's what I would do with Bill. When Sunday nights, we would go week by week through anything that we were going to put on the list that we managed together. So you also want to look at a daily and a monthly to see, is there anything, sometimes there'll be things that jump out on the daily that you didn't see on the weekly. There really isn't anything here. There's not, the bottom day was just, it wasn't a big capitulation. You would have actually wanted a bit bigger spread on there showing that it took out a bunch of stops. So it's just not a good base. It just isn't. But I'm heavy in it. Why am I heavy? Because if the AI thing is going to go again, this is kind of the poster child for it. And then this one should, doesn't mean it will, participate. And we've got a good stop on here. You can do this from a position trading standpoint and use the 50-day, and a swing trading using today's low and yesterday's low, and then maybe the 50-day as your final. So again, it's that you have a good exit. And let's go to the monthly. This is a leading stock. Why is it a leading stock? How I define a leading stock is when you look at a monthly, is the relative strength line able to stay above its blue moving average, the longer term moving average? And you're supposed to turn off your phone beforehand.
I am.
I didn't either, and so I'm going to do it now as I throw you under the bus. So when you're able to stay above it for a long period of time, it tells you that it's leading, and it is a leader. And that's been happening for a long time. I think it's all attributed to the haircut of the CEO. It's probably what's going on. Just joking, seeing if anyone's still awake. So again, this is Palantir. We'll see how it plays out, but it's not for the faint of heart, because when this thing, if it had some bad news, I could see it easily being down 20% in a day, like easy. Where like the Raytheon that we were looking at with an ATR of 2, unless it was really significantly negative news, you're looking at maybe a gap down of like 8% or something. So risk reward, they're just apples and oranges.
Mm-hmm. Actually, I'm glad I heard that call. It was actually kind of important. I just checked my email and I forgot that Chris was out today, so my story hasn't moved and gotten edited. So yeah, so they're kind of panicking, like, "Hey, what's going on? Who's editing this thing?" Okay, let's go ahead and take a look at.
I'll speed up.
Yeah, no, it's fine. It's out of my hands. I just had to say someone else take care of it. Pan American Silver. I do have a position here. This has been one of the strong moves. You've got this combination of both silver. SLV is the silver ETF, really on a tear. And then, of course, GLD that we've been mentioning.
Which I have a position in.
PAS, yeah, I have a position.
Which I have a position in.
Yeah, right.
We've got to be able to do something differently. This is getting old.
So yeah, Pan American Silver. It actually does, even though silver is, the headline. It has actually recently purchased Yamana Gold in 2023. It sold some assets, so it's still, and I got some of this from Gemini. So using AI, it still has a very heavy. Amount of silver, number 2 in terms of the primary silver market, but it's actually getting more from gold right now. So what is your take on the base here, or tight area?
Yeah, it's way out of the base, and it's more of just a sign that this space is continuing to work, because you could really throw a dart at anything in this group, and they pretty much look good. So we had a lot to choose from. This is one that we've had on Swing Trader, and we're both trading it. So we went with it. So this is more a sign of when you look at it, just going, are the leaders other than AI holding up and acting normal and natural, and more of a sign of health for the market? And it is. Now, GLD looks a lot weaker than silver. GDX, which I also have a position in, that is looking better than GLD right now. So you can spread it out and do some of all of them, and that's how I'm approaching it, by owning silver, gold, GDX, and the Pan American Silver, just to try to have a broad, broad exposure to this theme that I think could have a long way left in them. And so that's it. We can move on.
Mm-hmm. Well, if it's time to move on from here, then that's your chance to share your charts. A lot of these charts, we're going to go through these a little bit quick, and part of that is because we don't quite have the trend yet, so there isn't much to talk about on some of these. But Mike, go ahead and start. We have. Not everything is going to be quick, so let's go ahead and start with your Bob Weir.
Okay. That's the first time you've ever said Bob Weir. Do you know who Bob Weir is, Justin?
He's some guy that does some music stuff, right?
Oh God! Jeez, what are you going to do? Okay. Oh God. Oh, I gotta help you out. So this is the Bob Weir Take a Step Back, where we look at the weekly, and you can also do this on the monthly, just to see, is there anything else here that we're missing or that will add to the picture. So we're going to look at a bunch of charts in different ways. And what I like to do is not lean too heavily on any one of them, but I just let it tell me a story of the health of the market in any areas that look stronger or weaker than others. So with the weekly candles on this, you can get a sense for where are you? Is it normal or natural? Is it healthy? This one, I really actually like this weekly candle because your bottom wick is so long. That tells you cleaned out a lot of people this week, and then you were able to close back up. Now, well off the lows. But what's not good about it is it's a pink candle, because just a sign that it closed weaker than where it opened. So it's a mixed on there, but being up relatively near highs, I would say that the tie goes to it being more positive than negative. Let's look at the same thing on NASDAQ. Much better there, right? You've got this tiny little, what I call a sliver body. So it really closed about where it opened, just slightly below it. But you had this huge bottom wick where it really cleaned out a lot for the week. Very constructive. Not what I would call a setup week, because the spread was too wide for that. But it looks like it wants to go higher. Just looking at it through this lens, let's look at the IWM, which I have a position in, and this is the weakest of the candles, because you got this big negative body, the distance between the open and close. But on the good side is you did have a close above last week's low, but not into the body area of it, which that's, you'd prefer it to have been at least closing where last week's open was. So it doesn't have that, but it has a decent bottom wick. But I'd say that the composite, NASDAQ composite, looked the best. SPY looked in the middle, and then this one looked the worst there. Let's go over to our original regression lines. Nothing to talk about here. This one, for a while, we were using a different one. Those broke as well, but really the October 10th broke the look of this regression. So we're waiting for a new channel to emerge there. Same thing on the NASDAQ. So what we will do is eventually we'll use the 11/21 date, and then go out 50 days for our next channel or regression lines. We'll skip our alternative ones. Now here's our 50% retracement, and this is an art. You can pick all sorts of different highs and lows. This week I decided to go with the high, this high here, and then what was the date on that? The 29th of October, and then the low here in November, on November 21st. You want to live in the upper half of that area, and that's where you are right now. The 50% retracement is 670 and change, and we're in this area, the sign of strength. So that's good. The same thing here with, I guess must have gone away because I did put those in here. Let's go ahead and add that back. Not sure.
Well, now we can see how you do it.
It's as simple as that. So
there you go.
The same high, same low, and it shook out below that this week on that bad day on Wednesday, and now you're back up above it, and so you want to stay in that area. Let me see if I did the IWM. Yes, I did do it on the IWM. This one, I wanted to show that you could keep old ones in there. So this was our, oops, I gotta move this so I can see that date. The October 10th low and the October 15th high, just to see what was going on. Now, obviously this traded underneath it over here and above it over here, but with that, it's still in the upper half. Now we could slice this a bunch of different ways. Let's move over to our lines of importance. And we'll start off with SPY here. Now we've got two lines that are important, pretty much in the same general area. One was from the over here, the highs in October. The other one is a low this week. So I would say when you've got the congestion there, you can just remove one of them. Let's remove that one. And we'll only look at the low from, just to keep it a little bit on the simpler side, the low from this week becomes really important. The low from the 21st of November is important. Over here, there's a million other lines that are important, but really this low from August 1st becomes your clear line in the sand. That's why it's thicker on there, the 619.29, because it coincides with your 200-day moving average, which is that teal line there. Let's go over to the NASDAQ. Again, a lot of noise on here. One area that we want to get above this, where I have the high from the 10th of this month marked. Then you've got this one here, which is the high of the October 10th day. And which kind of went with today's low. We're going to go ahead and get rid of that one to simplify this chart. And again, only use the low from this week, which becomes very important. The low from the 21st. And then our line in the sand, again, is going to be way back over here, right along with the 200-day. So the same thing with IWM. We've got the high from October 15th that we want to get through, and then the low of this week on the downside. And really what's important for this one, because we've had years and years with this fading, is the low here, the November 20th low. We want to stay above that, or this is going to be kind of a broken chart. Now we can look at my Fibonacci moving averages on here. This is something I've been using for years, and I've recently just been sharing it on the SMTs. It might look like a lot of noise to you at first, but if you put this on your screens, I think you're going to get a lot from them. I use Fibonacci numbers. You can pick other numbers, but so 3, 5, 8, 13, 21, 34. You can just Google them to see. And they space out nicely, just the way the whole Fibonacci works out. So you can see very, very short term to really long term, and everything in between proportionally. And what you want is you want those stacked properly, as we were over here. That really kind of defines a trend where your shortest term moving average, your 3 is above your 5, and your 5 is above your 8, and your 8 is above your 13. Your 13 is above your thick blue line, which is your 21 day, and so on, or your 34, which is something I don't talk about a lot, but is a very important one. And that's that kind of tan one. And that's why I put it thicker there. So that's a sign that you're in a good, healthy trend. And we're not in that here, because you've got a bunch of crisscrosses in there, and that happens, but it just tells you you've been in more chop. And you can look at this, or you can look at your account to see maybe some of you haven't been chopped up, so very happy for you, but I've been chopped up during this time. And really those moving averages are kind of another thing to just a warning. Let's look at the same thing on the NASDAQ. Same thing there. Let's look at the IWM. A little bit better there, frankly. And you always kind of want to look and see where your shortest term moving average, where is that? What is that one holding above? And this one held above its 21 day, which again is that blue line there. Let's just look at RSP for fun. And that one actually looks the best out of all of these, where they're pretty much stacked again with today's action, where it looks like the 3 is above the 5 and the rest of them are stacked properly, which is one of the reasons why we put the RSP back on. We'll do our final, if that was too much noise for you, here's our simplest one. This is Allie's favorite, and this is just the 21 day. So we started off with taking a step back with the weekly. We looked at a bunch of different ways of looking at things, and now we're just keeping the very, very simple way. Is your low above your 21 day or not? And our low is not above our 21 day, but our close is back above it. And for me, I really want that low to get above your 21 day, close up on the day, and really do that for at least 3 consecutive days where your low stays above your 21-day and you close up in a material way on the day, and then you've regained that moving average, in my opinion. So we're at day 1 of that. You got to get a close above the moving average, then you got to get your low above the moving average and close up. Then 3 consecutive days, your low above the moving average and close up. That's just how I like to look at things. Not the only way, but it is my way. Same thing with the NASDAQ here. You get a close back above it, but we need to get the low above it. Let's look at the IWM. This day is our first day where our low is back above the 21-day and you closed up. So even though we had some things that looked weak, like the weekly chart and some of the other charts, from this standpoint, this one looks the best compared to SPY and the NASDAQ. Now let's look at RSP. Much better, right? It's held above that for this, all the way going back to the 25th of November. It's been able to stay above your 21-day. Let me stop sharing there and just go over to one more thing, and I'm just going to do the Webby RSI stuff. Did they find somebody to?
Oh yeah, we're all good. Yep.
You're good. Okay. All right. I was freaking out for you. Let's see. So we wear a lot of hats. It's not just Hat Man that wears a lot of hats. We wear a lot of hats.
A lot of people are having to pick up the slack of my mistake. So hopefully we get the paper out.
I hope so. All right. So here we've got SPY using the Webby RSI. What is this? If this is your first time looking at this, this bottom part, that's your Webby RSI. It's just measuring in terms of your ATR, your low versus your 21-day. So when your low is through your 21-day, you don't have anything there. So we don't have a Webby RSI to look at, which is also giving you information that you're in that kind of riskier chop area. Same thing with the NASDAQ, but what was worse about the NASDAQ is you started getting this kind of burnt orange histogram there, even though it was tiny. This is in terms of ATRs, so it was only like 0.28 or 0.25 ATRs, where your high was underneath that moving average, which is a real sign of weakness. And let's just scroll out here. Look at this big wall of orange that ends up happening, and that was back during the bear market that we had at the beginning of the year with the whole tariffs concerns, and you could just see that wall that you wanted to just stay out of that mess. We will finish this one by looking at I need to look at the IWM as well. But the RSP is starting to get this wall of blue. We just want it to be bigger, which would mean your low would have to get further away from your 21-day to really show some power. We will look at the IWM there. And that one, we can see this little poke there. And we're starting to get, that's like one brick in the wall. And I'm going to stay away from those references. You knew where I was going. I knew you knew where I was going. There you go. How can you eat your... No, I won't even...
Yeah.
There's so many things. I wish you were here. All right, so here is our... and I could go on forever. The off high. This is our Bob Marley off high. And it's just measuring in terms of ATRs how far you are off your high. And we use our low in the calculation there. So you rarely see it all the way up to the top because that would just be very odd. But the green area is 4 ATRs, yellow area is 4 to 8 ATRs, and your red zone is under 8 ATRs. So how I like to look at this is, one, just how many ATRs off the high are you, is just a kind of a wake-up call. If you're in the red area and you're still bullish and you're going down, you've got to, it's a wake-up call for you. In the green area, you don't want to get too bearish. It's a reminder to not get too bearish, and that I can get too bearish too quickly. And so this is one of the reasons why I created this one. And then the other thing is each instrument, whether it's a stock or an ETF or an index, will have a different character. Where off the high does it like to come off before it starts getting support? And you can see this one, it really likes it kind of in this area, shy of 2. or just shy of 3 ATRs, it tends to get support. You get outliers like this one that got close to 4, this one that got into the 4s, but you kind of start seeing where does it get support, and it got support in and around that area again this time. So again, more of a normal and natural. Let's look at the NASDAQ, and that's a bit more all over the place. This one, you can see it tends to get support in the high 3 ATRs off the high. It did that there in August, again at the end of August, again over here. Then it got a little bit worse over here, but then this week, still in that same type of area. So that's on your positive side. And we will look at the IWM. And this one, it feels like it's kind of in the, the 2.5 to 3 area, and that's about where you got. So what does all these squiggly lines mean? You weigh each one a little bit differently. I put the most weight in that simple chart at the end, at the end of our TradeStation charts, that was just the 21-day moving average. And just to keep it very simple, are you above it or are you not? Is your low above it or not? And we went through that. So we're at the beginning phase of kind of a recovery based on those things. And you had some mixed results in there. Some things looked better depending on what lens you looked at them through. And look, if you don't like all that, if it's noise to you, just pick and choose the ones that work for you. I've got more ways of looking at it, but this is the bulk of it. And I don't look at I don't look at psychological indicators. I don't look at seasonal stuff. I don't look at, VIX, put to call, any of that noise. And so if this feels noisy to you, it's very simple. It's all just based off of high, low, and close and open,
Mm-hmm. Okay. Well, so this is your last SMT video of the year. And just maybe give a kind of wrap up. I mean, there's a lot of talk of what the end of the year entails in terms of window dressing, low volume, people, already going on vacation. And then, of course, there's the first week of, January, which a lot of people look at, especially after you've had a, decent year in the indexes, where sometimes there's some selling as people have pushed their tax burden to the next tax year. So anything to kind of close out the year besides the happy holidays?
Yeah, I was looking to see how long it was, but since you asked, I did Webby Rambles On, which is my podcast, non-IBD podcast that I've got that is on my YouTube channel, Webby 5150. If you forget, you can just go onto my X or Twitter handle, MWebster1971, and I'm always posting links there. But tomorrow morning, I've got about 2 hours, give or take, on that topic that you're talking about. So I will spare everybody listening to it now. So those who have a hard time sleeping and want something to fall asleep to, they can listen to that tomorrow morning. And it's this procedure that I go through every year, because Bill O'Neill would always say if he was ever going to take a vacation, it would be in January, because Januaries are so tricky. And you and I both know that he never really took any of those vacations, but he would always just say that. But January is
working less,
Working less, yeah. But January is a time where there's so many cross currents that end up happening. You don't want to be out unless your instruments are telling you that, but you want to approach it in a different way. And so what I do, the same thing I do every year, where I look at every year end, the last few weeks of December and the first few weeks of January, and I try to find ones that look similar, a similar setup to our current year, and that's what I did in that, and then just try to gain information from there. And it's just something that helps a lot. I hope people watch it and stay awake for it, because it is a lot of info. If you're not going to watch it, this is what I'll tell you, that between now and the end of the year, use your normal instruments. At the beginning of the year, just lean on more on having your foot off of that gas, just to be on the safe side until all your instruments are kind of perfect, because you've got these cross currents where people who didn't sell at the end of the year end up selling, because for tax reasons. You have a lot of window dressing that ends up happening from big institutions that, maybe they don't want to show something on their books, or they do want to show something on their books. So there's lots of gyrations at the end of December, and those get unwound in early January. So that's where all these cross currents happen. And what you don't want to have is, if you're up to your eyeballs in stock and you get one of those wild moves in January, to then be in a negative mindset to set you up for a really bad year. So if you just ease off the gas in early January until you get some clarity of how the market's trading, that's it in a nutshell. So I saved everyone a bunch of time.
There you
There's
go.
a lot more. There's a lot more.
But what if we
details
need to
in
sleep and we want to watch it anyway?
If you need to sleep, you got Ambien, you got Webby Rambles On. They're about the same.
Well, that's going to wrap it up for us today. Thank you so much, Mike.
Wait. One more thing. I just got to say, Merry Christmas to you and your family, and to everyone who is watching. A very special Merry Christmas and a Happy New Year. And I will see you the first week of January.
Sounds great. Well, the great way to end things. Thanks a lot for the commentary. That's going to wrap it up for us this week, and we will see you on Monday. It's going to still be a trading day, so we will have IBD Live. I'm actually going to be out that day, so someone else will be hosting in my stead. We'll also have the Stock Market Today video. Someone's going to be helping on that side as well with Alexis. And then we're going to have a shortened trading day on Wednesday and the day off on Thursday, but right back here on Friday with the Stock Market Today video. We'll see you all then. Have a great one. Bye now.
The news flow on the AI story will remain volatile.
Scale is getting to be even more important given the investments that are needed in AI.
Anyone investing solely in AI right now is taking risks they don't need to be taking.
There are some tailwinds for U.S. companies into next year. The earnings engine in the United States is on.
In the end, the fundamentals will dominate.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It is Friday. Good morning. Welcome to Bloomberg Surveillance. Finally getting a spot of positivity, an unusually skeptical December, with stocks building on yesterday's rally. A renewed focus this morning on TikTok, with an agreement being signed with firms including Oracle about a joint venture. Oracle shares higher this morning, and a Bank of Japan rate hike, capping a big week of central bank decisions, with Japanese yields at the highest levels going back 30 years. You are seeing just a bit of yen weakening this morning. Danny Berger alongside me this morning. I'm so pleased to say, Danny, it really does seem like such a huge divide between the rest of the world and the United States when it comes to the rate cutting or rate hiking type of backdrop.
100%, because you have, as you say, the Bank of Japan hiking rates to a 30-year high. The ECB yesterday putting things on hold, in a Bloomberg story out shortly after of officials saying the rate cutting cycle is over. Then you had a more divided and hawkish BOE decision. For now, the U.S. is concentrating on CPI. But as we get into this quiet period, how much of the narrative turns into there are holes? So maybe the more important thing is what's happening to bond yields abroad, and that pressuring us here at home.
Right now, it seems like people are saying, yes, there are holes in that CPI report. Yes, it was completely unreliable. Yes, you cannot look at this and say that that is how much CPI actually did go down relative to the month before. However, we don't care, because it's going to give this Fed a chance to run this economy hot, which is the thesis heading into 2026.
To be fair, Austin Goolsbee, who was one of the FOMC members who dissented in the last decision, he was out yesterday saying that there was a lot to like in the CPI data. He said, yes, you need more than 1 month, but having someone who's maybe on the more hawkish side, kind of confirming that the data's looking better, that was just another feather in the dove's hat. But maybe it's enough just to kind of get this narrative shift that things are cooler, even if, owner's equivalent rent is, some people saying that someone should be fired for it.
Yes, we saw that report yesterday coming out, because there just is a zero put there if you don't have the comp. Meanwhile, we are looking ahead to a big year of geopolitics geopolitics and a question of the government's role in really supporting big tech in the United States. We saw finally there does seem to be some sort of joint venture with TikTok. I think this is really interesting in light of some of the bigger questions about the U.S. government's involvement in big U.S. companies that are considered strategically important.
And Oracle and the Ellisons just keeping a thread in so many of these deals, whether it be this, whether it be Warner Brothers Discovery. How much of this deal making is away from the world of we're buying things because they grow well versus we're buying things because we're closely connected to the government and we want to be involved in whatever national security concerns that the government also has?
I want to hear what Larry Ellison is hearing, because let me tell you, I think that would be actually quite instructive right now in markets. A question about whether we can reprise the Santa Claus rally that isn't this year. We're down about 1% on the S&P so far this month, even with yesterday's bounce this morning, trying to build on that, up about 0.25%. I feel like every morning we're up between 0.25% and 0.5%, and then it's a wild ride for the rest of the day. Meanwhile, that euro-dollar cross around that 117 mark, man, it has been pegged there. And you're looking at 10-year yields just marginally higher, up 2 basis points after the Bank of Japan rate hike to 4.14%. Coming up this hour, Kevin Mann of Henian and Walsh with stocks coming off their best day in 3 weeks. It's a low bar. Heidi Kribo-Redeker of the Council on Foreign Relations on what's next for peace talks between Russia and Ukraine. And Krishna Guha of Evercore ISI on potential holes in the CPI inflation data. What, Swiss cheese? I think, that was one thing, or take it with the entire shaker of salt. We begin this hour with stocks rising as markets close out the last full trading week of 2025. Kevin Mann of Henian and Walsh writing his macro theme in 2026 is follow the money, saying we believe that the bull market will celebrate its 4-year anniversary. However, there will likely be short-term bouts of volatility. Kevin joins us now. Volatility seems to be the theme, and yet money is the trump factor. What we're seeing right now is people flooding back into equities. Is it enough to get the optimism back before the end of the year?
I think optimism will continue in certain areas of the market. And to my quote earlier, I think the areas of the market that led this bull market over the first 3 years may very well not be the areas that lead this bull market over its next 3 years, if in fact it continues that long. But if you follow the money in terms of where all the money was spent in 2025 and will likely be spent in 2026, I still think there's more growth opportunities ahead.
How much is that predicated on this idea of running the economy hot? The idea that the Federal Reserve is going to cut rates on any excuse, even a very holy CPI report, I mean, full of holes, not necessarily religious. There is this feeling that they are looking for reasons to cut rates, even with inflation higher than expected. Is that sort of the base case for you?
Not for me. In fact, if I look to just a week ago from the Fed's dot plot chart at that point in time, they're forecasting just one rate cut in 2026 and one more rate cut in 2027. Now, that could all change next May when we have a new chair of the Federal Reserve. Perhaps we get both of those rate cuts in 2026, but I wouldn't expect too much during the first half of the year. But regardless of what the Federal Reserve does, we know that this AI infrastructure spend is going to continue, albeit through some circular financing levels. We know that the spending on aerospace and defense is going to continue. President Trump announced, I believe, $901 billion going towards defense in the U.S., and we know that NATO countries have committed to spend up to 5% of their GDP on defense by 2035. That's a lot of money going towards defense contractors. And how about power? The AI revolution stops without power. So we need to look at nuclear. We need to look at natural gas, and that brings the utilities into play. And then my biggest theme for 2026 is healthcare. And not traditional healthcare like large cap pharma, but small cap biotech. I think there's going to be more M&A activity. It's going to be focused on those areas such as oncology, obesity drugs, cancer treatments. If you look at the gene editing and gene splicing, that's where all the activity is going to take place. And here's a great stat for you. Over the upcoming years, over 200 drugs are scheduled to come off patent. Associated with those 200 drugs is over $300 billion worth of revenue. As all of those drugs now get subject to generic pricing, where's large cap pharma going to turn to replace all that lost revenue? They're going to have to be acquisitive, and small cap biotech is going to ride that tailwind.
You know, in all of these sectors that you're talking about, you could tie some sort of AI element to it.
Oh,
usually people talk about it as a benefit. But can you talk about the other side? When you think about AI disruption, Are there things that you wouldn't touch for fear of disruption, be it enterprise software, be it a radiology company? What do you want to back away from as we try to figure out how AI impacts things?
Sure, I'm going to answer that question a little bit of a different way. To provide a smoother road for investors along this AI revolution, which is going to be a very long road, as we know, filled with many potholes, I think you need to build a diversified portfolio across the entire ecosystem. Don't lean so much into semiconductors and chips and software plays right now. We're still in the infrastructure build-out portion of this revolution. I've said on this program before, I think we're in batting practice of a doubleheader. Batting practice involves infrastructure. The games involve the actual spending and deployment of AI. So I would shift more time and attention to the data center plays, data center construction, electrical connectivity, cooling solutions like a company like Comfort Systems being added to the S&P 500 next Monday. Their stock's up over 100% year to date, yet they're only trading at a forward PE of around 34. Not too rich, and then bring in the utility plays as well and some of the small modular reactors. I think that's a better ride.
Kevin, it also strikes me that a lot of what you're talking about is also happening in private markets, just not in public markets. Can you get the exposure you want just through public equity? Or do you need exposure to private credit, to private equity, to other parts of this ecosystem?
Yes. I've been resistant so far on private credit and private equity because liquidity is paramount to me in our portfolio structures. Liquidity doesn't matter until it matters, and generally during that periods of volatility and crisis, so I don't want to subject to my clients to liquidity concerns. But I think you can find exposure to all those areas of the ecosystem through the public equity market. And I think there's an abundance of opportunities out there, but valuations do matter. And all the means by which these companies are financing the way that they play the AI revolution is important, right? Because to me, there's going to be more losers than winners in the AI revolution. But the best way to find and identify those winners are those who are deploying capital strategically, smartly with the balance sheet to sustain themselves throughout this entire revolution. But don't just look for the next NVIDIA of the world. Look to those ancillary benefactors.
Can those ancillary benefactors win without government support? And I say this as the U.S. government gets more involved in picking the winners and losers, and a lot of the issues that we're talking about, in particular in the power area, become increasingly politically motivated. You think about power prices rising 10% in the first 8 months of the year. This raises a question, especially for an administration that wants to bring down costs. How does that factor into the calculus of what some of the profit landscape looks like for these companies?
I would think that the utility sector is an excellent example of an area that will benefit because of government failures with respect to upgrading and maintaining our power grid. Before the AI revolution, our grid was frail and it was ripe for shutdown. Now, these utility companies aren't going away regardless of the AI revolution. But as we saw with the deal between Microsoft and Constellation Energy to reopen 3 Mile Island, large cap tech's not waiting for the government to fix the grid. They're going out and forming their own strategic partnerships. And then we see the evolution of these small modular reactors from a company like NuScale Power, ironically enough with a ticker of SMR, building these small modular reactors so that data centers can get nuclear power off grid. That's the future, regardless of what the government does. So some of these themes can persist with or without government intervention.
Before we let you go, Kevin, because you're so optimistic, it's been a pretty pessimistic December.
Optimistic.
Cautiously optimistic. Okay, fine, but cautiously optimistic, but optimistic nonetheless. And we're looking at a lot of pessimism to close out the year. Even good earnings reports. Nike's could have been thought of as a good earnings report. Absolutely, stocks tanking. There is this feeling, show me, and then when you show me, it's not going to be enough. What's it going to take to turn around the sentiment?
I think there's a large contingent of investors on Wall Street who really want this perceived AI bubble to burst. And I think for those investors who are waiting for this bubble to burst, they're likely to miss out on the most significant returns that the AI revolution has to offer. But there's going to be a lot more volatility next year than there is this year. We got midterms, we got the partial funding of the federal government coming due at the end of January, we got the debt ceiling debate. All that's going to create some choppiness. But I think this bull market continues into its 4th year in 2026.
Kevin Mann, thank you so much for being with us.
My
Great
pleasure.
to see you. Kevin Mann of Hennian and Walsh here in New York. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa.
TikTok and ByteDance have signed agreements to create a U.S. joint venture that will be majority owned by American investors. According to an internal memo seen by Bloomberg, Oracle, Silver Lake Management, and MGX have all signed onto the deal. It is expected to close on January 22nd if approved by Chinese regulators. Oracle shares are up nearly 5% in the pre-market on the news. Meanwhile, the suspected shooter in the Brown University attack and alleged murder of an MIT professor has been found dead. Claudio Manuel Neves Valente was a 48-year-old Portuguese national and former Brown student. The motive for the attacks is unclear. The Trump administration has halted the U.S. green card lottery program, which it claims was used by the suspect. And the Bank of Japan delivering an interest rate hike to raise levels to their highest since 1995. The move is part of a continued shift from ultra-loose policy. Governor Kazuo Ueda signaled markets should expect further gradual increases. A fresh read on consumer prices in Japan also showed inflation rising 3% for November, above the BOJ's 2% target. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. More on the Bank of Japan coming up. Up next, though, standing behind